Welcome everyone to Chapter 3, and let me tell you, this is where things get real. If you've ever wondered what separates a good accountant from a great one, the answer lies in the topics we're about to cover. This chapter is the core of accounting, the foundation upon which everything else is built. It's not just important, it's absolutely essential. For every single one of you starting your accounting journey, these topics are your golden ticket. Why? Because mastering the skills in this chapter is what makes you indispensable. If you get these concepts right, you'll set yourself up for an incredible professional career. You'll be the one businesses rely on to make sense of their financial world. But let me be completely honest, if you overlook these basics or don't fully grasp them, it can create long-term challenges. Accounting is all about precision. And these are the tools you need to get it right every single time. Think of this chapter as the toolbox for your future. Each topic is like a tool you'll use every day to help businesses stay on track, thrive, and grow. From recording transactions to managing ledgers, you're not just learning processes. You're learning how to transform raw financial data into meaningful insights that drive decisions. You're becoming the expert every business needs. Now, I know this might sound intimidating, but here's the good news. You're not alone. I'll be walking you through each topic step by step, making sure everything is crystal clear. You've got what it takes to succeed, and together, we're going to make sure you come out of this chapter feeling confident and ready to apply what you've learned. So, let's take a quick look at what's ahead. 1. Recording business transactions, an overview. The starting point for understanding how financial records are built. 2. The general ledger, the heart of accounting where everything comes together. 3. Recording in the general ledgers, learning how to post entries correctly and maintain accuracy. 4. Trade receivables and trade payables, managing the money businesses owe and are owed. 5. Accounting for sales tax, a vital skill for compliance and financial reporting. 6. Methods of coding data, organizing information efficiently to avoid confusion. 7. Manual and computerized systems, understanding both traditional and modern accounting processes. 8. Batch processing and control totals, ensuring your records are complete and error-free. 9. Accounting systems, how everything ties together in a functioning system. 10. Accounting modules, diving into the specific parts of modern accounting software. Every one of these topics is like a puzzle piece, and when you put them all together, you'll have a full picture of how to manage and understand financial data. And the best part? Once you've mastered these, you'll have a skill set that's respected, in demand, and highly valued in the professional world. So, are you ready to take this next big step? Let's get started on this incredible journey and unlock the skills that will shape your future success. All right, dear students, let's dive into our very first topic from Chapter 3, Recording Business Transactions. This is the foundation, the very first practical step in preparing financial reports. It's where everything begins, capturing the financial story of a business step by step. But before we move forward and explore how to record transactions, there's something very important we need to understand first. What is a source document? Why? Because every single transaction in accounting is recorded from a source document. Think of it as the starting point, the evidence, or the proof of what actually happened in a business. Whether it's a sale, a purchase, or even paying a utility bill, there's always a document behind it. And this document guides how we record it. So let's take a moment to fully understand source documents before we move on to recording transactions. Trust me, once you get this right, the rest of the process will feel much smoother and more logical. Ready to begin? Let's go. What is a source document? Let's start with a simple question. How does a business keep track of its transactions? When money comes in or goes out, how do we know what happened? The answer lies in something called a source document. A source document is the original record of a business transaction. Think of it as the evidence that something took place. Whenever a business buys something, sells something, pays an expense, or collects money, a source document is created. It provides the details of the transaction: what happened, when it happened, how much money was involved, and who was involved. Source documents are essential in accounting because they provide proof that a transaction took place. They contain all the details needed to record the transaction accurately. They act as a reference if there are any questions or audits about the business's finances. Without source documents, we'd have no way to confirm the accuracy of the records in the accounts. They're the foundation of the accounting process. How to record a business transaction from a source document, step-by-step guide. When it comes to accounting, every transaction begins with a source document. The source document is the proof that a business transaction occurred, and it contains all the important details you need to record it correctly. Let me guide you through the detailed process of how a business transaction is recorded from a source document. Step 1. Identify the transaction. The first step is to figure out what the transaction is. You must ask, what happened? Did the business make a sale, buy something, or pay a bill? Is it a cash or credit transaction? Who is involved? A customer, a supplier, or an employee? What is the amount involved? Example: a business sells goods to a customer on credit. The customer is issued a sales invoice, which serves as the source document. This invoice shows the date of the sale, the goods sold, the quantity, the price, and the total amount owed. Step 2. Check the details on the source document. The source document contains critical details you'll need for accurate recording. Always verify. 1. Date of the transaction. 2. Parties involved, e.g. customer or supplier name. 3. Description of the transaction, e.g. type of goods sold or service provided. 4. Amount, ensure it's accurate. 5. Payment terms, if it's a credit transaction, when is payment due? 6. Taxes or discounts, if applicable. Step 3. Determine the type of account. Next, figure out which accounts are affected by the transaction. Ask yourself, does this involve an asset, liability, income, or expense? Is something increasing or decreasing? Example: in the case of the credit sale to John's Furniture, the business has sold goods, so sales, an income account, is increasing. The customer owes money, so trade receivables, an asset account, is increasing. Step 4. Decide the debit and credit entries. Accounting follows the double entry system, which means every transaction affects at least 2 accounts. 1. One account is debited, left side. 2. Another account is credited, right side. To decide, debit the account that increases in value or decreases if it's a liability. Credit the account that decreases in value or increases if it's income. Step 5. Record the transaction in the journal. The journal is the first place where transactions are recorded. Here's how it's done. 1. Enter the date of the transaction. 2. Write the debit account and the amount. 3. Write the credit account, slightly indented, and the amount. 4. Include a brief description of the transaction for clarity. Step 6. Post to the general ledger. After the journal entry is made, the amounts are transferred to the respective accounts in the general ledger. Each account will now reflect the updated balances. The general ledger is important because it organizes all transactions by account, making it easier to prepare financial statements later. Step 7. Cross-reference and attach the source document. To maintain accuracy and accountability, attach the source document, e.g. sales invoice, to the journal entry or record. This provides evidence of the transaction. Why is this important? If there's ever a question about the transaction, e.g. during an audit, you can refer back to the source document for verification. Step 8. Check for accuracy. Before moving forward, ensure the debits equal the credits. Verify the amounts match the source document. Double-check that the correct accounts were used. Pro tip: always review your work to catch errors early. Mistakes can lead to incorrect financial reports, which can harm decision-making. Comprehensive list of source documents for business transactions. Here is a detailed list of all the possible source documents a business might use to record its transactions. This includes documents for sales, purchases, payments, receipts, and other types of transactions. Sales-related source documents. 1. Sales invoice, issued when goods or services are sold on credit. It details the transaction, including the buyer's name, the amount due, and the payment terms. 2. Credit note, issued when a customer returns goods or there is a reduction in the amount owed, e.g., due to damaged goods or overcharges. 3. Delivery note, a document sent with goods to confirm what has been delivered to the customer. The customer may sign it to acknowledge receipt. 4. Quotation, provided to a customer to show the price of goods or services before a sale is finalized. 5. Sales order, issued to confirm the details of a sale agreed upon with a customer. Purchase-related source documents. 6. Purchase invoice, received when the business buys goods or services on credit. It provides details of what was purchased, the cost, and payment terms. 7. Debit note, sent to a supplier to request a reduction in the amount owed, e.g., for faulty goods or overcharges. 8. Goods received note, GRN, prepared when goods are received from a supplier. It records the quantity and condition of goods received. 9. Purchase order, sent to a supplier to confirm the order of goods or services. 10. Supplier statement, a summary of all transactions between the business and the supplier, including invoices issued, payments received, and outstanding balances. 11. Receipt, proof of payment received or made, either in cash or through other payment methods. 12. Check stub, the part of a check left in the checkbook after a check is written. It records details of the payment made by check, including the date, amount, and recipient. 13. Check received, a physical or electronic check received from a customer as payment. 14. Bank statement, a record of all transactions in the business's bank account, including deposits, withdrawals, and bank charges. 15. Petty cash voucher, a document used to record small cash expenses, like buying stamps, small office supplies, or coffee for a meeting. 16. Payment voucher, used to record payments made, often for larger transactions or where a check or bank transfer is involved. 17. Electronic fund transfer, EFT record, proof of payments made or received electronically. 18. Direct debit mandate, authorization for a supplier to take payments directly from the business's bank account. 19. Standing order confirmation, a fixed amount paid to a supplier on regular intervals, recorded for payment tracking. Cash-related source documents. 20. Cash receipt, issued when a customer pays in cash. It confirms the amount received. 21. Cash register roll or till slip, a detailed record of all sales made through a cash register. 22. Petty cash reimbursement form, used when the petty cash box needs to be topped up to maintain a fixed balance. Employee and payroll source documents. 23. Timesheets, used to record the hours worked by employees, especially those paid hourly. 24. Payslips, provided to employees to show details of their wages, including gross pay, deductions, and net pay. 25. Payroll summary, a document summarizing payroll payments made during a period. Miscellaneous source documents. 26. Utility bills, received for services like electricity, water, gas, or internet. They detail the amounts owed and due dates. 27. Rent invoice or agreement, records the monthly or periodic rent payment amount due. 28. Loan agreements, documents showing the terms of a loan received by the business. 29. Bank deposit slips, proof of cash or check deposits made into the business's bank account. 30. Insurance policy documents. Provide proof of insurance coverage and any premiums paid. 31. Contracts or agreements. For services provided or received, documenting agreed terms and amounts. 32. Purchase requisitions. Internal documents used to request the purchase of goods or services from suppliers. 33. Stock adjustment forms. Used to record any corrections or adjustments to inventory levels, such as damaged stock. 34. Expense claims. Submitted by employees to reimburse business-related expenses they've paid for personally. Why is this comprehensive list important? Each of these documents serves as proof of a business transaction and provides the details needed for accurate accounting. By knowing the types of source documents, you'll be better equipped to understand how transactions are recorded, keep proper records for financial reporting and tax purposes, avoid errors, and ensure all transactions are backed by evidence. Think of these documents as the starting points of the accounting cycle. Without them, the rest of the accounting process, like recording transactions, posting to ledgers, and preparing financial statements, would not be possible. Thank you, dear students, for staying with us throughout this lesson. I truly appreciate your time, focus, and dedication. You're doing an amazing job by taking these steps toward mastering accounting, so give yourself a pat on the back. Now, this lesson covered the theory part of recording business transactions, and I hope it gave you a clear foundation. But here's the exciting part. In the next lesson, we'll jump into the practical side of things. We'll not only show you how to manually record transactions step by step using Microsoft Excel, but we'll also take it further by exploring 3 of the most popular accounting software programs: QuickBooks, Xero, and Sage accounting software. This means you're not just learning accounting concepts. You're also gaining real-world skills that will boost your career opportunities and set you apart in the field of accounting. Knowing how to work with these tools is something employers truly value, and you'll have a head start. So for now, goodbye and have a great time. Don't forget to support us by liking this video and subscribing to the channel so you don't miss the next lesson. I'll see you soon as we dive into this exciting practical journey. Take care and see you in the next lesson. Welcome to today's lecture, everyone. As promised, today we're diving into the practical part of recording business transactions. We're going to start entering transactions into the general journal, step by step, using the scenario of Neelam Sultan's florist business, Bloom and Blossom. This will give you a hands-on understanding of how accounting works. In today's session, we'll keep things manual and focus on using a chart to record the transactions. But don't worry, this is just the first step. In the next session, we'll level up and input these transactions into some of the most popular accounting software, like QuickBooks, Xero, and Sage accounting software. This way, you'll not only understand the theory, but also gain practical, in-demand skills for your accounting career. Before we get started, a quick reminder. If you're new to the channel, please like the video and subscribe to support us. This helps us bring more lessons like this to you. Before we dive into recording transactions manually, I want to quickly mention something important. Manually recording business transactions is rare in today's world. Most businesses now rely on accounting software for speed and accuracy. However, learning to record transactions manually is still incredibly valuable. It helps you truly understand the process, the rules behind it, and how debits and credits work. If you find yourself struggling to understand the transactions or how to record them, don't worry. We've got you covered. Make sure to watch Chapter 1 and Chapter 2 videos that we've uploaded earlier. Those lessons explain the basics of transactions, the double entry system, and how accounts work. Reviewing them will definitely make this easier to follow. All right, Now let's start recording Neelam Sultan's transactions into the general journal. Let's quickly go over what information comes at the top of the journal and how to structure the entries properly. What comes at the top of the journal? 1. Name of the company. Always write the name of the business, such as Bloom and Blossom. 2. Title of the document. Clearly label it as General Journal. 3. Date range. Include the period you're recording, like for the month of December 2024. This helps keep the journal organized and easy to reference later. How to record transactions in the journal. 1. Start with the date. Write the date of the transaction in the first column. 2. Debit entry. Record the account to be debited on the first line without indentation, followed by the amount in the debit column. 3. Credit entry. On the second line, indent slightly and record the account to be credited, followed by the amount in the credit column. 4. Description. Below the debit and credit entries, write a short explanation of the transaction, like capital invested by owner or paid for flower cooler. This format ensures clarity, keeps everything balanced, and makes it easy to review later. All right, students, let's record the first transaction from Neelam Sultan's florist business step by step in the journal. We'll go through each part of the process to make it simple and easy to follow. Transaction 1. Neelam Sultan invests $15,000 into the business. Step 1. Identifying the transaction. The first thing we need to do is identify what has happened. In this case, Neelam Sultan invested her personal savings of $15,000 into the business. This is the starting capital of the business. The transaction involves money coming into the business and represents the owner's contribution. Step 2. Checking the details of the source document. To record this transaction, we need to look at the source document. The source document here is the bank deposit slip or the bank statement, which confirms that Neelam deposited $15,000 into the business bank account. Always check that the document includes important details like the date of the transaction, the amount involved, $15,000, the nature of the transaction, owner's investment. This ensures that we're working with accurate information. Step 3. Determining the accounts involved. Next, we need to decide which accounts are affected by this transaction. Account 1. Bank account. This is an asset account because the business now has more cash in its bank account. Account 2. Capital account. This is an equity account because the owner is contributing money to the business, increasing the owner's equity. Step 4. Deciding debit and credit. Now that we know the accounts involved, we decide which account is debited and which account is credited. The bank account asset is debited because it is increasing. In accounting, an increase in an asset is always a debit. The capital account equity is credited because the owner's equity in the business is increasing. An increase in equity is always a credit. So, the entry will involve a debit to the bank account and a credit to the capital account. Step 5. Recording in the journal. Finally, we record this transaction in the journal. The journal is the first place where transactions are officially recorded, and it shows both the debit and credit sides of the transaction, along with a brief explanation. For this transaction, the journal entry would look something like this. Date. Record the date of the transaction, which is the day Neelam deposited the money. Accounts. Clearly write the names of the accounts involved, bank account and capital account. Amounts. Write the amount of $15,000 in the appropriate debit and credit columns. Description. Add a short explanation like owner invested cash into the business. Let's now move on to recording the second transaction for Neelam Sultan's florist business in the journal. As before, we'll go through every step so it's clear and easy to follow. Transaction 2. Purchase of a flower cooler for $5,000. Step 1. Identifying the transaction. The transaction involves Neelam Sultan purchasing a flower cooler for her florist business. The cooler is essential for keeping flowers fresh, so it is considered a non-current asset. She paid for this cooler in cash, which means money was deducted from the business bank account. So in this transaction, the business acquires a new asset, the flower cooler. The business pays cash for it. Step 2. Checking the details of the source document. The source document for this transaction is the receipt issued by the supplier of the cooler. This receipt provides the necessary details for recording the transaction, including the date of the purchase, the total cost of the flower cooler, $5,000, a description of what was purchased, flower cooler, confirmation that payment was made in cash. Always ensure that the source document is accurate and complete before recording the transaction. Step 3. Determining the accounts involved. Now, let's identify which accounts are affected. Account 1. Equipment account. This is an asset account because the flower cooler is a long-term resource for the business. It will help generate revenue over multiple years. Account 2. Bank account. This is also an asset account, but it decreases because cash was used to pay for the flower cooler. Step 4. Deciding debit and credit. After identifying the accounts, we determine which account to debit and which to credit. The equipment account is debited because the asset flower cooler is increasing. An increase in an asset is always recorded as a debit. The bank account is credited because the business used cash to pay for the purchase. A decrease in an asset is always recorded as a credit. So, we'll debit the equipment account and credit the bank account for $5,000. Step 5. Recording in the journal. Finally, we record the transaction in the journal. Here's how we do it. Date. Record the date when the flower cooler was purchased. Accounts. Write the names of the accounts involved, equipment account and bank account. Amounts. Enter $5,000 as a debit to the equipment account and $5,000 as a credit to the bank account. Description. Add a short explanation such as purchased flower cooler for cash. All right, let's move on to recording the third transaction for Neelam Sultan's florist business. As always, we'll go through it step by step so everything is crystal clear. Transaction 3. Purchase of fresh flowers for $3,000 on credit. Step 1. Identifying the transaction. In this transaction, Neelam Sultan purchased fresh flowers for her inventory, worth $3,000. Instead of paying immediately, she bought them on credit from a supplier. This means the business acquired inventory, an asset. The business now owes the supplier money, a liability. This is an example of a credit purchase, which is different from a cash transaction because payment will be made later. Step 2. Checking the details of the source document. The source document for this transaction is the purchase invoice provided by the supplier. This invoice contains all the details we need to record the transaction, such as the date of the transaction, the supplier's name and contact information, a description of the goods purchased, fresh flowers, the total amount owed, $3,000, the payment terms, e.g., payment due in 30 days. Always check the invoice carefully to ensure the details are accurate. Step 3. Determining the accounts involved. Next, we identify which accounts are affected by the transaction. Account 1. Inventory account. This is an asset account because the flowers are part of the business's inventory, which it will sell to customers. Account 2. Trade payables account. This is a liability account because the business now owes the supplier, the creditor, $3,000. Step 4. Deciding debit and credit. Now, let's decide which account is debited and which is credited. The inventory account is debited because the inventory and asset is increasing. In accounting, an increase in assets is recorded as a debit. The trade payables account is credited because the liability amount owed to the supplier is increasing. An increase in liabilities is always recorded as a credit. So, we'll debit the inventory account and credit the trade payables account for $3,000. Step 5. Recording in the journal. Finally, we record the transaction in the journal. Here's how. Date. Write the date of the purchase. Accounts. Clearly state the accounts involved, inventory account and trade payables account. Amounts. Enter $3,000 as a debit to the inventory account and $3,000 as a credit to the trade payables account. Description. Add a brief explanation, such as purchased fresh flowers on credit, invoice number 67890. Let's move on to the fourth transaction for Nilam Sultan's florist business. We'll continue using the same step-by-step process to make everything clear. Transaction 4. Rent payment of $1,500. Step 1. Identifying the transaction. In this transaction, Nilam Sultan pays $1,500 for the first month's rent for her shop. This is a necessary expense for running the business. The business pays this amount in cash, which means the cash balance decreases. The payment is for rent, which is classified as an expense because it's part of the cost of operating the business. Step 2. Checking the details of the source document. The source document for this transaction is the receipt provided by the landlord or property manager. This receipt includes the date of the transaction, the amount paid, $1,500, a description of the payment, rent for the shop, confirmation that payment was made in cash. Always verify that the receipt matches the payment details. Step 3. Determining the accounts involved. Now we identify the accounts affected by this transaction. Account 1. Rent expense account. This is an expense account because the rent is a cost incurred to operate the business. Account 2. This is an asset account because cash is used to make the payment and the cash balance decreases. Step 4. Deciding debit and credit. Now let's decide which account to debit and which to credit. The rent expense account is debited because expenses increase and expenses are always recorded on the debit side. The bank account is credited because the cash balance and asset is decreasing. A decrease in assets is recorded on the credit side. So we'll debit the rent expense account and credit the bank account for $1,500. Step 5. Recording in the journal. Finally, we record the transaction in the journal. Here's how it would look. Date. Enter the date the rent was paid. Accounts. Write the names of the accounts involved, rent expense account and bank account. Amounts. Enter $1,500 as a debit to the rent expense account and $1,500 as a credit to the bank account. Description. Add a brief explanation such as paid shop rent for the month. All right, let's move on to the fifth transaction for Nilam Sultan's florist business. We'll follow the same detailed process step by step. Transaction 5, utility bill payment of $200. Step 1, identifying the transaction. In this transaction, Nilam pays $200 to cover utility bills, such as electricity and water, for her shop. This is a necessary expense for operating the business, so it is classified as an expense. The payment is made in cash, which reduces the business's cash balance. Step 2, checking the details of the source document. The source document for this transaction is the utility bill provided by the utility company. This document contains the date of the payment, the total amount due, $200, a description of the services provided, electricity and water, confirmation of payment if the bill was paid immediately, Ensure the bill's details are accurate and match the amount paid. Step 3. Determining the accounts involved. Now, let's identify the accounts affected by this transaction. Account 1. Utilities Expense Account. This is an expense account because the payment covers costs necessary to keep the business operational. Account 2. Bank Account. This is an asset account because cash was used to pay the bill and the cash balance decreases. Step 4. Deciding debit and credit. Next, decide which account to debit and which to credit. The utilities expense account is debited because expenses are increasing. In accounting, an increase in expenses is recorded as a debit. The bank account is credited because the cash balance and asset is decreasing. A decrease in assets is recorded as a credit. So we'll debit the utilities expense account and credit the bank account for $200. Step 5. Recording in the journal. Finally, record this transaction in the journal as follows. Date. Enter the date of the payment. Accounts. Write the names of the accounts involved, utilities expense account and bank account. Amounts. Enter $200 as a debit to the utilities expense account and $200 as a credit to the bank account. Description. Add a brief explanation, such as paid utility bill for electricity and water. Let's continue with the 6th transaction for Neelam Sultan's florist business. And as always, we'll break it down step by step for clarity. Transaction 6. Advertising expenses of $500. Step 1. Identifying the transaction. In this transaction, Neelam spends $500 on advertising to promote her florist business. This includes both online and print advertisements. This is classified as an expense because it's a cost incurred to attract customers and increase sales. The payment is made in cash, which reduces the business's cash balance. Step 2. Checking the details of the source document. The source document for this transaction is the invoice provided by the marketing agency or advertising platform. This invoice shows the date of the payment, the total amount paid, $500, a description of the advertising services provided, confirmation of payment if the invoice was settled immediately. Make sure the invoice matches the details of the payment. Step 3. Determining the accounts involved. Now let's figure out which accounts are affected by this transaction. Account 1. Advertising expense account. This is an expense account because the payment is for promotional activities to support the business. Account 2. Bank account. This is an asset account because cash is used to pay for the advertising and the cash balance decreases. Step 4. Deciding debit and credit. Let's decide which account to debit and which to credit. The advertising expense account is debited because expenses are increasing. An increase in expenses is always recorded as a debit. The bank account is credited because the cash balance and asset is decreasing. A decrease in assets is always recorded as a credit. So we'll debit the advertising expense account and credit the bank account for $500. Step 5. Recording in the journal. Finally, record this transaction in the journal with the following details. Date. Enter the date the payment was made. Accounts. Write the names of the accounts involved, advertising expense account and bank account. Amounts. Enter $500 as a debit to the advertising expense account and $500 as a credit to the bank account. Description. Add a brief explanation such as paid for advertising services to promote the business. Let's move on to the 7th transaction for Neelam Sultan's florist business. This time, it's a cash sale, so we'll go through each step carefully. Transaction 7. Cash sale of $1,200. Step 1. Identifying the transaction. In this transaction, Neelam makes a cash sale of flowers to a customer for $1,200. This is classified as revenue because it's money earned from selling goods, flowers. Since the customer pays in cash, the business's cash balance increases. Step 2. Checking the details of the source document. The source document for this transaction is the sales receipt issued to the customer. This document includes the date of the sale, the total amount paid, $1,200, a description of the goods sold, e.g. a bouquet or floral arrangements, confirmation that the payment was made in cash. Always verify the sales receipt to ensure all details are accurate before recording the transaction. Step 3. Determining the accounts involved. Next, let's identify which accounts are affected by this transaction. Account 1. Bank account. This is an asset account because the business receives cash from the sale, increasing its cash balance. Account 2. This is a revenue account because the business earns income from the sale of flowers. Step 4. Deciding debit and credit. Now let's determine which account to debit and which to credit. The bank account is debited because the cash balance and asset is increasing. An increase in assets is always recorded as a debit. The sales account is credited because the business's income revenue is increasing. An increase in revenue is always recorded as a credit. So we'll debit the bank account and credit the sales account for $1,200. Step 5. Recording in the journal. Finally, record this transaction in the journal with the following details. Date. Enter the date the sale was made. Accounts. Write the names of the accounts involved, bank account and sales account. Amounts. Enter $1,200 as a debit to the bank account and $1,200 as a credit to the sales account. Description. Add a brief explanation, such as cash sale of flowers to a customer. Let's now move on to the 8th transaction for Nilam Sultan's florist business. This one involves a credit sale, so we'll carefully explain each step. Transaction 8. Credit sale of $800. Step 1. Identifying the transaction. In this transaction, Nilam delivers a large order of flowers to a corporate client. The flowers are worth $800, but the client has agreed to pay later within 30 days. This is classified as revenue because it's money earned from selling goods, flowers. However, since the customer hasn't paid yet, the business records the amount as trade receivables, which is an asset representing the money owed by the client. Step 2. Checking the details of the source document. The source document for this transaction is the sales invoice issued to the corporate client. The invoice provides important details, such as the date of the transaction, the total amount owed, $800, a description of the goods delivered, e.g. floral arrangements for an event, the payment terms, e.g. payment due within 30 days. Ensure the invoice is accurate before recording the transaction. Step 3. Determining the accounts involved. Let's identify the accounts affected by this transaction. Account 1. Trade receivables account. This is an asset account because it represents the money the customer owes to the business. Account 2. Sales account. This is a revenue account because the business earns income from the sale of flowers. Step 4. Deciding debit and credit. Now let's determine which account to debit and which to credit. The trade receivables account is debited because the amount owed by the client, an asset, is increasing. An increase in assets is always recorded as a debit. The sales account is credited because the business's income revenue is increasing. An increase in revenue is always recorded as a credit. So we'll debit the trade receivables account and credit the sales account for $800. Step 5. Recording in the journal. Finally, record this transaction in the journal with the following details. Date. Enter the date the flowers were delivered. Accounts. Write the names of the accounts involved, trade receivables account, and sales account. Amounts. Enter $800 as a debit to the trade receivables account and $800 as a credit to the sales account. Description. Add a brief explanation, such as credit sale of flowers to corporate client, invoice number 789. This one involves paying off part of a liability, so let's break it down step by step. Transaction 9. Payment of $1,000 to supplier. Step 1. Identifying the transaction. In this transaction, Neelam makes a partial payment of $1,000 to the supplier from whom she had previously purchased flowers on credit from Transaction 3. This is classified as a liability payment, reducing the amount owed to the supplier. The business uses cash to make the payment, so the cash balance decreases. Step 2. Checking the details of the source document. The source document for this transaction is the receipt provided by the supplier. This receipt confirms the date of the payment, the amount paid, $1,000, a reference to the original credit purchase, e.g., invoice number, confirmation that the payment was made. Always verify the receipt details before recording the transaction. Step 3. Determining the accounts involved. Now, let's identify the accounts affected by this transaction. Account 1, Trade Payables account. This is a liability account because it represents the money owed to the supplier. Since Neelam is paying part of the amount owed, the liability decreases. Account 2, Bank account. This is an asset account because cash is used to make the payment and the cash balance decreases. Step 4. Deciding debit and credit. Now let's determine which account to debit and which to credit. The trade payables account is debited because the liability, amount owed, is decreasing. A decrease in liabilities is recorded as a debit. The bank account is credited because the cash balance, an asset, is decreasing. A decrease in assets is recorded as a credit. So we'll debit the trade payables account and credit the bank account for $1,000. Step 5. Recording in the journal. Finally, record this transaction in the journal with the following details. Date. Enter the date the payment was made. Accounts. Write the names of the accounts involved, trade payables account and bank account. Amounts. Enter $1,000 as a debit to the trade payables account and $1,000 as a credit to the bank account. Description. Add a brief explanation, such as paid $1,000 to supplier for previous credit purchase, receipt number 456. Let's move on to the 10th and final transaction for Neelam Sultan's florist business. This one involves the owner withdrawing money for personal use, so let's break it down step by step. Transaction 10. Neelam withdraws $500 for personal use. Step 1. Identifying the transaction. In this transaction, Neelam withdraws $500 from the business bank account for her personal use. This type of transaction is classified as drawings, which represents the owner taking money out of the business for personal purposes. The withdrawal decreases the business's cash balance. Step 2. Checking the details of the source document. The source document for this transaction is the bank withdrawal slip or bank statement, which confirms the date of the withdrawal, the amount withdrawn, $500, a reference to the transaction if necessary, e.g., owner's withdrawal. Always check the document to ensure the details are correct. Step 3. Determining the accounts involved. Now let's identify which accounts are affected by this transaction. Account 1. Drawings account. This account is used to record withdrawals made by the owner. It reduces the owner's equity in the business. Account 2. Bank account. This is an asset account because cash is being withdrawn and the cash balance decreases. Step 4. Deciding debit and credit. Next, determine which account to debit and which to credit. The drawings account is debited because drawings reduce the owner's equity, and a reduction in equity is recorded as a debit. The bank account is credited because the cash balance and asset is decreasing. A decrease in assets is recorded as a credit. So, we'll debit the drawings account and credit the bank account for $500. Step 5. Recording in the journal. Finally, record this transaction in the journal as follows. Date. Enter the date of the withdrawal. Accounts. Write the names of the accounts involved, drawings account and bank account. Amounts. Enter $500 as a debit to the drawings account and $500 as a credit to the bank account. Description. Add a brief explanation, such as owner withdrew cash for personal use. Thank you, students, for watching and staying with us throughout this lesson. Today, we worked through 10 very simple transactions, and we recorded them manually in the General Journal. Remember, one of the most important rules in accounting is that at the end of your work, your total debits must equal the total credits. This ensures your books are balanced and accurate. In the upcoming lessons, we're going to explore computerized accounting software like QuickBooks, Xero, and Sage. You'll see how these same transactions are recorded in modern systems, making the process faster and more efficient. But that's not all. We'll also move on to much more complicated transactions and learn how to record and post them into ledgers step by step. You're building strong foundations, and soon you'll be tackling advanced scenarios with confidence. See you in the next lesson. Until then, keep practicing, stay focused, and don't forget to like the video and subscribe to support us. Have a great day. Welcome to today's lesson. Hello, students. Welcome to today's lesson, where we'll take another exciting step in your accounting journey. Today, we'll explore recording business transactions in a computerized accounting system. But before we dive into the practical part, there's something critical we need to cover first. We'll be focusing on sections 1.3 and 1.4 from Chapter 3 of your FIA FA1 book by BPP. These sections hold essential concepts that provide the foundation for understanding computerized accounting systems. Whether you're preparing for your exams or setting yourself up for a successful accounting career, this knowledge is indispensable. Why this lesson is so important. Before you can record transactions in a computerized system, it's essential to understand. 1. Section 1.3. Key features of computerized accounting systems. Learn about the controls in place to ensure accuracy and security. Understand standing data, which includes key information about customers, suppliers, and transactions that stays consistent over time. Familiarize yourself with account codes, which make the process of organizing and posting transactions more efficient. 2. Understand why businesses rely on accurate record keeping to track sales, expenses, customer balances, and profits. Learn how these processes help businesses plan, monitor, and make informed decisions for short and long-term success. How this knowledge helps you. These sections aren't just theory, they're your roadmap to mastering computerized accounting systems. Once you understand the features and requirements, you'll see how they make recording transactions quicker, more accurate, and more secure. Additionally, these topics may appear in your exams, so be extra careful and take your time to really absorb this information. Revisit this lesson if needed. It's better to fully understand it now than to struggle later. What's next? Once we've covered these foundational concepts, we'll move on to the practical part, where we'll actually record transactions in a computerized accounting system. This will include working with software to apply what we've learned. So, let's get started with sections 1.3 and 1.4. Listen carefully and don't forget to take notes. This knowledge is key to your progress and future success in accounting. What is a computerized accounting system? A computerized accounting system is software designed to record, manage, and report a business's financial transactions and data digitally. Unlike manual bookkeeping, where entries are written down by hand, computerized systems use automation to streamline processes like recording journal entries, maintaining ledgers, generating reports, and ensuring compliance with accounting standards. These systems come in various forms, ranging from basic software for small businesses to complex ERP, enterprise resource planning systems for larger organizations. Core features of a computerized accounting system. 1. Automation. Automates repetitive tasks like posting to ledgers, calculating totals, and generating financial statements. 2. Accuracy. Reduces human errors, ensuring more precise recording of transactions. 3. Integration. Combines all financial data in one place, such as sales, purchases, payroll, and taxes. 4. Scalability. Grows with the business, allowing the addition of more modules and accounts as needed. 5. Real-time data. Provides instant updates, so financial reports can be generated at any time with the latest information. Efficiency of computerized accounting systems. One of the biggest advantages of a computerized accounting system is its efficiency. Let's break it down step by step to see how these systems save time, minimize errors, and improve overall productivity. 1. Faster data entry. Transactions only need to be entered once into the system. After that, the software automatically posts them to all relevant accounts, saving time compared to manually recording each transaction in multiple ledgers. Example: a sale recorded in the sales account will automatically update the accounts receivable and cash bank accounts without additional input. 2. Real-time reporting. Computerized systems generate financial statements instantly, giving businesses immediate insight into their financial position. This is especially useful for decision-making. Example: a manager can pull up a profit and loss statement or a cash flow report at any time without waiting for accountants to compile data manually. 3. Accuracy and error reduction. By using predefined account codes, the system ensures that transactions are posted to the correct accounts. Automated calculations eliminate errors in arithmetic. Example: if a transaction is recorded in the wrong account in a manual system, correcting the mistake involves a lot of work. In a computerized system, it's a simple matter of editing the entry. 4. Simplified reconciliation. Matching bank statements with accounting records, a process known as bank reconciliation, is much faster in computerized systems. Many software programs can even link directly to bank accounts for automatic reconciliation. Example: the software will flag discrepancies between the recorded transactions and the bank statement, saving time on manual checks. Integration across departments. Computerized accounting systems can integrate with other software like inventory management, payroll, or customer relationship management systems. This creates a unified workflow. Example: when an invoice is issued through the sales module, the system automatically updates the accounts receivable, inventory, and revenue accounts. 6. Scalability and customization. As a business grows, computerized systems allow for the addition of new accounts, departments, or even multiple business locations without reworking the system. Example: a growing retail chain can add accounts for each new store to its existing system without disrupting ongoing operations. 7. Improved compliance. Computerized systems are programmed to comply with accounting regulations, tax laws, and reporting requirements. This reduces the risk of fines and penalties. Example: the system can automatically calculate V8 GST or income tax and generate the necessary reports for submission. 8. Security and backup. Data is often encrypted and backed up regularly to prevent loss or theft. Access controls can restrict who can view or edit specific information. Example, only authorized personnel can access sensitive accounts like payroll or taxes, ensuring data confidentiality. 9. Audit trails. Every transaction is logged with details like who entered it, when it was entered, and any subsequent modifications. This ensures transparency and makes audits easier. Example, an auditor can trace a single transaction back to its source document with just a few clicks. 10. Cost efficiency in the long run. While setting up a computerized accounting system requires an initial investment, it saves money in the long term by reducing labor costs, minimizing errors, and improving productivity. Example, automating payroll processing can eliminate the need for additional staff to manually calculate salaries and taxes. Key features of computerized accounting systems. Based on Section 1.3 of your FIA FA1 book by BPP, here are the key features of computerized accounting systems. Today, we'll dive into each of these features in detail, one by one, to fully understand how they work and why they're important. 1. Controls. These ensure that all data is recorded accurately and processed as expected. Built-in controls automatically check for errors, prevent unauthorized access, and verify the validity of transactions. They ensure the system operates efficiently and the records remain reliable. 2. Standing data. This refers to data that doesn't change frequently, such as customer and supplier information, sales tax rates, or agreed payment terms. Once entered into the system, this data is reused for transactions and only updated when necessary. It eliminates repetitive data entry and reduces the risk of errors. 3. Account codes. Every account in the general ledger is assigned a unique code to make categorization and posting of transactions efficient. These codes simplify identifying accounts like sales, rent expenses, or supplier payments. Account codes are particularly helpful for tracking transactions and ensuring accuracy in reports. Understanding these features will give you a strong foundation in using computerized accounting systems. Let's now move into each feature step by step. Controls in computerized accounting systems. When it comes to computerized accounting systems, controls are an essential feature. Controls are mechanisms, processes, or checks built into the system to ensure that all the data entered is accurate, complete, and secure. These controls are like security guards for your accounting records. They make sure everything works as intended and prevent errors, fraud, or misuse. Let's break this down step by step. What are controls? Controls are built-in features within the accounting software that monitor, check, and restrict how data is entered and processed. These controls protect the system in several ways. 1. Accuracy. Ensures that data entered is correct. 2. Completeness. Makes sure no transaction or information is missing. 3. Authorization. Restricts access to sensitive areas of the system, so only authorized users can make changes. 4. Consistency. Makes sure that all data follows predefined rules or formats. Types of controls in computerized accounting systems. 1. Input controls. Input controls ensure that the information being entered into the system is correct and in the proper format. They are designed to minimize human errors during data entry. Examples: mandatory fields. Certain fields, such as the transaction date or invoice number, cannot be left blank. This prevents incomplete records. Validation rules. If you try to enter text into a numeric field, e.g. a dollar amount, the system will display an error message. Drop-down menus. Instead of typing out customer names, you might choose from a drop-down menu. This reduces spelling mistakes or mismatches. Duplicate entry checks. The system alerts you if you accidentally try to enter the same invoice twice. Scenario. Imagine you're entering a sales invoice for Neelam Sultan's florist business. The system checks that the date is valid, e.g., December 32 is flagged as invalid. The total invoice amount matches the sum of individual items listed. The customer name is selected from an existing list to avoid creating duplicate customer records. 2. Processing controls. These controls ensure that data entered into the system is processed correctly and doesn't get corrupted during calculations or postings. Examples. Automatic calculations. For example, if you enter the quantity and price of an item, the system automatically calculates the total amount, e.g., 10 items at $5 each equals $50. Batch totals. If multiple transactions are entered at once, the system checks that the sum of the totals entered matches the sum of the processed transactions. Audit trails. Every change made to a transaction is recorded, showing who made the change, what was changed, and when it was changed. Scenario. If Neelam records 5 invoices totaling $1,000, the system compares the entered total with the calculated total. If they don't match, it flags the error. 3. Access controls. Access controls ensure that only authorized users can access certain parts of the accounting system. This is especially important for sensitive financial information. Examples. Role-based permissions. A sales clerk may only be allowed to create sales invoices, while the accountant has access to the bank reconciliation module. Password protection. Each user needs a secure password to log into the system. Approval levels. High-value transactions may require manager approval before being processed. Scenario. In Neelam's business, the cashier can enter daily sales transactions, but only Neelam herself can approve payments to suppliers or view profit reports. 4. Output controls. These ensure that the reports and summaries generated by the system are accurate and complete. They check that the information presented is reliable for decision-making. Examples. Reconciliation reports. The system generates a report to compare recorded cash with actual bank balances. Error logs. If something goes wrong, e.g. a missing data field, the system flags it in an error log for review. Summary reports. These reports are reviewed to confirm that totals match across different sections of the accounts. Scenario. When Neelam runs a report to see her monthly sales, the system ensures that all transactions recorded for the month are included and nothing is left out. 5. Preventive controls. These controls stop mistakes or fraud before they happen. Examples. Preset spending limits. The system may prevent a payment that exceeds a certain amount without special authorization. Segregation of duties. A user who enters invoices cannot also approve payments for those invoices. Locked periods. Once a month's accounts are closed, the system prevents further changes to those records. Scenario. If Neelam tries to process a payment for a supplier that exceeds her company's spending limit, the system blocks the payment and sends a request for her approval. 6. Detective controls. Detective controls identify errors or issues after they've occurred so they can be corrected. Examples. Bank reconciliation. Compares the bank statement with recorded transactions to spot discrepancies. Exception reports. Highlights unusual activities, such as unusually large discounts given to customers. Trial balances. Detects when total debits don't match total credits. Scenario. Neelam's accountant notices that the trial balance for December is off by $50. The system highlights this discrepancy, prompting the accountant to review the journal entries. Why are controls important? Accuracy. They ensure the financial records are correct and free of errors. Security. They protect sensitive financial data from unauthorized access. Compliance. They help businesses follow accounting laws and standards. Efficiency. They reduce the time spent fixing mistakes and streamlining processes. Fraud prevention. They prevent dishonest employees from tampering with the records. Real-life example of controls in action. Imagine Neelam Sultan has hired an employee to handle daily sales transactions. Without controls, the employee could 1. Enter incorrect sales amounts, leading to inaccurate financial reports. 2. Process unauthorized refunds to themselves or friends. 3. Forget to record some sales entirely. However, with controls in place, the system validates all sales entries and ensures they match inventory records. Any refund requires Nilam's approval. All transactions are time-stamped and recorded in an audit trail. This way, Nilam can confidently manage her business, knowing the system is protecting her financial records. Conclusion. Controls are the backbone of any computerized accounting system. They ensure that transactions are handled accurately, securely, and efficiently. By preventing errors, fraud, and misuse, controls help businesses like Nilam Sultan's florist shop focus on growth without worrying about financial inaccuracies. Remember, good controls mean good business. Understanding standing data in computerized accounting systems. Standing data refers to the essential information stored within a computerized accounting system that does not change frequently. Think of standing data as the static information that forms the backbone of the accounting system. It's always there and is only updated occasionally. This data helps automate transactions and ensures accuracy and consistency in the system. Let's break it down step by step and look at examples to make it clear and relatable. What is standing data? Standing data is the core information about the business, its customers, suppliers, and products, which is entered into the system when the software is set up or when there are updates, like adding a new supplier or customer. This data is not part of day-to-day transactions, but it provides the foundation for those transactions to be recorded accurately. Types of standing data. 1. Customer information. Details about the business customers are stored in the system, allowing quick and accurate invoicing, credit tracking, and customer relationship management. Examples: customer name, Green Garden Supplies; address, 123 Floral Street, Springfield; contact details, email and phone number; credit terms, payment due in 30 days; sales tax registration number if applicable; agreed discounts, 5% off for orders above $1,000. Scenario: when Nilam Sultan sells flowers to Green Garden Supplies, her system automatically fills in the customer's details, such as their name, address, and payment terms, ensuring she doesn't have to re-enter this data for every sale. 2. Supplier information. Information about suppliers is recorded to streamline purchasing and payment processes. Examples: supplier name, Bloom Wholesale Distributors; address, 45 Plant Avenue, downtown; contact details, phone number and email; bank account details, for processing payments; agreed terms, payment due in 60 days. Scenario: when Nilam orders floral supplies from Bloom Wholesale Distributors, her system uses the stored standing data to ensure the supplier's address is printed on the purchase order and payment terms are followed. 3. Inventory or product information. Details about the products or services that the business sells or purchases are stored. Examples: product name, Rose Bouquets; product code, RB001; unit price, $25 per bouquet; description: freshly arranged roses in decorative wrapping; reorder level: notify when stock falls below 20 bouquets. Scenario: when Nilam creates a sales invoice for Rose Bouquets, the system automatically retrieves the product code and price, ensuring the invoice is accurate and no manual entry mistakes occur. 4. Tax rates and rules. The system stores information about applicable taxes, such as sales tax or value-added tax, VAT. Examples: sales tax rate, 10%. Exempt customers or products, educational institutions are exempt from sales tax. Scenario: when Nilam sells flowers to a school, the system knows to exclude sales tax based on the stored standing data about tax exemptions. 5. Employee information. In businesses with payroll processing, employee details may also be part of the standing data. Examples: employee name, Sarah Flores; job title, delivery driver; hourly rate, $15 per hour; bank account details, for salary payments, Tax codes for payroll deductions. Scenario: when processing payroll, the system uses the stored hourly rate and tax code to calculate Sarah's salary and deductions accurately. 6. Business-specific information. Details about the business itself are stored and used in documents like invoices, purchase orders, and financial reports. Examples: business name, Sultan's Florist. Address, 10 Bloom Lane, Springfield. Business registration number. Bank account details for receiving payments. Logo, included on all printed invoices. Scenario: when Neelam sends out an invoice, the system automatically includes her business name, address, and logo without needing manual input each time. Why is standing data important? 1. Saves time. Since standing data is stored in the system, it eliminates the need to re-enter the same information repeatedly. For example, customer details are automatically filled in when creating a sales invoice. 2. Ensures accuracy. By using pre-entered data, errors are minimized. For example, if Neelam's supplier's bank details are stored, she won't accidentally send a payment to the wrong account. 3. Improves efficiency. Automating processes like generating invoices, purchase orders, or payroll reduces workload and allows businesses to focus on other tasks. 4. Consistency across transactions. Standing data ensures that customer names, product codes, and tax rates are consistent across all transactions. This reduces confusion and improves professional reporting. How is standing data used? Sales transactions. When a sale is made, the system pulls customer details, product descriptions, and tax rates from standing data to create an accurate invoice. Purchase orders. When buying supplies, the system uses supplier details and inventory information to generate purchase orders quickly. Payroll processing. Employee details stored as standing data are used to calculate salaries and deductions. When does standing data need updates? Standing data is generally static, but may require updates under the following circumstances. 1. Customer or supplier changes. A customer moves to a new address, or a supplier changes their payment terms. 2. Price updates. The price of a product increases or decreases. 3. Tax changes. The government announces a new tax rate. 4. New employees or products. A new hire joins the team, or a new product is added to the inventory. Example of standing data in action. Let's say Neelam Sultan receives a phone order for 50 rose bouquets from Green Garden Supplies. 1. Neelam opens her accounting system and creates a new sales invoice. 2. The system automatically fills in Green Garden Supplies address and payment terms, the price and product code for rose bouquets, the applicable sales tax rate. 3. Neelam only has to confirm the quantity, 50, and the system calculates the total amount due. This process takes just a few clicks, thanks to the stored standing data. Conclusion. Standing data is like the foundation of a well-built house. It ensures the system runs smoothly, accurately, and efficiently. While it doesn't change often, it plays a crucial role in automating transactions and maintaining consistency. By keeping standing data updated and accurate, businesses like Neelam Sultan's Florist Shop can save time, avoid errors, and focus on what matters most, serving their customers and growing their business. Understanding the chart of accounts and account codes. Before we learn about account codes, let's first talk about the chart of accounts. These two things are closely connected and form the foundation of any accounting system. What is a chart of accounts? A chart of accounts, COA, is like a detailed list of all the accounts a business uses to record its financial transactions. Think of it as a directory or filing system that organizes every transaction into categories like income, expenses, assets, liabilities, or equity. The purpose of the chart of accounts is simple: to make sure every financial transaction is recorded in the right place, to help the business easily track and report its financial health. Example of a chart of accounts: assets, cash, inventory, equipment; Liabilities, loans payable, accounts payable. Income, sales revenue, service revenue. Expenses, rent, salaries, utilities. Each account in the chart of accounts is given a unique identifier or number, which is where account codes come in. What are account codes? Account codes are special numbers or letters assigned to each account in the chart of accounts. They act like short names for the accounts, making it quicker and easier to record financial transactions. Think of account codes as labels that help you direct transactions to the correct place in the accounting system. Example, instead of writing cash account, you could just use the code 1010. For rent expense, you might use the code 5010. Why are account codes important? Account codes are very helpful because they, 1, keep things accurate. They make sure transactions go to the right account. 2, save time. Instead of typing the full account name, you just enter the code. 3, help computers work better. Accounting software relies on codes to sort and organize transactions automatically. How do account codes work? Businesses often use a numbering system to organize account codes. Accounts are grouped into categories, and each category is given a range of numbers. Example of account code ranges. Assets, 1,000 to 1,999. Liabilities, 2,000 to 2,999. Equity, 3,000 to 3,999. Income, 4,000 to 4,999. Expenses, 5,000 to 5,999. Within these ranges, each specific account is given a unique code. Example of specific account codes. Cash account, 1010. Accounts receivable, 1020. Sales revenue, 4010. Rent expense, 5010. How are account codes assigned? Step 1. Decide the category first. Figure out if the account is an asset, liability, income, expense, or equity. For example, cash is an asset and rent is an expense. Step 2. Pick a number range. Next, choose a number within the range for that category. For example, assets might start at 1,000, so cash could be 1010. Expenses might start at 5,000, so rent could be 5010. Step 3. Make sure the code is unique. Every account needs its own unique code. For example, cash account might be 1010. Accounts receivable might be 1020. Why use account codes? 1. Speeds up data entry. Instead of typing rent expense each time, you just type 5010. 2. Prevents mistakes. Each account has its own unique code, so there's less chance of putting a transaction in the wrong place. 3. Makes reporting easier. When accounts are organized by codes, it's simple to group similar transactions for reports. For example, all income accounts, 4,000 to 4,999, can be grouped together in one report. Examples of account codes in action. Example 1. Recording a sale. Let's say a florist sells flowers for $500. The transaction would involve sales revenue account, code 4010. This is credited because income has increased. Cash account, code 1010. This is debited because cash has increased. Example 2, paying rent. The florist pays $1,000 for rent. The transaction would involve rent expense account, code 5010. This is debited because expenses have increased. Cash account, code 1010. This is credited because cash has decreased. Accessing computerized accounting systems. Accessing a computerized accounting system depends on how the software is set up and deployed within an organization. Broadly speaking, there are two main ways businesses access such systems: locally installed software or cloud-based solutions. Each method has its own features, advantages, and limitations. Let's go through both approaches in detail. 1. Locally installed software. In this setup, the accounting software is installed directly on the computers or servers within the company's premises. This means the system operates entirely offline unless the company adds network connectivity for data sharing. How it works. Installation. The software is purchased and physically installed on the computers of the accounting team or company servers. Access. Employees access the software through local drives or via a network within the company. Storage. All financial data is stored on the company's computers or servers. Advantages of locally installed systems. 1. Control. The business has full control over its financial data since everything is stored in-house. This is especially important for companies with strict data privacy policies. 2. Security. Because the data isn't stored online, it's not exposed to potential internet-based threats like hacking or breaches. 3. Offline access. Users can work even when there is no internet connection, ensuring uninterrupted operations. Example. Imagine a mid-sized retail company that uses locally installed accounting software. The company has its accounting department access the software through its internal network. Only authorized staff can log in, and all data is stored securely on the company's own servers. Challenges. 1. Maintenance. The business is responsible for maintaining the software, updating it, and ensuring that backups are made. 2. Cost. Initial costs can be high since the business must purchase the software license and potentially invest in dedicated servers. 3. Limited access. Employees can only access the software from devices connected to the company's network. Cloud-based accounting systems. Cloud-based systems, often referred to as cloud accounting, operate differently. Here, the accounting software and all the data are hosted on remote servers managed by a service provider. Users access the system via the internet, similar to logging into an email account. How it works. Hosting. The software and data are stored on the service provider's servers. Access. Users log in using a web browser or dedicated application on their devices. Connectivity. An internet connection is required to use the software and access data. Advantages of cloud-based systems. 1. Remote access. Users can access the system from anywhere with an internet connection, making it ideal for businesses with remote teams or multiple locations. 2. Automatic updates. The software provider manages all updates, ensuring that users always have access to the latest features and security measures. 3. Data backup. Data is automatically backed up on the provider's servers, reducing the risk of data loss due to hardware failures or natural disasters. 4. Scalability. Cloud systems can easily grow with the business, allowing companies to add more users or modules as needed. Example. Imagine a startup company that uses a cloud-based accounting software like QuickBooks Online. The owner, working from home, can access the system to check financial reports, while the accountant, working in the office, can simultaneously input transactions, all in real time. Challenges. 1. Dependence on internet. If the internet connection is slow or unavailable, users may face difficulties accessing the system. 2. Data privacy concerns. Some businesses worry about storing sensitive financial information on external servers. 3. Subscription costs. Cloud-based systems often operate on a subscription model, which may become expensive over time. Key differences between locally installed and cloud-based accounting systems. This chart highlights the main differences between locally installed systems, software installed directly on company computers, and cloud-based systems, software accessed via the internet. Let's go over each aspect step by step. 1. Access. Locally installed, access is limited to the company network. This means you can only use the software when you're physically connected to the company's computers or internal network. Cloud-based, the system can be accessed from anywhere as long as you have an internet connection. This makes it ideal for remote work or accessing data on the go. 2. Data storage. Locally installed. All data is stored on the company's own servers or computers. This gives the business full control over its information. Cloud-based. Data is stored on the servers of the service provider, often located in remote data centers. The business depends on the provider for secure storage. 3. Cost. Locally installed. These systems generally have a high upfront cost because the business must purchase licenses, hardware, and infrastructure. However, ongoing costs tend to be lower since there are no recurring subscription fees. Cloud-based. These systems typically have lower initial costs because they operate on a subscription model. However, the business will need to pay recurring subscription fees, which can add up over time. 4. Maintenance. Locally installed. The company is responsible for handling all updates, backups, and hardware maintenance. This requires technical expertise and time. Cloud-based. The service provider takes care of all updates, backups, and system maintenance, saving the business time and effort. 5. Security. Locally installed. Security is fully controlled by the business. The company is responsible for implementing and maintaining firewalls, encryption, and other protective measures. Cloud-based. Security is managed by the service provider. While most providers have robust security protocols, the business must trust the provider to protect its data. Why is this important? Understanding how computerized accounting systems are accessed helps businesses choose the right system for their needs. For example, a small business with a tight budget may prefer a cloud-based solution because of its low upfront costs. A large corporation with high data security needs might opt for locally installed software to maintain full control over its data. Conclusion. Both locally installed and cloud-based accounting systems have their unique strengths. Modern businesses often prefer cloud-based systems for their flexibility and ease of use. However, for companies prioritizing control and offline functionality, locally installed systems remain a viable option. Regardless of the choice, both systems aim to streamline accounting processes, reduce manual effort, and provide real-time insights into a company's financial health. Business requirements in accounting. In accounting, every business needs to maintain accurate and up-to-date records to stay on top of its financial situation. These records don't just fulfill legal or regulatory requirements. They also provide vital information that helps a business operate efficiently, make informed decisions, and plan for the future. Let's break this down into simpler terms and explain why accurate record keeping, summarizing, and posting transactions are essential for meeting a business's requirements. What information does a business need? Here are the key types of information businesses rely on. 1. Sales of goods and services by volume and value. A business must know how much it has sold, both in terms of quantity, volume, and money earned, value. Example, if a store sells 100 chairs in a month at $50 each, it needs to track both the 100 units sold, volume, and the $5,000 earned, value. This information is crucial for assessing performance, planning inventory, and setting sales targets. 2. Expenditure incurred. This refers to all the money a business spends, whether it's on rent, salaries, raw materials, or utilities. Example, a bakery spends $1,000 on flour and sugar this month. Knowing this helps the business see where its money is going and control costs. Tracking expenses ensures the business doesn't overspend and maintains profitability. 3. Amounts owed by customers. When a business sells goods or services on credit, it needs to know how much money is owed by its customers. Trade receivables. Example, a car dealership sells a car for $20,000, but allows the buyer to pay in installments. The business needs to track how much the customer still owes. Without this, businesses might forget to collect payments or run into cash flow problems. 4. Amounts due to suppliers. On the flip side, businesses often buy goods or services on credit and owe money to their suppliers. Trade payables. Example: a clothing store orders $5,000 worth of stock but agrees to pay the supplier after 30 days. The business needs to record and monitor this liability. Keeping track of payables ensures the business doesn't miss payment deadlines and maintains good relationships with suppliers. 5. Cash and bank balances. Every business needs to know how much cash it has on hand and in its bank accounts at any given time. Example: a business may have $2,000 in cash and $10,000 in its bank account. This information helps with daily operations and ensures the business has enough funds to cover expenses. Monitoring cash flow is crucial for avoiding overdrafts or running out of money. 6. Profits and/or losses made over a period. Ultimately, a business needs to know whether it is making money, profit, or losing money, loss over a specific time, such as a month or a year. Example: if a business earns $50,000 in sales but spends $40,000 on costs, it has a profit of $10,000. If the costs exceed sales, it's operating at a loss. Profit and loss information guides long-term decisions, like whether to expand, cut costs, or raise prices. Why is this information important? When all this information is put together, it helps the business. 1. Plan for the future. Businesses can forecast how much they'll earn or spend in the coming months and prepare accordingly. For example, if sales are expected to increase, they might order more stock or hire more staff. 2. Monitor performance. By reviewing sales, expenses, and profit figures, businesses can see what's working and what isn't. If expenses are too high, they can look for ways to cut costs. If sales are low, they might adjust their pricing or marketing strategy. 3. Make informed decisions. Financial data helps businesses decide things like whether to take out a loan, invest in new equipment, or open a new location. For instance, knowing how much cash is available might help a business decide whether it can afford to buy a new delivery van. 4. Ensure long-term success. Accurate records help businesses avoid financial problems, like overspending or forgetting to collect money owed by customers. This strengthens their financial health and keeps them competitive. In simple terms, accurate record keeping is like keeping a personal diary for the business's money, where it comes from, where it goes, and how much is left. This financial diary ensures the business operates smoothly and makes smart decisions for both the short term and the long term. By the end of this chapter, you'll understand how to record, summarize, and use this information effectively to meet these essential business requirements. Thank you, students, for joining today's lesson. We hope you found it informative and engaging. If you enjoyed the session or found it helpful, please take a moment to like the video and subscribe to the channel to stay updated on future lessons. Your support means a lot and helps us continue bringing you valuable content. See you in the next lesson. Until then, take care and keep learning. Welcome, students, to today's lesson. Today, we are diving into an important topic: the general ledger, posting, and the format of a ledger account. This is a critical part of the accounting process, and understanding it will give you the foundation to track financial transactions and prepare financial reports effectively. Before we begin, please open your books to Chapter 3 and turn to the section on the general ledger. This is where we'll be starting today. Make sure you follow along closely, as we'll be covering 1. What the general ledger is and why it's important. 2. How transactions are posted to the ledger. 3. The proper format of a ledger account and how to use it. Take your time as we go through this step by step. Grab your notebooks for examples and don't hesitate to jot down questions for the discussion at the end. Let's get started. When you begin studying accounting, One of the key terms you will encounter is the general ledger. Let's break it down in simple terms so it's easy to understand. What is the general ledger? The general ledger is the heart of a business's accounting system. It's like a giant database that contains all the financial information about a business. This includes details about the business's assets, liabilities, capital, income, and expenses. Every financial transaction that the business undertakes is recorded in the general ledger through individual accounts called ledger accounts. Each ledger account is created for a specific type of transaction or activity. For example, one account might track cash transactions, cash account. Another might record sales revenue, sales account. A separate account would track rent expenses, rent account. Every account has a unique purpose or name, and in computerized systems, it also gets an identity or code to make it easy to manage. Where did the term ledger come from? The term ledger dates back to the days when businesses recorded their financial transactions manually in large physical books called ledgers. Each page was reserved for a specific account, and accountants would write entries in them by hand. Although accounting is now computerized, the term ledger is still used. But instead of physical books, all transactions are recorded electronically using accounting software. Why is the general ledger important? The general ledger is crucial because it organizes and summarizes all financial activity of a business in one place. Without it, a business wouldn't be able to understand its financial position. How much cash does the business have? How much does it owe to suppliers? How much profit has it made? 2. Prepare financial statements. Information from the general ledger is used to create key financial reports like the balance sheet, income statement, and cash flow statement. 3. Keep track of transactions. Every dollar that comes in or goes out is logged in the general ledger, ensuring no detail is overlooked. How does the general ledger work? The general ledger follows the double entry bookkeeping principle. For every transaction, there are always 2 entries, a debit in one account, a credit in another account. This ensures that the accounting equation, assets equals liabilities plus equity, always stays in balance. For example, if the business sells goods for cash, the cash account increases, a debit, and the sales account also increases, a credit. If the business pays rent, the rent expense account increases, a debit, while the cash account decreases, a credit. What does the general ledger include? The general ledger is made up of many different ledger accounts, each tracking a specific type of financial activity. These accounts are grouped into 5 main categories. 1. Assets. Things the business owns, like cash, inventory, buildings, or equipment. Example, cash, accounts receivable, machinery. 2. Liabilities. Money the business owes to others, like loans or unpaid bills. Example, accounts payable, bank loan. 3. Equity. The owner's interest in the business. Example, owner's capital, retained earnings. 4. Income. Money the business earns from selling goods or services. Example, sales revenue, service revenue. 5. Expenses. Costs the business incurs to run its operations. Example, rent, utilities, wages. How is the general ledger used in computerized systems? In a computerized accounting system, the general ledger acts as the foundation for recording all transactions. Instead of writing transactions in books, businesses input the details of a transaction into accounting software, which automatically updates the correct ledger accounts. For instance, if a business buys office supplies for $50, the software will update the office supplies expense account, a debit, and the cash account, a credit, in the general ledger. This makes the process more efficient, accurate, and less time-consuming compared to manual bookkeeping. In simple terms, you can think of the general ledger as the big picture of a business's financial world. It organizes and categorizes every dollar the business spends, earns, borrows, or owns. Whether it's paying rent, receiving money from customers, or buying inventory, the general ledger ensures everything is properly recorded. By mastering how the general ledger works, you'll have a solid foundation for understanding accounting and preparing financial statements. It's a skill every accountant needs to succeed. What is posting in accounting? Posting is an essential step in accounting where transactions are transferred or posted from the journal to the ledger accounts in the general ledger. Think of the journal as the place where transactions are first recorded in detail, and the ledger as the summary of those transactions organized into specific accounts. For example, if a business pays for rent, the transaction will first be recorded in the journal. The same transaction is then posted to the rent and rates account in the ledger. Why is posting important? Posting ensures that all financial information is properly categorized so the business can understand its financial position. By posting transactions to the general ledger, a business can 1. Summarize its financial data into specific categories, e.g. expenses, income, assets. 2. Prepare financial reports like the income statement or balance sheet. 3. Track the balances of individual accounts to see how much the business owes, owns, or earns. Understanding the chart in the attachment. The chart in the attachment lists examples of ledger accounts that you might find in a business's general ledger. Each account is categorized based on the type of financial information it represents. Non-current assets. Long-term assets like machinery and motor vehicles. Current assets. Short-term assets like cash and inventory that are expected to be used or converted into cash within a year. Current liabilities. Short-term obligations like accounts payable or overdrafts. Non-current liabilities. Long-term obligations like loans that won't be fully paid within the year. Capital. The owner's investment in the business. Expenses. Costs the business incurs to operate like wages, rent, or advertising. Income. Money the business earns from its activities, such as sales revenue. Let's go through each account listed in the chart and explain which category it belongs to. Non-current assets. Long-term assets. 1. Plant and machinery at cost. Refers to equipment or machinery the business owns and uses for a long time. Recorded as a non-current asset because it provides value over several years. 2. Motor vehicles at cost. Refers to cars, vans, or trucks purchased by the business. Also a non-current asset for the same reason as machinery. Capital. Owner's equity. Proprietor's capital. The money or assets the owner invests in the business. Classified under capital because it represents the owner's interest in the business. Current assets. Short-term assets. 4. Inventory. Raw materials. Refers to materials the business uses to create its products. A current asset because raw materials are converted into goods and sold within the year. 5. Inventory. Finished goods. Completed products ready for sale. A current asset for the same reason as raw materials. 6. Trade receivables. Money owed to the business by customers who bought goods or services on credit. A current asset because it's expected to be collected within a year. Current liabilities, short-term obligations. 7. Trade payables. Money the business owes to suppliers for goods or services bought on credit. Classified as a current liability because it's usually paid within a short period. Expenses, costs to run the business. 8. Wages and salaries. Payments made to employees for their work. An expense because it's part of the business's operating costs. 9. Rent and rates, costs for renting office or shop space and paying local property taxes. Also an expense related to the business's daily operations. 10. Advertising expenses, money spent on promoting the business to attract customers, another example of an expense. 11. Bank charges, fees paid to the bank for account services like processing transactions or overdrafts, classified as an expense. 12. Motor expenses, costs for running business vehicles like fuel or repairs, recorded as an expense. 13. Telephone expenses, costs for phone services used in the business. Revenue from sales or services. 14. Sales, revenue earned from selling goods or services, recorded under income because it increases the business's earnings. Cash refers to physical money or money in the business's bank account. A current asset because it's immediately available for use. 16. Bank overdraft, when the business withdraws more money from its bank account than it has available. A current liability because the business must repay the bank soon. 17. Bank loan, money borrowed from a bank that is repaid over time. Classified as a non-current liability if repayment extends beyond 1 year. In summary, posting means transferring transactions from the journal to the ledger. The chart categorizes each type of ledger account, helping us understand where specific transactions should be recorded. Knowing the difference between assets, liabilities, income, expenses, and capital ensures accurate bookkeeping. By mastering these concepts, you'll be ready to record and summarize transactions properly in the general ledger. The format of a ledger account can be thought of as resembling the shape of the letter T, which is why it is sometimes referred to as a T account. This structure is used to record financial transactions systematically, with clear divisions for debits and credits. Let's break down the format step by step using the example provided in the image. Key elements of the ledger account format. 1. Name of the account. At the very top of the ledger, you'll find the top name of the account. This specifies which account the ledger belongs to. For instance, in the example, the account is titled Advertising Expenses. Every transaction recorded in this account will relate to advertising expenses only. 2. Two sides of the account. The ledger account is split into two sides. Left-hand side, debit side. This side is used to record debit entries related to the account. Right-hand side, credit side. This side is used to record credit entries related to the account. Each transaction will be entered on either the debit or credit side, depending on its nature, as per the rules of double-entry bookkeeping. 3. Columns for each entry. Each side of the account, debit and credit, has specific columns to organize the transaction details. Date column. This shows the date of the transaction. For example, in the image, the date is recorded as 15 April. Narrative column. This provides a short description of the transaction, explaining what it relates to. For example, in the image, the description says JFK Agency for quarter to 31st of March. Reference column. This records a reference number or code linking the transaction back to its source document, like an invoice or receipt. For example, the reference is PL 348. Amount column. This shows the monetary value of the transaction. For instance, the amount of $2,500 is recorded on the debit side. Summary of the ledger account format. At the top, write the name of the account, e.g., advertising expenses. The left-hand side is the debit side, and the right-hand side is the credit side. Each side has clear columns for date, to record when the transaction occurred. Narrative, a brief description of the transaction. Reference, linking to supporting documents. Amount, the monetary value being recorded. This format ensures transactions are properly organized and easy to reference when preparing financial reports. Understanding this format is essential because it is the foundation for recording transactions into the general ledger, whether manually or using a computerized accounting system. Students, we have already discussed many of these fundamental concepts in chapters 1 and 2, such as assets, liabilities, income, expenses, and the principles of double entry bookkeeping. If you need a refresher or want to revisit those topics, please check out the links provided in the description below. This will help you connect the dots as we dive deeper into today's lesson. Thank you, students, for watching today's lesson. We've covered some essential concepts about the general ledger, posting, and the format of a ledger account. I hope it's now much clearer how these pieces come together in the accounting process. In our next lesson, we're going to take things a step further and see how transactions are practically posted to the general ledger. This will give you hands-on insight into how the system works in real-life scenarios. Make sure you're ready, because this will be an exciting step in your journey to mastering accounting. Don't forget to like the video, subscribe to the channel, and share it with others who might benefit. See you in the next lesson, and have a great day ahead. All right, class, let's dive into a real-world example to get our hands dirty with some accounting. Today, we're looking at a small business called B&B Repair Services Ltd. This is a repair company that's been around for a while, and it's our job to help them keep their books in order. Now, I want you to imagine that it's the last day of July 31st, 2018, to be exact. At this point in time, the business has recorded all its balances in the accounts. Here's the list of accounts and their amounts. Listen closely as I read them aloud and try to picture what each account represents. July 31st, 2018, account balances. Accounts payable, $2,300. Accounts receivable, $3,200. Accumulated depreciation on equipment, $2,000. Accumulated depreciation on vehicles, $5,000. Bank loan payable, non-current, $4,000. Cash, $8,040. Common shares, $14,000. Equipment, $10,000. Retained earnings, $17,290. Salaries payable, $1,420. Supplies, $1,030. Unearned revenue, $1,260. Vehicles, $25,000. These numbers give us a snapshot of where the business stands financially at the end of July. You can see we've got a mix of assets like cash, vehicles, and equipment, along with liabilities such as accounts payable, unearned revenue, and a bank loan payable. And of course, we also see equity items like retained earnings and common shares, which show the owner's investment and profits kept in the business. Now let's fast forward to August. B&B Repair Services had a busy month, and we're going to review everything that happened. I'll read through the transactions one by one, so pay close attention. Each event affects the business's financial position, and it'll be your job to figure out how to record it in the company's books. Let's go. August transactions. 1. On August 1st, the company paid $250 for advertising on Kijiji. This was for the current month's advertising expenses. 2. On August 2nd, they provided $1,260 worth of services to customers. Now, here's the key. These services had already been paid for in July as part of unearned revenue. That means we're recognizing the revenue this month. 3. On August 3rd, they paid $980 for the office rent for August. 4. On August 6th, the company received $1,200 in cash from customers. This was payment for amounts they owed from earlier transactions. 5. On August 7th, they signed a contract with Merithew's Appliances Ltd. To provide future repair services for its customers. Now, no money changed hands for this one. It's just an agreement for the future. 6. On August 10th, the company paid employees $3,120 in salaries. Let's break this down. $1,700 was for August salaries, and $1,420 was the amount they owed for July salaries. 7. On August 13th, they received $2,800 in cash for repair services they performed during August. 8. On August 15th, they purchased new equipment worth $2,000. Instead of paying cash, they financed the purchase with a bank loan. 9. On August 20th, they paid $2,000 to their creditors for amounts they owed on accounts payable. 10. On August 22nd, the company purchased $800 worth of supplies on account. That means they didn't pay cash right away. They'll owe this money in the future. 11. On August 24th, they paid employees again, this time $2,900 in salaries. 12. On August 27th, the company billed customers $3,760 for services they performed in August. Notice they haven't received the cash yet. It's just been invoiced. 13. On August 29th, they received $780 in cash from a customer for services they'll perform in the future. This is unearned revenue because the work hasn't been done yet. 14. On August 30th, they made a payment of $500 on the bank loan and also paid $50 in interest. 15. Finally, on August 31st, they paid $380 in income taxes. On the same day, they declared and paid $400 in dividends to their shareholders. That's quite the list, isn't it? But don't worry, we're going to take this step by step. Here's what we're going to do. 1. First, we'll journalize each transaction. That means we'll record them in the general journal using the proper format, debits and credits. 2. Then, we'll post those entries to the general ledger. This involves updating the account balances based on the opening balances we saw from July 31st. As we work through this, I'll guide you to think about the key questions. What accounts are affected? Are they increasing or decreasing? And is it a debit or a credit? By the end of this exercise, you'll have a much clearer understanding of how we keep track of a business's financial activities. Are you ready to get started? Any questions before we dive in? All right, everyone. Let's walk through the transactions for the first 10 days of August. Remember, we're going to apply our three-step process. 1. Step 1. What happened? Identify the transaction. 2. Step 2. Which accounts are affected? Determine what accounts are involved and whether they increase or decrease. 3. Step 3. How do we record it in the journal? We'll decide which accounts are debited, which are credited, and include the amounts. Let's get started. August 1st, paying for advertising. Step 1. What happened? The company paid $250 for advertising on Kijiji to promote their services for the month of August. Step 2. Which accounts are affected? Advertising expense increases because the business is incurring this cost. Cash decreases because the company paid this amount. Step 3. How do we record it? To record this, we debit advertising expense for $250 to show the increase in expenses. Credit cash for $250 to reflect the decrease in money. The narrative for this entry is paid for advertisement expense. August 2nd, recognizing revenue from unearned revenue. Step 1. What happened? The company performed $1,260 worth of repair services for customers who had already paid in July. This amount was initially recorded as unearned revenue because the service wasn't performed at that time. Step 2. Which accounts are affected? Unearned revenue decreases because the company has fulfilled its obligation. Service revenue increases because the company has now earned this income. Step 3. How do we record it? To record this, we debit unearned revenue for $1,260 to show the decrease in this liability. Credit service revenue for $1,260 to record the income earned. The narrative for this entry is Earned revenue from services previously paid in advance. August 3rd, paying rent. Step 1. What happened? The company paid $980 for rent for the month of August. Step 2. Which accounts are affected? Rent expense increases because rent is a recurring cost of operating the business. Cash decreases because the company paid this amount. Step 3. How do we record it? To record this, we debit rent expense for $980 to reflect the increase in operating expenses. Credit cash for $980 to show the decrease in money. The narrative for this entry is paid monthly rent for August. August 6th, receiving payment from customers. Step 1. What happened? The company received $1,200 in cash from customers. This payment was for amounts owed from previous transactions recorded earlier as accounts receivable. Step 2. Which accounts are affected? Cash increases because the company is receiving money. Accounts receivable decreases because the customers no longer owe this amount. Step 3. How do we record it? To record this, we debit cash for $1,200 to show the increase in money received. Credit accounts receivable for $1,200 to reflect the reduction in what's owed to the company. The narrative for this entry is received cash from customers for outstanding balances. August 7th, signing a contract. Step 1. What happened? The company signed a contract with Matthews Appliances Limited to provide future repair services as needed. No money was exchanged and no services have been performed yet. Step 2. Which accounts are affected? None. This is not a financial transaction yet. Since no money or services have changed hands, no accounts are impacted. Step 3. How do we record it? There's no entry to record for this. The narrative for this entry is no entry. Signed a contract to provide future services. August 10th, paying salaries. Step 1. What happened? The company paid $3,120 in salaries to employees. This includes $1,420 that was owed from July and $1,700 for salaries earned in August. Step 2. Which accounts are affected? Salaries payable decreases because the company is paying off the amount owed from July. Salaries expense increases because this represents the cost of August salaries. Cash decreases because the company paid this amount to employees. Step 3. How do we record it? To record this, we debit salaries payable for $1,420 to show the reduction in the liability from July. Debit salaries expense for $1,700 to reflect the current month's salary cost. Credit cash for $3,120 to reflect the payment. The narrative for this entry is paid salaries, including amounts owed for July. August 13th, receiving cash for services performed. Step 1. What happened? The company received $2,800 in cash for services they performed during August. Step 2. Which accounts are affected? Cash increases because the company is receiving money for its services. Service revenue increases because the company earned this income by completing the work. Step 3. How do we record it? To record this, we debit cash for $2,800 to reflect the increase in money received. Credit service revenue for $2,800 to record the income earned. The narrative for this entry is received cash for services performed during August. August 15th, purchasing equipment with a bank loan. Step 1. What happened? The company purchased new equipment worth $2,000. Instead of paying cash, the purchase was financed with a bank loan. Step 2. Which accounts are affected? Equipment increases because the company acquired a new asset. Bank loan payable increases because the company now owes this amount to the bank. Step 3. How do we record it? To record this, we debit equipment for $2,000 to show the acquisition of the new asset. Credit bank loan payable for $2,000 to reflect the new liability. The narrative for this entry is purchased new equipment financed with a bank loan. August 20th, paying creditors. Step 1. What happened? The company paid $2,000 to creditors for amounts owed on accounts payable. Step 2. Which accounts are affected? Accounts payable decreases because the company is paying off what it owes to creditors. Cash decreases because the company paid this amount. Step 3. How do we record it? To record this, we debit accounts payable for $2,000 to reflect the reduction in the liability. Credit cash for $2,000 to show the decrease in money. The narrative for this entry is paid creditors for outstanding amounts owed. August 22nd, purchasing supplies on account. Step 1. What happened? The company purchased $800 worth of supplies. They didn't pay cash at the time of purchase. Instead, the amount is owed to the supplier, meaning it was purchased on account. Step 2. Which accounts are affected? Supplies increases because the company is adding to its inventory of supplies. Accounts payable increases because the company now owes this amount to the supplier. Step 3. How do we record it? To record this, we debit supplies for $800 to reflect the increase in supplies. Credit accounts payable for $800 to show the increase in the amount owed. The narrative for this entry is purchase supplies on account. August 24th, paying employee salaries. Step 1. What happened? The company paid $2,900 in salaries to its employees for the current payroll period. Step 2. Which accounts are affected? Salaries expense increases because this represents the cost of paying employees for their labor. Cash decreases because the company used money to pay the employees. Step 3. How do we record it? To record this, we debit salaries expense for $2,900 to reflect the payroll cost. Credit cash for $2,900 to show the payment. The narrative for this entry is paid salaries to employees for the current payroll period. August 27, billing customers for services performed. Step 1. What happened? The company billed customers $3,760 for repair services they performed during August. The customers haven't paid yet, so this amount is recorded as accounts receivable. Step 2. Which accounts are affected? Accounts receivable increases because this is money the company expects to receive in the future from customers. Service revenue increases because the company earned income by providing these services. Step 3. How do we record it? To record this, we debit accounts receivable for $3,760 to reflect the money owed to the company. Credit service revenue for $3,760 to record the income earned. The narrative for this entry is billed customers for repair services performed during August. August 29th, receiving cash for future services. Step 1. What happened? The company received $780 in cash from a customer for services they will perform in the future. Since the work hasn't been done yet, this amount is considered unearned revenue. Step 2. Which accounts are affected? Cash increases because the company received money. Unearned revenue increases because the company has an obligation to perform the services in the future. Step 3. How do we record it? To record this, we debit cash for $780 to reflect the increase in money received. Credit unearned revenue for $780 to show the increase in the company's liability. The narrative for this entry is received cash from customers for services to be performed in the future. August 30th, paying part of a bank loan with interest. Step 1. What happened? The company paid $550 toward its bank loan. Of this amount, $500 was applied to the loan principal and $50 was for interest. Step 2. Which accounts are affected? Bank loan payable decreases because the company is paying down the principal of the loan. Interest expense increases because the company is incurring this cost as part of borrowing money. Cash decreases because the company paid this amount. Step 3. How do we record it? To record this, we debit bank loan payable for $500 to reduce the loan balance. Debit interest expense for $50 to reflect the borrowing cost. Credit cash for $550 to show the payment. The narrative for this entry is paid a portion of the bank loan including interest. August 31st, paying income taxes. Step 1. What happened? The company paid $380 in income taxes for the month. Step 2. Which accounts are affected? Income tax expense increases because this represents a cost incurred by the business. Cash decreases because the company paid this amount. Step 3. How do we record it? To record this, we debit income tax expense for $380 to reflect the tax cost. Credit cash for $380 to show the payment. The narrative for this entry is paid income taxes for the month. Declaring and paying dividends. Step 1. What happened? The company declared and paid $400 in dividends to its shareholders. Dividends are a distribution of profits, not an expense, so they reduce retained earnings. Step 2. Which accounts are affected? Dividends declared increases because this represents a reduction in retained earnings. Cash decreases because the company paid the dividends. Step 3. How do we record it? To record this, we debit dividends declared for $400 to reflect the reduction in retained earnings. Credit cash for $400 to show the payment. The narrative for this entry is declared and paid dividends to shareholders. And that completes the month of August. Great job following along, everyone. We've handled expenses, revenues, liabilities, assets, and even shareholder distributions, all while keeping our debits and credits balanced. Next, we'll move on to posting these journal entries into the general ledger. But before we do that, let's pause. Any questions about what we've done so far? All right, class, we've done a fantastic job journalizing all the transactions for August. Now, we're ready to move on to the next step, preparing and posting to the general ledger. The general ledger is where we track each account individually. It's like a big book where each account has its own page or section. This is where we summarize all the journal entries we've made so far and organize them by account. By the end, the ledger will give us a clear view of the total balance for each account after all the August transactions. Let's break this process down step by step. Step 1. Bring forward the opening balances. The first thing we need to do is take the balances from July 31, our opening balances, and write them in the ledger for each account. These balances represent where the business stood financially before the August transactions began. Here's a reminder of our opening balances as of July 31st, 2018. Accounts payable, $2,300. Accounts receivable, $3,200. Accumulated depreciation equipment, $2,000. Accumulated depreciation vehicles, $5,000. Bank loan payable, $4,000. Cash, $8,040. Common shares, $14,000. Equipment, $10,000. Retained earnings, $17,290. Salaries payable, $1,420. Supplies, $1,030. Unearned revenue, $1,260. Vehicles, $25,000. Now, we're going to write these amounts as the opening balance for each account in the ledger. If it's an asset, liability, or equity account, the balance will carry over exactly as it was from July 31. These balances are the starting point for the month of August. Step 2. Understand each account and its opening balance. 1. Cash. The cash account shows how much money the business has on hand or in the bank. As of July 31st, the company has $8,040 in cash. This balance is an asset, so it's written on the debit side of the cash ledger as the opening balance. 2. Accounts receivable. Accounts receivable represents the money owed to the business by customers who haven't paid yet. As of July 31st, the company has $3,200 in accounts receivable. This is also an asset account, so the opening balance goes on the debit side of the ledger. 3. Supplies. The supplies account tracks the value of office or repair supplies the business has on hand. On July 31st, the balance is $1,030. Supplies are an asset, so this opening balance is recorded on the debit side of the ledger. 4. Equipment. The equipment account represents the tools or machinery the business owns. On July 31st, the balance is $10,000. Equipment is an asset, so the opening balance is recorded on the debit side of the ledger. 5. Vehicles. Vehicles are another asset, representing the company's transportation equipment. As of July 31st, the business owns vehicles worth $25,000. This balance is an asset, so it goes on the debit side of the vehicles ledger. 6. Accumulated depreciation. Equipment and vehicles. Accumulated depreciation tracks the wear and tear on assets over time. For equipment, the accumulated depreciation is $2,000, and for vehicles, it's $5,000. These balances are contra asset accounts, so they're recorded on the credit side of their respective ledgers. 7. Accounts payable. The accounts payable account shows the money the business owes to creditors. As of July 31st, the company owes $2,300. This is a liability account, so the opening balance is recorded on the credit side of the ledger. 8. Bank loan payable. The bank loan payable account represents a long-term loan the company owes to the bank. On July 31st, the balance is $4,000. Since this is also a liability account, the opening balance goes on the credit side of the ledger. 9. Salaries payable. Salaries payable tracks the wages the company owes its employees. As of July 31st, the balance is $1,420. Salaries payable is a liability account, so the opening balance is written on the credit side of the ledger. 10. Unearned revenue. The unearned revenue account shows money received from customers in advance for services the business hasn't performed yet. As of July 31st, the balance is $1,260. Unearned revenue is a liability, so this opening balance is recorded on the credit side of the ledger. Common shares. The common shares account represents the owner's initial investment in the business. On July 31st, the balance is $14,000. This is an equity account, so the opening balance is recorded on the credit side of the ledger. 12. Retained earnings. Retained earnings represents the accumulated profits of the company that haven't been paid out as dividends. As of July 31st, the balance is $17,290. Retained earnings is an equity account, so this opening balance is recorded on the credit side of the ledger. Step 3. We're ready to post the August transactions. Now that we've carefully written down all the opening balances, we're ready for the next step, posting the August transactions into each account's ledger. As we go through each transaction, we'll record the debits and credits in their respective accounts. By the end of this process, we'll have the updated balances for every account, and those balances will help us prepare the trial balance. Take a moment to review these opening balances and let me know if you have any questions before we dive into posting the transactions. All right, class. Now that we've set up the general ledger and added the opening balances, it's time to post the August transactions. Posting is the process of transferring the journal entries we made earlier into their respective ledger accounts. This helps us track each account's running balance. Let me explain how we post each transaction step by step. 1. First, write the date of the transaction in the ledger. This helps us stay organized and shows when the transaction occurred. 2. Second, include the narrative. The narrative explains the purpose of the transaction, so anyone looking at the ledger can understand what happened. 3. Third, include the journal reference. This is the reference to the journal entry where the transaction was first recorded, for example, J1 for the first journal page. 4. Fourth, write the amount. Finally, we enter the amount in either the debit or credit column, depending on how the account was affected. Let's begin with the first transaction from August 1, and I'll show you exactly how this works. August 1st, paying for advertising. Step 1, review the journal entry. The journal entry for August 1 was debit advertising expense, $250, credit cash, $250. This tells us two accounts are affected, advertising expense and cash. We'll now post these amounts to their respective ledgers. Posting to the advertising expense ledger. Date, write the date of the transaction, August 1. 2. Narrative, add the narrative, paid for advertisement expense. This explains what happened. 3. Reference, include the journal reference, J1, meaning this transaction came from the first page of the journal. 4. Amount, enter the amount $250 in the debit column because expenses increase on the debit side. Posting to the cash ledger. 1. Date, write the date of the transaction, August 1. 2. Narrative, add the narrative, paid for advertisement expense. This explains what happened from the perspective of the cash account. 3. Reference, include the journal reference, J1. Amount, enter the amount $250 in the credit column because cash is decreasing and decreases in assets are recorded as credits. Notice how we updated the running balance in both accounts. For advertising expense, the balance now shows $250, reflecting the cost incurred. For cash, the balance has decreased by the same amount. Let's keep going with the next transaction from August 2, recognizing revenue from unearned revenue. Step 1, review the journal entry. The journal entry for August 2nd was debit unearned revenue, $1,260. Credit service revenue, $1,260. This means we'll post amounts to the unearned revenue and service revenue ledgers. Posting to the unearned revenue ledger. 1. Date, write the date August 2. 2. Narrative, add the narrative. Recognized revenue for services previously paid in advance. 3. Reference, add the journal reference, J1. 4. Amount, enter $1,260 in the debit column because unearned revenue is a liability and liabilities decrease on the debit side. Posting to the service revenue ledger. 1. Date, write the date, August 2. 2. Narrative, add the narrative. Recognized revenue for services previously paid in advance. 3. Reference, add the journal reference, J1. 4. Amount, enter $1,260 in the credit column because revenue increases on the credit side. See how we've decreased the liability unearned revenue because the company fulfilled its obligation and increased the revenue? Let's keep the momentum going with August 3. Step 1. Review the journal entry. The journal entry for August 3 was debit rent expense, $980, credit cash, $980. Posting to the rent expense ledger. 1. Date, write the date August 3. 2. Narrative, add the narrative, paid monthly rent for August. 3. Reference, add the journal reference, write as J1. Amount, enter $980 in the debit column because expenses increase on the debit side. Posting to the cash ledger. 1. Date, write the date, August 3. 2. Narrative, add the narrative, paid monthly rent for August. 3. Reference, add the journal reference. 4. Amount, enter $980 in the credit column because cash decreases on the credit side. Let's continue with the next transaction from August 6th. And by the time we finish posting all the transactions, we'll see how these ledgers give us the full picture of the company's financial position. August 6, receiving payment from customers. Step 1. Review the journal entry. The journal entry for August 6 was debit cash, $1,200. Credit accounts receivable, $1,200. This tells us that the company received payment from customers who previously owed money, so we need to update both the cash and accounts receivable ledgers. Posting to the ledgers. Cash ledger. 1. Date, write the date, August 6. This helps us keep track of when the transaction occurred. 2. Narrative. Add the narrative, received cash from customers for outstanding balances. This explains what happened, so anyone reading the ledger knows the reason for the change. 3. Reference. Include the journal reference, J1. This tells us the transaction was recorded on the first page of the journal. 4. Amount. Enter $1,200 in the debit column. We debit the cash account because the company received money, and increases to cash are recorded as debits. Accounts receivable ledger. 1. Date, write the date, August 6. The date ensures we can trace back when the transaction happened. 2. Narrative. Add the narrative, received cash from customers for outstanding balances. The narrative here is the same as in the cash ledger, reflecting the same transaction, but from the perspective of accounts receivable. 3. Reference. Include the journal reference, J1. This links back to the journal entry, keeping our records consistent and easy to trace. 4. Amount. Enter $1,200 in the credit column. We credit the accounts receivable account because the customers no longer owe this money, and decreases to assets like accounts receivable are recorded as credits. August 7. Step 1. Review the transaction. On August 7th, the company signed a contract with Marathuse Appliances Ltd. To provide repair services in the future. This is an agreement to perform services as needed. But here's the key point. No services have been provided yet, and no money has been exchanged. Since nothing financial has occurred, there's no journal entry for this transaction. And if there's no journal entry, there's nothing to post to the ledger. Explanation. Recap. In accounting, we only record events that have a financial impact on the business. Signing a contract is an important note for the business, but it's not something we record in the journal or ledger until money is received or services are performed. For now, we can simply document this as a note in the company's records for reference. August 10th, paying salaries. Step 1. Review the journal entry. On August 10, the company paid a total of $3,120 in salaries to employees. This payment included $1,420 for salaries owed from July, salaries payable, and $1,700 for current salaries earned in August, salaries expense. The journal entry for this transaction was debit salaries payable, $1,420. Debit salaries expense, $1,700. Credit cash, $3,120. This tells us we need to post to three ledgers: salaries payable, salaries expense, and cash. Posting to the ledgers: salaries payable ledger. 1. Date, write the date, August 10. 2. Narrative, add the narrative, paid salaries owed from July. 3. Reference, include the journal reference, J1. 4. Amount, enter $1,420 in the debit column. We debit salaries payable because liabilities decrease when they are paid off. Salaries expense ledger. 1. Date, write the date, August 10. 2. Narrative, add the narrative, paid current salaries for August. 3. Reference, include the journal reference, J1. 4. Amount, enter $1,700 in the debit column. We debit salaries expense because expenses increase on the debit side. Cash ledger. 1. Date, write the date, August 10. 2. Narrative, add the narrative, paid salaries for July and August. 3. Reference, include the journal reference, J1. 4. Amount, enter $3,120 in the credit column. We credit cash because the company is spending money, and decreases to cash are recorded on the credit side. August 13th, receiving cash for services performed. Step 1. Review the journal entry. On August 13, the company received $2,800 in cash for repair services they performed during August. The journal entry for this transaction was debit cash $2,800, credit service revenue $2,800. This tells us that we'll need to post to the cash ledger and the service revenue ledger. Posting to the ledgers. Cash ledger. Date, write the date, August 13. 2. Narrative, add the narrative, received cash for services performed during August. 3. Reference, include the journal reference, J1. 4. Amount, enter $2,800 in the debit column. We debit cash because the company is receiving money, and increases to cash are recorded on the debit side. Service revenue ledger. 1. Date, write the date, August 13. 2. Narrative, add the narrative, recorded revenue for services performed during August. 3. Reference, include the journal reference, J1. 4. Amount, enter $2,800 in the credit column. We credit service revenue because revenue increases on the credit side. August 15th, purchasing equipment with a bank loan. Review the journal entry. On August 15, the company purchased new equipment worth $2,000. Instead of paying cash, the purchase was financed entirely with a bank loan. The journal entry for this transaction was debit equipment, $2,000, credit bank loan payable, $2,000. This means we'll need to post to the equipment ledger and the bank loan payable ledger. Posting to the ledgers. Equipment ledger. 1. Date, write the date, August 15. 2. Narrative, add the narrative, purchased equipment financed by a bank loan. 3. Reference, include the journal reference, J1. 4. Amount, enter $2,000 in the debit column. We debit equipment because the company's assets are increasing, and increases to assets are recorded on the debit side. Bank loan payable ledger. 1. Date, August 15. 2. Narrative, add the narrative, financed equipment purchase with a bank loan. 3. Reference, include the journal reference, J1. 4. Amount, enter $2,000 in the credit column. We credit bank loan payable because the company's liability is increasing, and increases to liabilities are recorded on the credit side. August 20th, paying creditors. Step 1. Review the journal entry. On August 20, the company paid $2,000 to creditors for amounts owed on accounts payable. This payment reduces the business's liability and its cash balance. The journal entry for this transaction was debit accounts payable, $2,000, credit cash, $2,000. This tells us that we need to post to the accounts payable and cash ledgers. Posting to the ledgers. Accounts payable ledger. Write the date, August 20. 2. Narrative. Add the narrative. Paid creditors for outstanding amounts owed. 3. Reference. Include the journal reference, J1. 4. Amount. Enter $2,000 in the debit column. We debit accounts payable because liabilities decrease when the company pays off what it owes. Cash ledger. 1. Date. Write the date, August 20. 2. Narrative. Add the narrative. Paid creditors for outstanding amounts owed. 3. Reference. Include the journal reference, J1. 4. Amount. Enter $2,000 in the credit column. We credit cash because the company is spending money, and decreases to assets like cash are recorded on the credit side. August 22nd, purchasing supplies on account. Step 1. Review the journal entry. On August 22, the company purchased $800 worth of supplies. Instead of paying cash, the company bought these supplies on account, meaning it now owes the supplier this amount. The journal entry for this transaction was debit supplies, $800, credit accounts payable, $800. This tells us that we'll need to post to the supplies and accounts payable ledgers. Posting to the ledgers. Supplies ledger. 1. Date. Write the date, August 22. 2. Narrative. Add the narrative. Purchase supplies on account. 3. Reference. Include the journal reference J1. 4. Amount. Enter $800 in the debit column. We debit supplies because the business is increasing its asset inventory of supplies, and increases to assets are recorded on the debit side. Accounts payable ledger. Write the date. 2. Narrative. Add the narrative. Purchase supplies on account. 3. Reference. Include the journal reference, J1. 4. Amount. Enter $800 in the credit column. We credit accounts payable because the company now owes more to its creditors, and increases to liabilities are recorded on the credit side. August 24th, paying employee salaries. Step 1. Review the journal entry. On August 24, the company paid $2,900 in salaries to its employees for the current payroll period. The journal entry for this transaction was debit salaries expense, $2,900. Credit cash, $2,900. This means we'll need to post to the salaries expense ledger and the cash ledger. Posting to the ledgers. Salaries expense ledger. 1. Date. Write the date, August 24. 2. Narrative. Add the narrative. Paid salaries for the current payroll period. 3. Reference. Include the journal reference J1. 4. Amount. Enter $2,900 in the debit column. We debit salaries expense because this cost is increasing, and increases to expenses are recorded on the debit side. Cash ledger. 1. Date. Write the date, August 24. 2. Narrative. Add the narrative. Paid salaries for the current payroll period. 3. Reference. Include the journal reference, J1. 4. Amount. Enter $2,900 in the credit column. We credit cash because the company is spending money, and decreases to assets like cash are recorded on the credit side. August 27th, billing customers for services performed. Step 1. Review the journal entry. On August 27, the company billed customers $3,760 for services they performed during August. The customers haven't paid yet, so the amount is recorded as accounts receivable. The journal entry for this transaction was debit accounts receivable, $3,760. Credit service revenue, $3,760. This means we'll need to post to the accounts receivable ledger and the service revenue ledger. Posting to the ledgers. Accounts receivable ledger. 1. Date. Write the date. August 27. 2. Narrative. Add the narrative. Billed customers for services performed during August. 3. Reference. Include the journal reference. J1. For amount, enter $3,760 in the debit column. We debit accounts receivable because this represents money the company expects to receive from customers, and increases to assets like accounts receivable are recorded on the debit side. Service revenue ledger. 1. Date. Write the date. August 27. 2. Narrative. Add the narrative. Recorded revenue for services performed during August. 3. Reference. Include the journal reference. J1. 4. Amount. Enter $3,760 in the credit column. We credit service revenue because the company earned income by performing services, and increases to revenue are recorded on the credit side. August 29th. Receiving cash for future services. Step 1. Review the journal entry. On August 29, the company received $780 in cash from a customer. However, this payment is for services that will be performed in the future. Since the work hasn't been done yet, we record this amount as unearned revenue. The journal entry for this transaction was debit cash $780, credit unearned revenue $780. This means we'll need to post to the cash ledger and the unearned revenue ledger. Posting to the ledgers. Cash ledger. 1. Date. Write the date, August 29. 2. Narrative. Add the narrative. Received cash for services to be performed in the future. 3. Reference. Include the journal reference. J1. 4. Amount. Enter $780 in the debit column. We debit cash because the company has received money, and increases to assets like cash are recorded on the debit side. Unearned revenue ledger. 1. Date the date, August 29. 2. Narrative. Add the narrative, recorded liability for future services. 3. Reference. Include the journal reference, J1. 4. Amount. Enter $780 in the credit column. We credit unearned revenue because the company now has a liability to perform services in the future, and increases to liabilities are recorded on the credit side. August 30th. Paying part of a bank loan with interest. Step 1. Review the journal entry. On August 30, the company paid $550 to the bank. This payment included $500 applied toward the loan principal and $50 for interest on the loan. The journal entry for this transaction was debit bank loan payable, $500, debit interest expense, $50, credit cash, $550. This means we'll need to post to the bank loan payable, interest expense, and cash ledgers. Posting to the ledgers. Bank loan payable ledger. 1. Date. Write the date, August 30. 2. Narrative. Add the narrative. Paid part of the bank loan principal. 3. Reference. Include the journal reference, J1. 4. Amount. Enter $500 in the debit column. We debit bank loan payable because the loan liability is decreasing, and decreases to liabilities are recorded on the debit side. Interest expense ledger. 1. Write the date. 2. Narrative. Add the narrative. Recorded interest expense on loan payment. 3. Reference. include the journal reference J1. 4. Amount. Enter $50 in the debit column. We debit interest expense because the company incurred a cost for borrowing, and increases to expenses are recorded on the debit side. Cash ledger. 1. Date. Write the date, August 30. 2. Narrative. Add the narrative. Paid part of the bank loan and interest. 3. Reference. Include the journal reference. J1. 4. Amount. Enter $550 in the credit column. We credit cash because the company spent money, and decreases to cash are recorded on the credit side. August 31st. Paying income taxes and declaring dividends. Step 1. Review the journal entry. On August 31, the company made 2 separate payments. 1. Paid $380 in income taxes. 2. Declared and paid $400 in dividends to shareholders. The journal entries for these transactions were: for the income tax payment, debit income tax expense, $380. Credit cash, $380. For the dividends, debit dividends declared, $400. Credit cash, $400. We'll need to post these amounts to the income tax expense, dividends declared, and cash ledgers. Posting to the ledgers. Income tax expense ledger. 1. Date. Write the date, August 31. 2. Narrative. Add the narrative. Paid income taxes for the month. 3. Reference. Include the journal reference J1. 4. Amount. Enter $380 in the debit column. We debit income tax expense because it's a cost incurred and expenses increase on the debit side. Dividends declared ledger. 1. Date. Write the date, August 31. 2. Narrative. Add the narrative. Declared and paid dividends to shareholders. 3. Reference. Include the journal reference J1. 4. Amount. Enter $400 in the debit column. We debit dividends declared because dividends reduce retained earnings, and they are recorded as a debit to show this reduction. Cash ledger. 1. Date. Write the date, August 31. 2. Narrative. Add the narrative. Paid income taxes and dividends. 3. Reference. Include the journal reference, J1. 4. Amount. Enter $380 and $400 separately in the credit column. We credit cash because the company spent money, and decreases to assets like cash are recorded on the credit side. Thank you so much, students, for joining me in today's lesson. I hope you found it clear and engaging as we worked through Posted the General Ledger. You're doing a fantastic job building your understanding of accounting principles step by step. Take a little time to review what we covered today, and don't hesitate to bring your questions to our next session. I'll see you all in the next lesson. Until then, have a great day and keep up the excellent work. Hey everyone, welcome to today's lesson on discounts. I'm really excited to go through this with you. We'll take it step by step, making sure everything is crystal clear. Today we'll talk about what a discount is, why it matters, and the 2 main types of discounts covered in our FIA FA1 book. Sound good? Let's dive in. What is a discount? Okay, picture this. You walk into a store and see a sign that says 20% off. That means the store is lowering the price of that item by 20%. In simple terms, a discount is just a price reduction. It means you get to pay less than the original price. Now, why do businesses give discounts? For sellers, they offer discounts to attract more customers, sell in larger quantities, or clear out old stock. For buyers, well, who doesn't love saving money? Discounts help you get a better deal on something you were already planning to buy. Think of a discount like a little bonus that makes shopping feel even better. Types of discounts. There are 2 main types of discounts we'll cover today. 1. Trade discount. 2. Cash discount. Let's break them down with some real-life examples. 1. Trade discount. A trade discount is given right at the time of purchase. Businesses usually offer this when someone buys in bulk or is a regular customer. The discount is applied immediately, and only the final price is recorded in the books, meaning the discount itself isn't separately mentioned in the accounting records. Example: let's say you're buying notebooks for school or your business. Original price: each notebook costs $5. Quantity: you buy 50 notebooks. Without a discount, 50 notebooks times $5 equals $250. With a trade discount, the seller gives a 10% discount for bulk buying. How do we calculate that? 10% of $250 is the same as $250 times 0.1, which equals $25. Final price: $250 minus $25 equals $225. So because of the trade discount, you save $25 just by buying in bulk. And remember, in the seller's accounting records, they'll only note down $225, not the original $250 or the discount amount. 2. Cash discount. A cash discount is a little different. Instead of being applied during the purchase, this discount is given after the sale as a reward for paying quickly. It's recorded in the accounting books because it affects the actual cash flow. Example: let's say you're buying a computer from an electronics store. Original price $1,000. Cash discount: if you pay within 7 days, you get 5% off. How to calculate the discount? 5% of $1,000 is the same as $1,000 times 0.05, which equals $50. Final price if you pay early: $1,000 minus $50 equals $950. So, if you make the payment within 7 days, you only pay $950 instead of $1,000. Unlike a trade discount, the seller records this cash discount in their books, usually as a small expense. Now that we've covered both trade discounts and cash discounts, let's take a moment to compare them so you can see the key differences. A trade discount is applied at the time of purchase, usually as a way to encourage bulk buying or to reward loyal customers. It is not recorded separately in the accounting books. Instead, only the final price after the discount is noted. On the other hand, a cash discount is given after the sale to motivate customers to pay their bills quickly. This type of discount is recorded in the accounting books because it directly affects cash flow. Another key difference is their purpose. A trade discount helps businesses sell more products by offering an incentive for buying in large quantities. A cash discount, however, is used to speed up payments, helping sellers manage their finances more effectively. So, while both discounts help customers save money, they work in different ways and serve different business goals. Understanding these differences can help you recognize how businesses use discounts to boost sales and maintain a healthy cash flow. How discounts are recorded in a journal entry. Now that we understand what discounts are and how they work, let's dive into something really important: how discounts are recorded in the accounting books. This is key because businesses need to keep track of every transaction, including any reductions in price. But here's something interesting. Trade discounts and cash discounts are recorded differently. Let's go step by step so it's easy to follow. 1. Recording a trade discount. A trade discount is given before the sale is recorded, meaning it is not separately shown in the journal entry. Instead, the invoice or bill will already reflect the final price after the discount has been applied. This means that when we record the transaction, we only enter the discounted price. The original price and the discount amount are not mentioned in the accounting records. Example, imagine a business buys stop 50 notebooks from a supplier. Original price per notebook, $5. Total price before discount, 50 notebooks times $5 equals $250. Trade discount offered, 10% of $250 equals $25. Final price after discount, $225. Journal entry for trade discount, purchases on credit. Since the buyer pays the discounted price of $225, this is how we record it in the books. Debit purchases or inventory, $225. Credit accounts payable, supplier, $225. Notice something? The original price of $250 and the discount of $25 are not recorded separately. The only thing we enter is the final price. Why? Because the trade discount was applied before the sale was finalized, it was just part of the pricing agreement. 2. Recording a cash discount. A cash discount, however, is handled differently. This discount is offered after the sale as a way to encourage fast payment. Since it happens after the transaction, we must record it separately in the books. Example, imagine a customer buys a computer for $1,000 on credit. The seller offers a 5% cash discount if the customer pays within 7 days. Cash discount amount. 5% of $1,000 equals $50. Final price if paid within 7 days. $1,000 minus $50 equals $950. Journal entry. When the sale happens, on credit. When the sale is made, the full price is recorded because the customer has not yet taken advantage of the cash discount. Debit, accounts receivable, customer, $1,000. Credit, sales revenue, $1,000. At this point, the business is still expecting the full amount. But what happens if the customer pays within the discount period? Journal entry. When the customer pays early. If the customer pays within 7 days and takes the discount, we record it like this. Debit cash, $950. This is the amount received. Debit sales discount, or discount allowed, $50. This is the discount given. Credit accounts receivable, $1,000 to clear the amount owed. Here, the sales discount is recorded separately because it was given after the sale and directly affects the cash flow. Key differences in journal entries. So to sum it up, trade discounts are not recorded separately. We only record the final discounted price. Cash discounts are recorded separately as a discount expense for the seller or savings for the buyer. By understanding these journal entries, you can see how businesses keep accurate financial records while using discounts to attract customers and speed up payments. Final thoughts. Accounting isn't just about numbers. It's about telling the story of a business's finances. Discounts are a huge part of that story, whether they help companies sell more products, trade discounts, or get paid faster, cash discounts. I hope this explanation makes everything super clear. If you have any questions or need more examples, feel free to ask. Keep learning and happy accounting. Hey everyone, welcome back to Lesson 7 of our FIA FA1 series. Today we're diving into an important topic, receivables, sales, and payables purchases ledgers. If you're new to accounting, don't worry. I'll break it down in a simple and easy to understand way. So grab your notes, get comfortable, and let's get started. All right, let's start with the general ledger, the backbone of a business's financial records. Think of it like a giant notebook where a business keeps track of all its financial transactions. Every dollar coming in and going out gets recorded here, organized into different categories like sales, expenses, assets, and liabilities. But here's the thing. The general ledger doesn't give us a detailed breakdown of individual customers or suppliers. Imagine running a business where hundreds of customers buy on credit. Wouldn't you need to know exactly how much each person owes you? Or, if you're purchasing supplies on credit, wouldn't you want a way to track exactly how much you owe to each supplier? That's where the receivables ledger and payables ledger come in. Receivables ledger, sales ledger, tracks who owes you money, your credit customers. Payables ledger, purchases ledger, tracks who you owe money to, your suppliers. Without these ledgers, businesses would be lost in a mess of numbers, trying to figure out who has paid, who still needs to pay, and how much they need to collect or settle. These ledgers make sure everything is organized, clear, and manageable, so no payments slip through the cracks. See? It's all about making life easier for businesses. Now let's break it down further and see exactly how these ledgers work. Let's go. Receivables ledger, sales ledger, the business's personal tracker for credit customers. All right, let's zoom in on one of the most critical ledgers in accounting, the receivables ledger, also known as the sales ledger. Now imagine you own a business that sells products or services on credit. You let customers take their purchases today and they promise to pay later. Sounds great, right? But here's the catch. How do you keep track of who owes you, how much they owe, and when they need to pay? This is exactly why we have the receivables ledger. What is the receivables ledger? The receivables ledger is a record of all individual customers who have bought on credit. It contains personal accounts for each customer, showing their outstanding balances and a detailed history of transactions. Think of it as a personal tracker for every single person or company that owes your business money. If the general ledger is the big picture, the receivables ledger is like zooming in with a magnifying glass, focusing on the details of each customer's financial activity with your business. Why do we keep a separate receivables ledger? You might be wondering, why not just track everything in the general ledger? Well, here's the thing. The general ledger is designed to give a summary of financial transactions. It shows how much money the business is owed in total, but it doesn't break it down customer by customer. Let's say your business has hundreds or even thousands of customers who buy on credit. If all of their transactions were dumped into the general ledger, it would become a chaotic mess, impossible to manage. So instead of crowding the general ledger with hundreds of customer details, we use a receivables ledger to keep track of individual customer accounts. This allows us to see exactly how much each customer owes at any given moment, track unpaid invoices and ensure customers pay on time, match customer payments to their debts so that we always know who has settled their accounts and who still needs to pay. Prevent credit limit issues. We can check if a customer is exceeding their credit limit before approving new sales. Why the receivables ledger is not part of the double entry system. Now, here's something interesting. The receivables ledger is not part of the business's official financial records. Wait, what? How can something so important not be part of the accounting system? Well, this is because the receivables ledger is just a reference tool, not an official part of the double entry system. Remember, double entry accounting means that for every financial transaction, there is a debit and a credit recorded somewhere. But if we recorded customer transactions in both the receivables ledger and the general ledger, we'd be duplicating records, which would cause accounting errors. Instead, the general ledger keeps the total receivables balance, while the receivables ledger holds all the individual customer details. Think of it like this. The general ledger is like the total class grade a teacher keeps for all students combined. The receivables ledger is like each student's individual report card, showing their personal scores and progress. Why does the receivables ledger include only personal accounts? The receivables ledger consists only of personal accounts, meaning it only tracks real people or businesses who owe money. Why? Because when a business sells on credit, it's dealing with individual customers or companies, not general categories like income or expenses. For example, if John Smith buys on credit, his name goes into the receivables ledger. If XYZ Corporation buys on credit, their account is also recorded here. But we don't record general accounting categories here because this ledger is specifically for tracking who owes us money, not how much money the business has overall. The power of the receivables ledger. With the receivables ledger, businesses have total control over their credit sales. They can quickly check which customers are overdue, send reminders or statements to late payers, keep a clean, organized record of all outstanding debts, improve cash flow by making sure customers don't delay payments. So, while the general ledger tells us the total money owed, the receivables ledger tells us who owes us that money, which makes it an essential tool for any business that sells on credit. Pretty powerful, right? Payables ledger, purchases ledger, the business's personal tracker for suppliers. All right, now that we've covered how businesses keep track of the money they are owed through the receivables ledger, let's flip the coin and talk about something just as important, the money the business itself owes. Every business, no matter how big or small, has to buy things to keep running. Whether it's raw materials, office supplies, rent, or professional services, most companies don't pay for everything upfront in cash. Instead, they buy on credit, meaning they receive the goods or services first and agree to pay for them later. Now, here's the challenge. Imagine your business has dozens, maybe even hundreds of suppliers. Each supplier has different payment terms, different due dates, and different invoice amounts. How do you keep track of who you owe, how much you owe, and when each payment is due? That's where the payables ledger, also known as the purchases ledger, comes in. What is the payables ledger? The payables ledger is a detailed record of every supplier or vendor that the business owes money to. It contains personal accounts for each supplier, tracking outstanding balances and all past transactions. Think of it as the business's to-pay list, a place where every bill and outstanding invoice from suppliers is recorded. While the receivables ledger tracks money coming into the business, the payables ledger tracks money going out. This ledger helps businesses answer critical questions like, how much do we owe in total? Which suppliers need to be paid this week or month? Have we missed any due payments? Are we staying within our budget for purchases? It's a lifesaver when managing business cash flow because keeping track of unpaid bills is just as important as collecting money from customers. Why do we keep a separate payables ledger? You might be thinking, why not just track everything in the general ledger? Wouldn't that be simpler? Well, not really. The general ledger is designed to provide a summary of all financial transactions. It tells the business how much it owes in total, but it doesn't break that amount down supplier by supplier. If every individual supplier account was listed in the general ledger, it would quickly become overwhelmed with unnecessary details, making it difficult to use for financial analysis and decision-making. Instead, businesses use the payables ledger as a separate, more detailed tracking system, making it easy to see exactly who the business owes money to, the due dates for different invoices, a history of all past payments and outstanding balances. This ensures that every supplier is paid on time, avoiding late fees or damage to business relationships. Why the payables ledger is not part of the double entry system. Here's something important to understand. Just like the receivables ledger, the payables ledger is not part of the official accounting records. It is only a memorandum reference ledger. Wait, what? How can something that tracks how much money the business owes not be an official record? Well, In accounting, every transaction is recorded in the double entry system, which means every financial movement is recorded with both a debit and a credit. If the payables ledger was part of the double entry system, each transaction would be recorded twice, once in the general ledger and again in the payables ledger. That would throw off the entire accounting system and create duplicate records. Instead, we do this. The general ledger records the total amount owed to all suppliers. The payables ledger breaks that total down into individual supplier accounts for reference. This way, the business gets the best of both worlds, an easy-to-read financial summary in the general ledger and a detailed breakdown of supplier debts in the payables ledger. Why does the payables ledger include only personal accounts? The payables ledger is exclusively for personal accounts, meaning it only tracks real people or companies the business owes money to. Why? Because when a business buys on credit, it doesn't owe money to a broad category like expenses or purchases. It owes money to specific suppliers who provided goods or services. For example, if a business orders office supplies on credit from ABC Office Supplies Limited, that supplier is recorded in the payables ledger. If a business purchases raw materials on credit from XYZ Manufacturing Co., that supplier is also recorded here. But we don't record general accounting categories like expenses in this ledger because it's strictly for tracking debts to suppliers. The power of the payables ledger. The payables ledger is not just about keeping records. It's a critical tool for managing cash flow and maintaining good supplier relationships. A business that doesn't keep track of its payables properly might forget to pay suppliers on time, damaging its reputation and leading to late fees, lose important supplier discounts for early payments, struggle with cash flow because it doesn't plan for upcoming payments. With a well-maintained payables ledger, a business can plan ahead for payments, ensuring there's enough cash available when bills are due, avoid late payment penalties, and maintain good relationships with suppliers. Take advantage of supplier discounts by making early payments when possible. Monitor purchasing activity to make sure the business isn't overspending. Final thoughts. So, while the general ledger tells us how much money the business owes in total, the payables ledger tells us who we owe that money to and when it's due. Without it, businesses would be lost, struggling to remember which suppliers to pay and when. But with it, payments stay organized, on time, and under control, keeping the business running smoothly and suppliers happy. And that, my friends, is the power of the payables ledger. All right, my amazing students, thank you so much for sticking with me till the end of this lesson. I truly appreciate your time, effort, and dedication to learning. I hope you found this lesson on receivables and payables ledgers helpful and easy to understand. If you enjoyed this session and it helped you, don't forget to hit that like button. It really supports the channel and lets me know you're finding value in these lessons. And if you haven't already, make sure to subscribe so you never miss an upcoming lesson. We have a lot more exciting and important topics ahead, and I'd love for you to be a part of this journey. Also, if you know someone who's learning accounting or preparing for FA1, share this video with them. Knowledge grows when we spread it. And if you'd like to go the extra mile in supporting this channel, any form of support, whether through comments, shares, or other means, is truly appreciated. It helps keep this content coming to you. Thanks again for being here, and I'll see you in the next lesson. Happy learning, and take care. Welcome to Lesson 8, Accounting for Sales Tax. Hello and welcome back, everyone. I'm so glad to have you here for Lesson 8 in our FA1 series. Today, we're going to learn about accounting for sales tax, a very important topic for any business, big or small. By the end of this lesson, you'll clearly understand what sales tax is and why it's used, how to record sales tax when making sales to customers, how to handle sales tax when the business buys from suppliers, and why sometimes sales tax is included in the cost of goods and other times it's not. Let's break this down step by step in the most simple and detailed way possible. What is sales tax? Sales tax is a type of tax that businesses add to the price of goods or services when they sell them to customers. The business collects this tax on behalf of the government and later pays it to the tax authority. This means the business does not get to keep the sales tax. It is just collecting it temporarily. Because the business doesn't keep this tax as profit, it should not include it in its sales revenue. So, when a business sells a product, the actual sale amount is recorded without the tax. Accounting for sales tax on sales, also called output tax. Let's take an example. Imagine a business sells goods for $600 and adds a 20% sales tax, which is $120. So the total price the customer pays is $720. Now, how does the business record this transaction? First, the full amount received from the customer, which is $720, is recorded as money coming in. But the business cannot treat all of this as income. Only $600, the value of the goods sold, is counted as sales revenue. The remaining $120 is recorded as sales tax collected, which is money the business will pay to the government. So, to sum it up, the business records $720 as money received. Out of this, $600 goes into the sales account. The remaining $120 is recorded in a separate sales tax account because it is owed to the tax authority. Accounting for sales tax on purchases, also called input tax. Now let's look at the other side. What happens when the business is the one buying goods or services and it pays sales tax? This depends on whether the business is allowed to reclaim the tax or not. This is a very important detail in accounting. Case 1. When the tax is recoverable. If the business can reclaim the tax from the government later, the tax is not treated as part of the cost of the goods. For example, imagine the business buys goods worth $400 and pays $80 in tax. The total is $480. Since the tax is recoverable, the business only records $400 as the purchase cost. The $80 of tax is recorded in a separate account called the input tax account because the business expects to get this money back. So the purchase cost is just $400, not $480. Case 2. When the tax is not recoverable. Now, if the tax is not recoverable, the business must bear the full cost, including the tax. Let's use the same numbers. The business buys goods for $400 and pays $80 tax, so the total paid is $480. But this time, the tax cannot be claimed back. In this case, the full amount of $480 is treated as the cost of the goods. So both the purchase cost and the sales tax are recorded together as one total amount because the business is fully responsible for paying it. Why does this matter? Understanding how to treat sales tax is very important because businesses must report the correct amount of tax to the government. They must not overstate their income by including tax in their sales. They need to know whether or not they can recover the tax they pay on purchases. And finally, it helps keep the accounts clean, organized, and accurate. Summary of what you've learned. Let's quickly review. Sales tax is collected by businesses but belongs to the government. Sales records should not include tax in the revenue. When a business sells, the sales amount is recorded without tax, and the tax is recorded separately as a liability. When a business buys, if the tax is recoverable, it is separated out and not counted in the cost of purchases. If the tax is not recoverable, it is added to the purchase cost because the business must pay it. I know it can feel tricky at first, but with practice, it becomes second nature. If this lesson helped you, please give it a thumbs up, subscribe to the channel, and share it with your classmates or friends who might also find it helpful. And if you'd like to support this channel even more, feel free to leave a comment or share this video. Every little bit helps keep these lessons going. When should businesses record sales tax? This might seem like a small detail, but it is crucial in accounting because businesses need to know exactly when to enter sales tax into their financial records. If they record it too late or too early, it can cause big problems, like incorrect tax payments or financial mistakes. So, let's break it down step by step in the easiest way possible. Understanding when sales tax is recorded. Sales tax must be recorded as soon as it first arises. But what does that mean? Well, it depends on how the transaction happens, whether it is a credit transaction or a cash transaction. Let's go through each one with clear explanations so you can fully understand. Case 1. Sales tax on a credit sale or credit purchase. A credit transaction means that the money is not paid right away. The customer will pay later, or the business will pay later if it's making a purchase. When do we record the sales tax? The sales tax must be recorded when the invoice is received or issued, not when the payment is made. Let's say you sell a product for $1,000 on credit, and there is a 10% sales tax, which is $100. The customer has not paid yet, but as soon as you issue the invoice, you must record the sales tax of $100 in your accounting system. The same applies if you are buying something on credit. If you receive an invoice from a supplier for $2,000 and the tax is $200, you must record that tax as soon as you get the invoice, even though you will pay the supplier later. Key point: for credit transactions, sales tax is recorded when the invoice is received or issued, even if the money has not been paid yet. Case 2. Sales tax on a cash sale or cash purchase. A cash transaction means that the money is paid immediately when the transaction happens. When do we record the sales tax? For cash sales and cash purchases, sales tax is recorded at the exact moment when the money is received or paid. Let's say a customer comes to your store and buys an item for $500 plus a 5% tax, which is $25. Since they are paying in cash, you must record the sales tax of $25 immediately. You do not wait until later. You record it at the same time you receive the money. The same applies if you are buying something in cash. If you pay a supplier $800 for materials plus a 10% tax of $80, you must record the tax as soon as you make the payment. Key point: for cash transactions, sales tax is recorded immediately when the payment is made or received. Why is this important? Recording sales tax at the correct time is important because it ensures accurate financial records. It helps businesses stay compliant with tax laws. It prevents errors in tax reporting, which could lead to penalties or legal issues. It helps businesses track their tax liabilities correctly so they know how much they owe to the government. If a business delays recording sales tax, it could underestimate how much tax it owes, leading to a tax penalty. If it records tax too early, it could create cash flow issues. That's why timing is everything. This is a crucial accounting principle, and it is often tested in exams. Make sure you practice it well. If this explanation helped you, make sure to like this video to support the channel. Subscribe and turn on notifications so you never miss an upcoming lesson. Share this with friends or classmates who are learning accounting. Thank you for learning with me. See you in the next lesson. What is coding and accounting, and why do we need it? Let's start with a simple idea. Imagine you walk into a big library. There are thousands of books. If the books didn't have labels, numbers, or codes, how would you find the one you're looking for? It would take you hours. Now think about a business. A business, even a small one, deals with hundreds or even thousands of records. Customers, suppliers, employees, sales, products, and so much more. If we don't organize this information properly, things can get messy and confusing very quickly. This is where coding comes in. In accounting, coding means giving each account a special and unique number or code, like an ID card, so that we can identify it quickly and accurately. These codes can be numbers, letters, or a mix of both. They help the business stay organized and avoid errors when recording transactions. So, in simple words, coding is a way of organizing information using short, clear codes instead of long names or descriptions. Why is it so important to have unique codes? Let me give you a real-world example. Imagine your business has two customers named John Smith. Yes, they have the same name. If you are not using unique codes, how would you know which one bought a product or made a payment? It could easily cause a big mistake. But if one John Smith has the code C101 and the other John Smith has the code C102, then there's no confusion. You can clearly tell who is who. That's the power of unique codes. They help you post transactions to the correct account, avoid making costly errors, quickly find and manage records, and keep everything clean and organized. Whether the system is manual or computerized. Imagine trying to type full names or product descriptions over and over again. It takes a lot of time, and sometimes people make spelling mistakes. But if you just use a short code like EMP01 for an employee or I205 for a product, it's faster and easier. That's why codes are so helpful. Real-life examples of codes used in accounting systems. Now you might be wondering, what kind of codes are we talking about? Let's look at some real examples that every business uses. Customer account numbers. Each customer is given a code like C001, C002, C003, and so on. This helps identify their transactions quickly. Supplier account numbers. These are codes for people or companies who supply goods to the business. For example, S01DO might be the code for a paper supplier. General ledger account numbers. These are codes for different categories in the accounting system, like one code for rent, another code for electricity, and another one for salaries. Employee reference numbers. Every staff member in a business has a code to track things like their salary, tax, and work records. Inventory item codes. Each item in the store or warehouse has a code to help track stock, pricing, and movement. So if you sell pens, notebooks, and staplers, each item will have its own code. These are called internal codes. That means the business creates them and uses them inside the company. There are also external codes. These are codes created by other organizations, like banks. For example, your bank account number, your bank sort code used to identify your bank and branch. These codes are also important when your business sends or receives money. What are the benefits of using codes in accounting? Let's talk about the amazing benefits of coding. First, codes help keep your records accurate. You know exactly where the money is going and where it's coming from. There's no confusion. Second, codes help you work faster. Typing a short code takes seconds. Typing a long name or description takes longer and increases the chance of mistakes. Third, coding helps you save storage space, especially in computer systems. Computers love data that is short and simple. Instead of storing full descriptions again and again, the system only stores and uses the codes. Fourth, coding gives you clarity. Everyone in the business knows what each code means. This makes teamwork easier and avoids misunderstandings. And finally, as your business grows, you will have more and more customers, more suppliers, more products, more everything. Without coding, managing this information would be almost impossible. In short, coding is not just useful, it is essential for every business that wants to be organized and professional. How does a business create a coding system? Here's a smart question. Who decides these codes? The answer is the business creates its own coding system based on what works best for them. This system must be logical, easy to understand, and consistent. Let me show you a simple example of how a business might design its codes. All customer accounts start with the letter C. So, if the first customer is C01, the second is C002. All supplier accounts start with EST. So, your printing supplier might be S05. All employees start with EMP, like EMP01, EMP02, EMP03. All inventory items could start with I, like I100 for pens, I101 for notebooks. This way, just by looking at the code, you can guess what type of account it belongs to, and that makes life a lot easier. Let's summarize everything we learned today. You've done great so far. Let's bring everything together. In accounting, we use codes to organize and identify information quickly. Every account gets a unique code, like a fingerprint, so there's no confusion between similar names. We use coding for customers, suppliers, employees, products, and more. There are two kinds of codes: internal codes, created by the business; external codes, like bank account numbers and sort codes. Coding saves time, reduces errors, improves clarity, and helps computers run more efficiently. A good coding system is logical, consistent, and easy to understand. Let's test your understanding. Mini quiz time. Here are a few quick questions to think about. Try answering them in your head. 1. Why do businesses give each account a unique code? 2. What might happen if two employees or customers have the same name and no code? 3. Can you give an example of an internal code and an external code? Take a moment, and if you answered those correctly, great job. Wrapping up. That's the end of today's lecture on methods of coding data. I hope this helped you understand how important coding is in accounting and how it makes business operations smoother, faster, and more organized. Don't forget to review your notes, and if you have questions, write them in the comments. In our next lesson, we'll continue building your accounting knowledge step by step. Thanks for joining me today, and remember, learning accounting is like learning a new language, one small step at a time. You've got this. What is general ledger coding and why is it so important? Hello, dear students, and welcome back to our exciting FIA FA1 journey. Today, we're going to learn about something very important in accounting, coding in the general ledger. Now, I know it sounds a little serious, but don't worry. I will explain it slowly, simply, and with real examples, so that even if this is your first time studying accounting, you will understand everything clearly. Let's begin with this question. What is a general ledger? Think of the general ledger as the main book of the business. It is like a big diary where the business writes down all the financial activities, every payment, every sale, every salary, and every expense. But here's the thing. This general ledger is not small. It has many accounts, sometimes hundreds or even thousands. So, how do we stay organized when there are so many accounts? That's where coding comes in. Each account is given a special number. We call this an account code. Just like every person has a phone number or every house has an address, every account in the ledger gets its own code. This makes it faster, easier, and clearer to find and record information. Let's look at how it works. Let's see some real examples of account codes. Here is a list of some example account codes. These are not from a real business. They are just for learning, but they show you how real businesses use codes. I will read them out for you. Code 100,200 for plant and machinery cost. Code 100,300 for motor vehicles. Code 100,201 for plant and machinery depreciation. Code 300,000 for trade receivables. This means money that customers owe the business. Code 400,000 for trade payables. This means money the business owes to suppliers. Code 500,130 for wages and salaries. Code 500,140 for rent and rates. Code 500,150 for advertising expenses. Code 600,000 for sales. Code 700,000 for cash. Now these codes may look long, but they are not random. The numbers actually mean something, and this is the smart part of coding. What are significant digit codes? Now let me teach you a new term, significant digit codes. Don't worry, it sounds difficult, but it's actually simple. Significant digit coding is a method where the first digit or the first few digits of the account code tell us what kind of account it is. Let's see an example together. If the code starts with the number 1, it usually means it is a non-current asset. Things like machinery, equipment, or vehicles that the business uses for a long time. If the code starts with 3, it usually means receivables, money that is going to come in from customers. If it starts with 4, it usually means payables, money the business owes to others. If it starts with 5, it is for expenses, like salaries, rent, or advertising. If it starts with 6, it is for sales, money the business earns. If it starts with 7, it usually means cash or money in the bank. So just by looking at the code, you can guess what type of account it is. That's why we say the digits are significant. They give us useful information. For example, 500,130 is an expense for wages and salaries. 600,000 is for sales, which is income. 700,000 is for cash, the money the business has in hand. This helps everyone, the accountant, the bookkeeper, even the computer system, to understand and organize data quickly. Why is using the correct code so important? Now let's imagine something. Suppose a customer pays money to the business. This payment should go into the receivables account, maybe something like 300,000. But what if, by mistake, the payment is recorded under wages and salaries instead? What would happen? That's right, the records would be wrong. The customer's account would still show that they haven't paid, even though they did. And the business would show that it spent money on salaries that it didn't. You see, just one wrong code can cause a lot of confusion. That's why we say, correct coding is very, very important. Using the wrong code can give you incorrect reports, make the business look unprofessional, create problems with auditors or tax authorities, and even cause loss of money. So always remember, before you post a transaction, always double-check the code. How do businesses create their coding system? Now let's talk about who decides these codes. Is there a worldwide rule? No. Every business creates its own coding system based on what works best for them. But smart businesses follow a logical and easy-to-understand pattern. Let me give you an example of a common structure. Codes starting with 1 equals non-current assets, like machines, buildings. Codes starting with 2 equals current assets, like inventory or cash. Codes starting with 3 equals trade receivables. Codes starting with 4 equals trade payables. Code starting with 5 is expenses. Code starting with 6 equals sales, revenue. Code starting with 7 equals cash or bank accounts. So when someone sees a code starting with 5, they know it is some kind of expense. And when they see a code starting with 6, they know it's income from sales. This system is called significant digit coding, and it makes accounting clear, fast, and accurate. Let's review what we learned today. Before we end the lesson, let's quickly go over what you've learned. The general ledger is the main book where all financial information is recorded. Every account in the ledger is given a code. This is like its name or ID. These codes help us identify accounts quickly and avoid mistakes. We use a system called significant digit coding, where the numbers in the code tell us what kind of account it is. Different starting digits mean different account types. For example, 1 equals non-current assets, 3 equals receivables, 4 equals payables, 5 equals expenses, 6 equals sales, 7 equals cash. Using the correct code is very important. One mistake can lead to wrong reports, confusion, and loss of trust. Wrapping up, thank you so much for joining me today. We learned a lot about how coding works in the general ledger, why the codes are carefully designed, and how they help keep accounting records accurate, clear, and professional. If you enjoyed this video, please give it a thumbs up, leave a comment, and subscribe for more beginner-friendly accounting lessons. And remember, every great accountant started as a beginner just like you. Take your time, ask questions, and keep learning. You are doing amazing. See you in the next lesson. Good morning, class. Today we're starting a very important new topic, and this one is all about how businesses use systems to manage their accounting. It's called manual and computerized accounting systems. Now don't worry, I know it sounds a little technical, but I promise you, I'll explain it step by step. You'll see examples. You'll understand why businesses use these systems. And by the end of the lesson, you'll be able to tell me exactly how they work. The book tells us that we should understand two things. The function of these systems, that means what they do, and the importance of these systems, that means why they matter. Most businesses today use some kind of computer system to manage their accounting. But here's the interesting part. Not all systems are the same. Some small businesses might just use one simple PC. That's a personal computer like your laptop. Bigger companies like banks or international corporations might use very large and powerful systems called mainframe computers. But wait, not all businesses have gone digital. Some small businesses still use manual systems. That means they write everything by hand in notebooks or physical ledgers. Imagine that. So now let's understand how these systems actually work. All accounting systems, especially computerized ones, follow a three-step process. Step 1, input. Let's say you just sold something to a customer or paid rent for your shop. You need to enter that information into the system. That's what we call input. So input simply means typing data into the computer or writing it into the ledger manually. For example, customer name, amount, invoice number, date. Step 2, processing. Once the data is entered, the system needs to work on it. This could mean sorting the information, calculating totals matching payments with invoices, updating customer balances. This is what we call processing. The computer, or even your brain in a manual system, does the math and organizes the data. Step 3, output. Finally, we need the result. We need a report, a summary, or a statement. This is called output. Examples include a profit and loss statement, a balance sheet, a list of customers who still owe you money. So remember, class, input is what we give the system, processing is what the system does, and output is what we get back. Here, the book talks about why computerized accounting systems are so useful, especially for modern businesses. Let me ask you a question. What happens when a company has to handle thousands of transactions every day? Can they really do all of that with pen and paper? Of course not. That would take forever. That's why the main advantage of computerized systems is that they can process a lot of data in a very short time. They are also much more accurate than doing everything by hand. Computers don't get tired. They don't make spelling mistakes unless the person types it wrong. They calculate things instantly. But hold on, computer systems aren't perfect. There's a small issue called the lack of audit trail. Have you ever heard someone say, "You never know what's going on inside that funny box"? That means we can't always see what the computer is doing behind the scenes. If something goes wrong, like a wrong balance or a missing transaction, it's sometimes hard to know where the mistake happened or who did it. That's what we mean by lack of audit trail. So that's one risk of using a fully computerized system. Manual versus computerized. What's different? Even though manual and computer systems do the same tasks, they do them differently. Let me break it down. 1. How information is stored. Manual. On paper, in books. Computerized. In computer files, digital, and can be printed or seen on screen. 2. How tasks are done. Manual. You calculate, write, and file everything yourself. Computerized. You click through a system and it helps you complete the tasks. 3. Automation. Manual. Nothing happens unless you do it. Computerized. The system can do some things automatically, like adding totals or updating balances. Let's take one example. Journal entries. These are very common in accounting. In a manual system, you would write each journal entry by hand. But in a computerized system, it's different. You don't need to write it. Instead, you click a menu option, choose New Journal or Reverse Journal, and the system creates it for you. This makes everything faster. And yes, it also reduces the chance of making a mistake. Final benefits. What else can computers do? Let's end with one big benefit. Computerized systems can be told to do things automatically. For example, want to reverse a journal? The system can do it for you. Want to repeat a transaction every month? The system can schedule it. Need totals updated the moment you enter data? The system does it instantly. This is the power of automation. It saves time. It reduces mistakes. It helps businesses grow without hiring more people. All right, class, that's the end of today's lesson on manual and computerized accounting systems. I hope it's clear now how these systems work, how they differ, and why most businesses today prefer using computers. But don't forget, manual systems still exist and are useful in small setups. Part 1. 7.1 Data Entry Errors, according to the FIA FA1 book. All right, class, let's begin. Imagine you're working in a company where you need to record sales, purchases, or payments into a computer system. Who does this job? Usually a data entry clerk or an accounts assistant. That means you'll be responsible for typing the right numbers in the right place. But here's the problem. Open quote. According to Section 7.1 of the FIA FA1 book, data entry errors are one of the biggest risks in computerized accounting systems. If the data is entered wrongly, then the system will process wrong results, leading to serious consequences like inaccurate reports, wrong balances, or even legal trouble. Close quote. Let's now go through the 6 major reasons for data entry errors, and I'll give real-life examples for each one. Common data entry errors from FIA FA1 Book Section 7.1. 1. Source documents can be damaged or destroyed. Example. A supplier invoice is left near a printer and someone spills coffee on it. Now the price is unreadable. This can lead to the wrong amount being entered, or no entry at all. 2. Poor handwriting can make forms hard to read. Example, someone writes 3107-2023, but it looks like 1101-2023 because of messy writing. The clerk types it wrongly, and now the sale shows up in the wrong month. 3. Incorrect or missing details in source documents. Example, a receipt is missing the tax code or has the wrong customer number. The entry might go to the wrong account, causing future confusion and reconciliation errors. 4. Transcription errors. This means copying something incorrectly from paper to screen. Examples, typing 54 instead of 45, entering 5,000 instead of 500, using the wrong date format like 2023-11-07 instead of 07-11-2023. Even one digit wrong can mess up reports, especially in financial data. 5. Poorly trained staff. If the person entering the data doesn't understand accounting, they might enter expense as income, confuse debit and credit, post to the wrong ledger. My cousin once worked in a warehouse and had to enter stock items into the system. He entered 200 chairs as $200 instead of quantity 200. The inventory reports were a disaster. 6. Malicious intent, fraud, or dishonesty. Yes, sadly, this happens too. Example, an employee intentionally changes the numbers to hide stolen money or overstates sales to earn a performance bonus. According to the FIA FA1 book, these types of errors can happen before the system even processes anything, and they affect the reliability of the entire accounting process. But we're not done yet. Even if the clerk enters the data correctly, the system itself can have issues. Software bugs, corrupted files, Incompatibility with other programs. Real-life impact. A small typo in a payment amount or a customer's name can delay payments, cause tax filing errors, mislead the business about its profit, make auditing and reconciliation harder. That's why the next part is very important. Part 2, 7.2, Reducing Data Entry Errors. Now that we know how errors happen, let's talk about how to stop them before they happen. As your teacher, I always say, prevention is better than correction. Let's now look at the methods recommended by the FIA FA1 book and expand them with some real-world context. How to reduce data entry errors. 1. Properly trained and experienced staff. Trained staff understand what they're doing, spot mistakes early, know how to use the software efficiently. A company might invest in short courses, training manuals, or shadowing senior staff. 2. Automatic data entry tools. Examples: barcode scanners, OCR software, optical character recognition, mobile apps that snap a photo of a receipt and autofill the data. This reduces the chance of human error and speeds up the process. 3. Well-designed forms that are easy to read. Good forms have clear headings, are logically ordered, use enough space to avoid cramping. Example: a purchase order form with separate sections for supplier info, items, prices, and tax codes. 4. Data entry screens that mirror the source document. This means the screen layout matches the paper document. For example, if the invoice has name, item, quantity, price, then the data entry form should follow the same structure. This reduces confusion and makes errors less likely. 5. Using tick boxes or drop-down lists. Example: instead of typing cash, bank, or card manually, just click from a drop-down list. This eliminates spelling errors or invalid inputs. 6. Avoiding long sequences of numbers. People make more mistakes when typing something like 87423154827. It's better to break it up into smaller chunks, use barcodes or autofill features when possible. 7. Double entry verification. This is where the data is entered twice, either by two people or once by the same person, and again for checking. In many companies, someone enters the payroll and another person double checks before it's approved. 8. Validation techniques. The system automatically checks for errors. Date can't be in the future. Quantity can't be negative. Customer ID must match existing records. Many accounting software programs, like Sage, QuickBooks, or Xero, include built-in validations to prevent common errors. Example story. Imagine a business entered $5,000 as a payment from a customer, but the actual amount was $500. Because there was no verification, the customer was shown as overpaying by $4,500. Months later, during an audit, the error was found, and the company had to refund money it never received. Final advice for students. Pay attention to small details. Double-check your entries. Always ask if something looks suspicious. Learn how the system works, not just where to click. And remember, your accuracy matters. Hello students. Today, we're going to learn about something very important in accounting called validation. This lesson is from section 7.3 of your FIA FA1 book. We will explain what validation means, why it is useful, and what types of validation are used in computer systems for accounting. You do not need to know big or difficult words. I will explain everything step by step, just like your classroom teacher sitting with you and helping you understand it in a very simple way. What is validation? Let's start with the main question. What is validation? Validation means checking the information data that you enter into a computer. The computer asks, does this look like the correct type of information? Is anything missing? Is this number too big or too small? Is it in the right format, style? If the information looks good, the system accepts it. If it looks wrong or something is missing, the system will stop you and give you an error message. Important, validation does not check if your answer is true. It only checks if your answer looks right. Example: you want to write the price of a product as $314.25, but you type it wrongly as $134.25. The computer will say, "Looks okay," because the number is typed correctly. But it is still wrong, because you entered the wrong amount. So validation only checks the format and if the rules are followed. It doesn't know your mind or your real intention. Let's learn the 6 main types of validation. There are 6 main validation techniques that help a computer check your information. We will now learn each one in a very clear and easy way. Number 1, field presence check. What does this do? This checks if you forgot to enter something important. Think of it like this. You are filling out a school form. If you forget to write your name or your address, the form is not complete. In accounting, some fields are required. If you leave them empty, the computer shows an error. Example 1. You are making an invoice for a customer. You forget to write the customer's delivery address. The system will stop you and say, "Please enter the address." Example 2. You are recording a payment but forget to write the date. The system will not allow you to continue. Why this is important? If we leave important boxes empty, the report or form will not work correctly. It may confuse people or stop the business from doing its work properly. Number 2, field length check. What does this do? This checks if the number of letters or digits is too short or too long. Think of it like this. Some boxes only want exactly 6 numbers. If you write 4 or 10, the computer says error. Example 1. You need to write a date as 15.12.x2. This is 6 characters. If you only write 15.112, it is too short. Error. Example 2. A student ID needs to be 8 characters like stud1234. If you type only ST1, it is too short, invalid. Why this is important? If the information is the wrong length, the system cannot store it or understand it correctly. It might break reports or cause problems later. Number 3, range check. What does this do? It checks if a number is within the allowed limit. There is a minimum and maximum value. Think of it like this. If you enter the month number, it must be between 1 and 12. If you write 13 or 0, error. Example 1. You type month equals 13, error. There are only 12 months. Example 2. Employee hours worked. Allowed hours are between 0 and 80. You type 100 hours, invalid. Why this is important? This prevents unrealistic or impossible values. It also stops mistakes like typing extra zeros. Number 4, format check. What does this do? It checks if the data follows the correct pattern or structure. Think of it like this. The computer wants things in a certain style. For example, a customer code might need to look like AAA999, 3 letters / 3 digits. Example 1. You type JKT123. This is good. You type 12JKT or JKT1234. Wrong format. Example 2. Phone number must be 604-123-4567. You type 604-13456. Error. It is missing brackets and dashes. Why this is important? If the format is wrong, the computer cannot match or organize the data. For example, emails without @ will never work. Number 5, batch header check. What does this do? It checks if the total of many entries matches the amount you told the system. Think of it like this. You say you will enter 10 payments and the total is $5,000. But after entering the payments, the system calculates only $4,800. The system says, warning, check your entries. Example 1. You are entering 20 invoices. The total should be $12,500. You entered only $12,200. Error. Example 2. Payroll for staff should be $25,000. Your entries total $30,000. Something is wrong. Why this is important? It helps find mistakes like typing the wrong amount, skipping an entry, or entering one payment twice. Number 6. Check digit. What does this do? It checks a number by doing a mathematical test. This type of validation adds a special digit at the end of the number. The system uses a formula to check if your number is typed correctly. Think of it like this. It's like a secret code at the end that proves your number is real. Example 1. Bank account number is 123456778. The system adds check digit. 3 final number equals 123456783. If you type 123456784, error. Example 2. Book ISBN number is 97836148410. The 0 at the end is the check digit. Why this is important? It helps catch typing mistakes like changing the order of numbers or adding one extra by mistake. Teacher's final advice validation is like a helpful friend inside your accounting system. It tells you, wait, you forgot something. That number looks too big. Please use the correct format. It protects your business, saves time, and makes you look professional. Always read error messages. Always double-check your work. This complete lesson comes from Section 7.3 of your official FIA FA1 textbook. FIA FA1, Batch Processing and Control Totals, Full Beginner-Friendly Classroom Lecture. Welcome, amazing students. Hello, everyone, and welcome back. Today, we are going to learn a very useful lesson from your FIA FA1 accounting book. This topic is not only important for your exam, but it is also something that accountants use every single day at work. We are going to learn two very important concepts: batch processing, control totals. Let me explain everything slowly and clearly. If your first language is not English, don't worry. I'll give you real-life examples, easy explanations, and repeat important ideas so you understand 100%. What is batch processing? In accounting, batch processing means that similar transactions, like sales invoices or payments, are grouped together into one big collection called a batch. Then, the computer processes the whole batch one time instead of one by one. Easy example. Let's imagine you are sending 50 envelopes to different people. Option 1. You take one envelope to the post office each day for 50 days. Option 2. You take all 50 envelopes to the post office in one visit. Which one is better? Of course, the second one. It's faster and easier. This is exactly what batch processing does. It groups similar transactions together so that they can be entered into the computer all at once. This saves time, effort, and money. Why is batch processing so important? Let's say you work in a company that creates a lot of sales every day. The business sends hundreds of invoices to customers. If you enter them one by one, it takes a lot of time. It is boring. You can easily make mistakes. But when you use batch processing, it is faster. It saves money. It reduces errors. That's why almost all accounting systems use batch processing for daily work. How big can a batch be? The size of a batch depends on a few things. The number of transactions, 10 or 100 or even 1,000. The type of transaction, sales, payments, refunds. The software or system limit. Some systems may allow only a certain number of entries per batch. Important, batch processing is different from real-time processing. Real-time processing means the transaction is processed right away, as soon as you enter it. Batch processing waits until all the transactions are ready, and then processes them together. What are control totals? Now let's talk about the second part of the lesson, control totals. Control totals help you to make sure everything is correct when entering a batch of transactions. Step-by-step explanation. Step 1. Before entering a batch into the computer, you manually add up all the amounts using a calculator or paper. This total is your control total. Step 2. You then enter all the data into the computer. The system also adds the total by itself. Step 3. The system compares your total with its total. If the two totals match, it means everything is okay. If the totals are not the same, it means something is wrong. Real-life example. Let's say you have a batch of 30 sales invoices. You add up the amounts using a calculator and get $42,378.47. Then you enter all 30 invoices into the accounting software. The system also calculates the total. If the system says the total is also $42,378.47, great, everything matches. You're good to go. But what if the computer shows only $42,178.47? Oh no! Now the total is $200 less than your manual total. This means you may have forgotten to enter one invoice. You may have typed the wrong amount. You may have made a mistake while calculating SULIS. Now you have to go back and check everything again to find the mistake. The batch will not be accepted until you fix the problem. Why are batch processing and control totals so important? They help you save time, avoid mistakes, stay organized, work faster, be more professional. Let's compare. Without batch processing, it takes a long time. More errors, expensive to do, messy records. With batch processing, much faster, fewer mistakes, more efficient, organized system. Now, control totals help by making sure you entered everything correctly, catching any missing or wrong entries, protecting your reports and financial results. Final summary. Let's review the main points. Batch processing equals entering a group of similar transactions into the computer at one time instead of one by one. Control totals, manually adding up the total before entry and comparing it with the total after entry by the system. If the totals match, you are safe. If not, there is an error that must be corrected. Teacher's final advice. Being fast is good, but being accurate is better. Batch processing helps you go fast. Control totals help you avoid mistakes. Use both like a smart accountant. You are not just entering numbers, you are making sure the company's records are right and trustworthy. Welcome, dear students. Hello to all of you future accountants and financial professionals. I'm so glad you're here today. We are going to learn one of the most important and practical topics in your FIA FA1 course, accounting systems. This lesson comes straight from Chapter 3, Part 9 of your FIA FA1 textbook. But don't worry. Even if this is your first time hearing about accounting systems, and even if English is not your first language, I will explain everything slowly, clearly, and in simple, everyday English. Our goal is to understand what accounting systems are, how they work, and why they are so important in the modern business world. So, get ready to learn with real-life examples, clear explanations, and practical knowledge that will help you both in your exams and in your future job. Let's begin. Introduction. Before we dive into studying the accounting system, it's important to understand what a system is and how it works. This will give you a solid foundation and make it easier to grasp the concepts of an accounting system. What is a system? Definition of a system. A system is a collection of parts or components that work together to achieve a common goal. Each part of the system plays a specific role and contributes to the overall functioning of the system. Components of a system. 1. Inputs. These are the resources, information, or materials that are put into the system. Inputs are necessary for the system to start functioning. 2. Processes. These are the actions or steps taken to transform the inputs into outputs. Processes are the core activities within the system. 3. Outputs. These are the results or products that come out of the system after the inputs have been processed. 4. Feedback. This is the information that is fed back into the system to ensure it is working correctly and to make any necessary adjustments. Feedback helps improve the system's performance. How does a system work? Step-by-step operation. 1. Inputs. Enter the system. Inputs can be anything from raw materials, data, energy, or information. These are essential resources that the system needs to function. 2. Processing the inputs. Once the inputs are gathered, the system starts processing them. This involves various actions, calculations, or transformations that turn the inputs into useful outputs. The processing part is where most of the work happens. 3. Producing outputs. After processing, the system generates outputs. These outputs are the final products, results, or services that the system aims to produce. The quality and quantity of outputs depend on how well the system processes the inputs. 4. Receiving feedback. To ensure the system is functioning correctly, feedback is collected. Feedback provides information about the performance of the system, highlighting any issues or areas for improvement. This information is crucial for making adjustments and enhancing the system's efficiency. Characteristics of a system. Interconnected components. All parts of a system are interconnected. This means that a change in one part can affect the other parts and the system as a whole. Goal-oriented. A system is always designed to achieve a specific goal or objective. All components work towards this common goal. Boundaries. A system has defined boundaries that separate it from its environment. These boundaries determine what is inside the system and what is outside. Environment interaction. Systems interact with their environment. Inputs come from the environment, and outputs are delivered back to the environment. The system must adapt to changes in its environment to remain effective. Feedback mechanism. Feedback is a critical component that helps the system to self-regulate and improve. Without feedback, the system cannot adjust to changes or correct any deviations from its goals. Types of systems. Open systems. These systems interact with their environment and are influenced by external factors. They receive inputs from the environment and send outputs back. Most real-world systems are open systems. Closed systems. These systems do not interact with their environment. They are self-contained and operate independently of external influences. Closed systems are rare and typically exist only in controlled environments. Subsystems. Larger systems are often made up of smaller subsystems. Each subsystem has its own specific function, but contributes to the overall goal of the main system. Understanding subsystems helps in managing complex systems more effectively. Importance of understanding systems. Efficiency. Understanding how systems work can help improve efficiency. By knowing the inputs, processes, and outputs, you can identify areas for improvement and optimize the system. Problem solving. When problems arise, understanding the system helps you pinpoint where things are going wrong. You can then focus on the specific part of the system that needs adjustment. Innovation. Knowledge of systems can drive innovation. By understanding the components and how they interact, you can develop new ways to enhance the system or create entirely new systems. Adaptability. Systems must adapt to changes in their environment to remain effective. Understanding the feedback mechanism and how the system interacts with its environment is crucial for making necessary adjustments. Conclusion. By understanding what a system is and how it works, you'll be better prepared to study accounting systems. You'll see how different components of the accounting system interact, how they process financial data, and how the outputs help businesses make informed decisions. This foundational knowledge is key to grasping more complex concepts in accounting systems. An accounting system is a structured process used by organizations to record, categorize, analyze, and report their financial transactions. Its main objective is to provide accurate, timely, and relevant financial information that supports decision-making, compliance, and efficient management of resources. Here's a detailed breakdown of an accounting system and its objectives, along with examples. Components of an accounting system. 1. Source documents. Invoices. Bills sent to customers for goods sold or services rendered. Receipts. Proof of payment received from customers. Purchase orders. Documents authorizing the purchase of goods or services. Bank statements, monthly summaries of bank transactions. 2. Journals, sales journal, records all sales transactions. Purchases journal, records all purchases made by the company. Cash receipts journal, logs all cash inflows. Cash payments journal, logs all cash outflows. 3 ledgers. General ledger, the master set of accounts summarizing all financial transactions. Subsidiary ledgers, detailed accounts supporting the general ledger, such as accounts receivable and accounts payable ledgers. 4. Trial balance, a statement that lists all the balances of the general ledger accounts to ensure that debits equal credits. 5. Financial statements. Income statement shows the company's revenues and expenses over a specific period, resulting in net profit or loss. Balance sheet provides a snapshot of the company's assets, liabilities, and equity at a specific point in time. Cash flow statement highlights the cash inflows and outflows from operating, investing, and financing activities. Objectives of an accounting system. 1. Accurate record keeping. Ensure all financial transactions are recorded accurately and systematically. Example, using double-entry bookkeeping to record both the debit and credit aspects of a transaction ensures accuracy and helps detect errors. 2. Financial reporting. Generate financial statements that reflect the company's financial performance and position. Example, quarterly financial statements help management and stakeholders assess the company's profitability and financial health. 3. Compliance and legal requirements. Adhere to accounting standards and regulatory requirements. Example, companies must comply with IFRS or GAAP standards, and an accounting system helps ensure that financial reporting meets these guidelines. 4. Decision-making support. Provide relevant financial information to support strategic and operational decisions. Example, a manager uses cost analysis reports to decide whether to continue or discontinue a product line. 5. Internal control and fraud prevention. Establish controls to safeguard assets and prevent fraud. Example, implementing separation of duties where the person who authorizes a transaction is different from the one who records it. 6. Budgeting and forecasting. Assist in preparing budgets and financial forecasts to plan for future activities. Example, a company uses past financial data and trends from the accounting system to create next year's budget. Examples of accounting systems. 1. Manual accounting system. Traditional method using physical ledgers and journals. Example, small businesses using handwritten ledgers to track income and expenses. 2. Computerized accounting system. Use of accounting software to record and process financial transactions. Example, QuickBooks or Sage, which automate data entry and report generation. 3. Enterprise resource planning (ERP) systems. Integrated systems that manage all aspects of a business, including accounting, inventory, and human resources. Example, SAP or Oracle ERP, which provide comprehensive modules for financial management. Example scenario. Imagine a small retail business, Elegant Dresses, which sells clothing both in-store and online. 1. Source documents. Elegant Dresses receives supplier invoices for new stock and issues sales receipts to customers. 2. Journals. The bookkeeper records all sales in the sales journal and all inventory purchases in the purchases journal. 3. Ledgers. The transactions are posted from the journals to the general ledger, which summarizes all financial activities. 4. Trial balance. At the end of the month, the bookkeeper prepares a trial balance to ensure that total debits equal total credits. 5. Financial statements. Quarterly, the accountant prepares the income statement, balance sheet, and cash flow statement to review the business's financial health. 6. Decision-making. The owner reviews the financial statements and decides to increase marketing efforts for best-selling items based on the sales data. 7. Internal controls. To prevent fraud, the cash register system requires a manager's approval for all refunds. By maintaining an accurate and comprehensive accounting system, Elegant Dresses can effectively manage its finances, comply with legal requirements, and make informed business decisions. An accounting system is crucial for every business, regardless of its size or industry. Here are the key reasons why an accounting system is important and why every business must have one. Importance of an accounting system. 1. Accurate financial records. An accounting system ensures that all financial transactions are recorded accurately and systematically. This is essential for maintaining the integrity of financial data and avoiding errors. 2. Financial reporting. An accounting system allows businesses to generate financial statements, such as the income statement, balance sheet, and cash flow statement. These reports provide a clear picture of the company's financial performance and position. 3. Legal and regulatory compliance. Businesses must comply with various accounting standards and regulatory requirements. An accounting system helps ensure that financial reporting meets these standards, reducing the risk of legal penalties. 4. Decision-making support. Accurate and timely financial information is crucial for making informed business decisions. An accounting system provides the necessary data to support strategic planning, budgeting, and forecasting. 5. Internal control and fraud prevention. An accounting system establishes controls to safeguard assets and prevent fraud. By implementing checks and balances, it reduces the risk of financial mismanagement and ensures the accuracy of financial data. 6. Tax preparation. An accounting system simplifies the process of preparing and filing tax returns. It ensures that all financial transactions are properly documented and categorized, making it easier to calculate tax liabilities. 7. Efficient financial management. An accounting system streamlines financial processes such as invoicing, payments, and payroll. This improves operational efficiency and allows businesses to manage their resources more effectively. 8. Tracking financial performance. By maintaining accurate financial records, businesses can track their performance over time. This helps identify trends, measure progress, and set future goals. 9. Enhancing credibility. Reliable financial reporting enhances the credibility of a business. Stakeholders, such as investors, creditors, and customers, are more likely to trust a company that maintains transparent and accurate financial records. 10. Supporting business growth. As businesses grow, their financial transactions become more complex. An accounting system scales with the business, providing the necessary tools to manage increased financial activities and support expansion. Why every business must have an accounting system. 1. Foundation for success. An accounting system lays the foundation for a successful business. It provides the necessary infrastructure to manage finances effectively and supports overall business operations. 2. Legal obligation. Many jurisdictions require businesses to maintain accurate financial records and comply with accounting standards. An accounting system helps fulfill these legal obligations. 3. Improved financial management. With an accounting system in place, businesses can better manage their cash flow, monitor expenses, and optimize their financial performance. This leads to better financial health and sustainability. 4. Facilitates growth and expansion. As businesses expand, their financial needs become more complex. An accounting system provides the tools and processes to handle increased financial activities, making it easier to scale operations. 5. Competitive advantage. Businesses that use an accounting system can gain a competitive edge by making informed decisions, managing resources efficiently, and maintaining financial stability. This positions them better in the market. 6. Building trust. Transparent and accurate financial reporting builds trust with stakeholders. Investors, lenders, and customers are more likely to engage with and support businesses that demonstrate financial integrity. In summary, an accounting system is essential for the accurate recording, reporting, and management of financial information. It supports compliance, decision-making, internal control, tax preparation, and overall financial management. Every business, regardless of size, needs an accounting system to ensure financial accuracy, legal compliance, and sustainable growth. There are several types of accounting systems that businesses can use to manage their financial transactions and reporting. Each type has its own features and is suited to different business needs. Here are the main types of accounting systems. 1. Manual accounting system. Description. A manual accounting system involves recording financial transactions by hand in physical books or ledgers. It relies on paper-based documents and physical journals to track financial activities. Features. Uses paper journals and ledgers. Transactions are recorded manually. Requires significant time and effort to maintain. Prone to human errors. 2. Computerized accounting system. Description. A computerized accounting system uses accounting software to record, process, and store financial transactions electronically. It automates many accounting tasks, reducing the likelihood of errors and increasing efficiency. Features. Utilizes software to automate accounting processes, provides real-time financial data and reporting, reduces manual data entry and human error, can generate various financial reports quickly, improves accuracy and efficiency. 3. Single entry accounting system. Description. A single entry accounting system records each financial transaction as a single entry in the accounting records. It is a simple system, often used by small businesses with straightforward financial transactions. Features. Records each transaction only once, similar to maintaining a checkbook register. Simpler to manage but less comprehensive. Does not track assets and liabilities comprehensively. 4. Double entry accounting system. Description. A double entry accounting system records each transaction as both a debit and a credit in two separate accounts. This system provides a more complete and accurate picture of a company's financial position. Features. Each transaction affects at least two accounts. Ensures that the accounting equation, assets equals liabilities, equity, always balances. Reduces errors and provides a more accurate financial picture. Standard method for most businesses. 5. Cash basis accounting system. Description. A cash basis accounting system records financial transactions only when cash is received or paid. It is a straightforward method often used by small businesses and individuals. Features. Records income when cash is received. Records expenses when cash is paid out. Simple and easy to implement. Does not account for receivables or payables. 6. Accrual basis accounting system. Description. An accrual basis accounting system records financial transactions when they are earned or incurred, regardless of when cash is exchanged. This method provides a more accurate picture of financial performance and position. Features. Records revenue when earned, not when received. Records expenses when incurred, not when paid. Provides a more accurate representation of financial health. Complies with generally accepted accounting principles, GAAP, and International Financial Reporting Standards, IFRS. 7. ERP, Enterprise Resource Planning Systems. Description. ERP systems integrate various business processes, including accounting, into a single comprehensive system. These systems are used by larger organizations to manage complex operations and provide real-time financial data. Features. Integrates accounting with other business functions like inventory, sales, and HR. Provides real-time data across the organization. Enhances decision-making and operational efficiency. Scalable to support business growth. 8. Cloud-based accounting systems. Description. Cloud-based accounting systems are online platforms that allow businesses to manage their finances over the internet. These systems offer flexibility, scalability, and access to financial data from anywhere with an internet connection. Features: accessible from any device with an internet connection, provides automatic updates and backups, enhances collaboration among team members, scalable and cost-effective for businesses of all sizes. In summary, businesses can choose from a variety of accounting systems based on their size, complexity, and specific needs. Manual and single-entry systems are suitable for very small or simple operations, while computerized, double-entry, accrual basis, ERP, and cloud-based systems are better suited for larger and more complex businesses. What is a computerized accounting system? A computerized accounting system is an accounting system that uses computer software to manage and record financial transactions. Unlike manual accounting systems, which rely on paper-based methods, computerized systems automate many of the tasks involved in accounting, making the process more efficient and accurate. Components of a computerized accounting system. 1. Hardware. Computers, desktops, laptops, or servers that run the accounting software. Peripherals, printers, scanners, and other devices used to input and output data. 2. Software. Accounting software, programs designed to handle financial data, perform calculations, and generate reports. Examples include QuickBooks, Sage, and Xero. 3. Database. Data storage, a centralized database that stores all financial transactions and records. This ensures data is organized and easily accessible. 4. User interface. Forms and fields for entering data, such as invoices, receipts, and payments. Menus and navigation. Tools that help users access different functions of the software, like generating reports or viewing account balances. 5. Security measures. Access controls, user permissions and roles to ensure that only authorized personnel can access sensitive financial information. Data encryption, protecting data from unauthorized access during transmission and storage. Key features of a computerized accounting system. 1. Automation, data entry. Automatic recording of transactions reduces the need for manual entry. Calculations, automated calculations for taxes, discounts, interest, and other financial figures. Reconciliation. Automatic bank reconciliation helps match the company's records with bank statements. 2. Real-time processing. Transactions are processed and recorded in real time, providing up-to-date financial information. 3. Reporting. Financial statements. Automatic generation of income statements, balance sheets, and cash flow statements. Custom reports. Ability to create custom reports tailored to specific business needs. 4. Data management, storage and retrieval. Efficient storage and quick retrieval of large volumes of data. Backup and recovery. Regular data backups to prevent loss of information and ensure data recovery in case of system failure. 5. Scalability, ability to handle increased data volumes and support business growth without significant changes to the system. Integration, integration with other business systems such as inventory management, payroll, and customer relationship management (CRM). 7. User-friendly interface, intuitive and easy-to-use interface that simplifies navigation and operation for users, even those with limited accounting knowledge. Advantages of a computerized accounting system. 1. Accuracy. Reduces human errors in calculations and data entry, ensuring more accurate financial records. 2. Efficiency. Speeds up the accounting process by automating repetitive tasks, allowing accountants to focus on analysis and decision-making. 3. Consistency. Ensures consistent application of accounting principles and standards across all transactions. 4. Accessibility. Provides easy access to financial data and reports from anywhere, especially with cloud-based systems. 5. Cost-effective. Reduces the need for extensive manual labor, lowering overall operational costs. Most commonly used accounting software. 1. QuickBooks. Overview. Developed by Intuit, QuickBooks is one of the most popular accounting software programs for small to medium-sized businesses. Features: invoicing, payroll, expense tracking, tax calculation, and financial reporting. Advantages: user-friendly interface, comprehensive feature set, and strong support community. Versions: available in desktop and online versions, catering to different business needs. 2. Sage. Overview. Sage offers a range of accounting solutions suitable for small businesses to large enterprises. Features: inventory management, invoicing, payroll, project management, and detailed financial reporting. Advantages: robust and scalable with industry-specific solutions and strong customer support. Versions include Sage 50 Cloud, Sage Intacct, and Sage Business Cloud Accounting. 3. Xero. Overview. Xero is a cloud-based accounting software designed for small to medium-sized businesses. Features: invoicing, bank reconciliation, expense management, payroll, and financial reporting. Advantages: easy to use, integrates well with other business applications, and offers real-time financial data. Versions: available in various plans to suit different business sizes and requirements. 4. FreshBooks. Overview. FreshBooks is a cloud-based accounting software aimed at small businesses and freelancers. Features: invoicing, time tracking, expense management, and financial reporting. Advantages: intuitive interface, strong customer support, and mobile app access. Versions: offers different pricing plans based on the number of clients and features needed. 5. Zoho Books. Overview. Part of the Zoho suite, Zoho Books is a cloud-based accounting solution for small to medium-sized businesses. Features: invoicing, expense tracking, project management, and detailed financial reporting. Advantages: integrates seamlessly with other Zoho applications, affordable pricing, and extensive automation features. Versions: offers multiple plans catering to different business sizes and requirements. 6. Wave. Overview. Wave is a free accounting software solution ideal for small businesses and freelancers. Features: invoicing, receipt scanning, expense tracking, and financial reporting. Advantages: cost-effective, free, user-friendly interface, and strong support for basic accounting needs. Versions: free version with optional paid services like payroll and payment processing. Conclusion: a computerized accounting system is essential for modern businesses as it enhances the accuracy, efficiency, and reliability of financial management. It automates many of the manual tasks involved in accounting, allowing businesses to focus on growth and strategic planning. Popular accounting software such as QuickBooks, Sage, Xero, FreshBooks, Zoho Books, and Wave offer a range of features and benefits tailored to different business needs, making them indispensable tools for managing finances effectively. Choosing the right accounting system for a business is a critical decision that can impact its financial health, efficiency, and growth. Here's a step-by-step guide to help beginners and those with no prior knowledge understand how to choose the right accounting system for their business. Step-by-step guide to choosing the right accounting system. 1. Understand your business needs. Before selecting an accounting system, it's essential to understand the specific needs of your business. Consider the following: size of the business. Small, medium, or large? The size will influence the complexity and scalability of the accounting system you need. Type of business. Different industries have different accounting requirements, e.g. retail, manufacturing, services. Number of users. How many people will need access to the system? This includes accountants, managers, and other employees. Budget. How much can your business afford to spend on an accounting system? Consider both initial costs and ongoing expenses. 2. Identify key features required. List the features that are essential for your business operations. Some common features to consider include basic accounting functions, invoicing, expense tracking, bank reconciliation, payroll management, calculating and managing employee salaries and wages. Inventory management is tracking stock levels, orders, and deliveries. Financial reporting, generating financial statements, tax reports, and custom reports. Project management, tracking the financials of individual projects. Multi-currency support, handling transactions in different currencies if you operate internationally. Integration, ability to integrate with other business software like CRM, ERP, and e-commerce platforms. 3. Consider ease of use. The accounting system should be user-friendly, especially for those without an accounting background. Look for intuitive interface, easy navigation and clear instructions. Customer support, availability of support through chat, email, or phone to help when needed. Training resources, availability of tutorials, guides, and training sessions to help users get up to speed. 4. Evaluate scalability. Choose an accounting system that can grow with your business. This means it should be able to handle increased transaction. Business grows, the number of transactions will increase. Additional users. More employees might need access to the system in the future. Advanced features. You might need more advanced features as your business operations become more complex. 5. Security is crucial for protecting your financial data. Consider the following security features. Data encryption ensures that your data is encrypted and protected from unauthorized access. User permissions allows you to control who has access to different parts of the system. Regular backups ensures that your data is regularly backed up to prevent loss. 6. Determine deployment options. Accounting systems can be deployed in different ways. Choose the one that suits your business. On-premises, installed on your local computers and servers, offers more control but requires IT resources for maintenance. Cloud-based, hosted online and accessible from anywhere with an internet connection, easier to maintain and often more cost-effective. 7. Check integration capabilities. Ensure the accounting system can integrate with other software you are using or might use in the future. CRM, Customer Relationship Management, for managing customer data and sales. ERP, Enterprise Resource Planning, for managing overall business processes. E-commerce platforms. If you run an online store, integration with your e-commerce platform is essential. Banking systems, for automatic bank reconciliation and transaction imports. 8. Consider cost. Evaluate the total cost of ownership, including initial purchase or subscription cost, the upfront cost of buying or subscribing to the software, maintenance and support fees, ongoing costs for support and updates, training costs, any costs associated with training your staff to use the system, upgrade costs, costs for adding new features or upgrading to a more advanced version. 9. Read reviews and get recommendations. Research and gather feedback from other businesses similar to yours. Online reviews. Check reviews on software comparison websites. Testimonials. Look for customer testimonials on the software's website. Recommendations. Ask for recommendations from business associates, accountants, or industry groups. 10. Request demos and trials. Before making a final decision, request a demo or take advantage of a free trial. Demos. A demo allows you to see the software in action and ask questions. Free trials. A trial period lets you test the software with your own data and see how it fits your business needs. Detailed example of the decision-making process. Imagine you own a small retail store called Trendy Fashions, and you need to choose an accounting system. Here's how you might go through the process. 1. Understand your business needs. Size, small business with potential for growth. Type, retail, dealing with inventory management and sales tracking. Users, you and one part-time accountant. Budget, limited budget but willing to invest in a good system. 2. Identify key features required. Basic accounting functions like invoicing, expense tracking, and bank reconciliation. Inventory management to track stock levels and reorder products. Financial reporting to generate income statements and balance sheets. Integration with your e-commerce platform to sync online sales data. 3. Consider ease of use. Look for a system with a simple and intuitive interface. Ensure good customer support is available. Check for training resources such as tutorials and guides. 4. Evaluate scalability. Choose a system that can handle more transactions as your business grows. Ensure it allows for adding more users in the future. Look for advanced features that might be needed as the business expands. 5. Assess security features. Ensure the system has data encryption. Check for user permissions to control access to sensitive information. Confirm that the system offers regular data backups. 6. Determine deployment options. Prefer a cloud-based system for ease of access and maintenance. 7. Check integration capabilities. Ensure the system can integrate with your e-commerce platform for seamless data syncing. Check for integration with your banking system for automatic reconciliation. 8. Consider cost. Compare the initial subscription costs of different systems. Check for any additional fees for support and upgrades. Calculate the total cost of ownership over the long term. 9. Read reviews and get recommendations. Read online reviews of different accounting software. Look for testimonials from other retail businesses. Ask for recommendations from other small business owners in your network. 10. Request demos and trials. Request demos from software providers like QuickBooks, Xero, and FreshBooks. Sign up for free trials to test the software with your business data. Conclusion. Choosing the right accounting system for your business involves understanding your specific needs, identifying key features, evaluating ease of use, scalability, security, integration capabilities, and cost. By following a systematic approach and considering all these factors, you can select an accounting system that not only meets your current requirements, but also supports your business's growth and future needs. Taking the time to research, read reviews, get recommendations, and test the software through demos and trials will help ensure you make an informed decision that benefits your business in the long run. How a computerized accounting system works. A computerized accounting system uses computer software to manage and record financial transactions. It automates many of the tasks involved in accounting, making the process more efficient and accurate. Here's a detailed explanation of how a computerized accounting system works, broken down into simple steps and concepts that even a beginner or someone with no accounting background can understand. 1. Input of financial data. The first step in a computerized accounting system is entering financial data. This includes all the money coming into the business, revenue, and all the money going out, expenses. Data entry. Users input data into the system using a computer or mobile device. This can include sales receipts, invoices, bills, and payroll information. Forms and fields. The software provides forms and fields where users can enter specific details about each transaction, such as the date, amount, and description. 2. Processing transactions. Once the data is entered, the software processes the transactions. This means it performs the necessary calculations and records the transactions in the appropriate accounts. Automated calculations. The system automatically calculates totals, taxes, discounts, and other financial figures, reducing the risk of human error. Journal entries. Each transaction is recorded as a journal entry, which includes details like the date, accounts affected, and amounts debited or credited. 3. Storing data. The system stores all the financial data in a centralized database. This ensures that the data is organized, secure, and easily accessible. Database. A database is a digital storage space where all the financial transactions and records are kept. It allows for quick retrieval and easy management of data. Backup and recovery. The system regularly backs up the data to prevent loss and ensures that it can be recovered in case of a system failure. 4. Generating reports. One of the key features of a computerized accounting system is its ability to generate various financial reports. These reports help business owners and managers understand the financial health of the business. Financial statements. The system can automatically generate financial statements such as income statements, balance sheets, and cash flow statements. Custom reports. Users can create custom reports to analyze specific aspects of the business, like sales trends or expense patterns. 5. Bank reconciliation. The system can automatically reconcile the business's records with its bank statements. This ensures that all transactions are accounted for and that there are no discrepancies between the business's records and the bank's records. Automatic reconciliation. The software matches the transactions recorded in the system with those on the bank statement, highlighting any discrepancies for further review. Error detection. This process helps detect errors or fraudulent transactions, ensuring the accuracy of the financial records. 6. Managing payroll. A computerized accounting system can also handle payroll management, ensuring that employees are paid accurately and on time. Payroll processing. The system calculates employee salaries, wages, taxes, and other deductions automatically. Payslips. It generates payslips for employees, detailing their earnings and deductions. 7. Integration with other systems. Many computerized accounting systems can integrate with other business systems such as inventory management, customer relationship management, CRM, and e-commerce platforms. Inventory management. Integration with inventory systems allows for automatic updates of stock levels and order processing. CRM integration. Connecting with CRM systems helps track customer payments and manage accounts receivable. E-commerce integration. For businesses that sell online, integration with e-commerce platforms ensures that sales data is automatically recorded in the accounting system. 8. Security and access control. Security is a crucial aspect of a computerized accounting system. It ensures that sensitive financial data is protected from unauthorized access. User permissions. The system allows the business owner to control who has access to different parts of the software. For example, only certain employees might have permission to view payroll information. Data encryption. The system encrypts data, making it unreadable to anyone without the proper authorization. Conclusion. A computerized accounting system automates and streamlines the process of managing a business's financial transactions. It involves inputting data, processing transactions, storing data in a secure database, generating reports, reconciling bank statements, managing payroll, integrating with other business systems, and ensuring data security. By using a computerized accounting system, businesses can save time, reduce errors, and gain valuable insights into their financial health. This helps them make better decisions and focus on growing their business. What is a cloud-based accounting system? A cloud-based accounting system is an online accounting software that allows users to access their financial data and perform accounting tasks over the internet. Unlike traditional accounting systems that are installed on a local computer or server, cloud-based systems are hosted on remote servers and accessed through a web browser. This setup offers numerous advantages in terms of accessibility, scalability, and security. Here's a detailed explanation of cloud-based accounting systems to help you understand the concept thoroughly. 1. Basic concept. A cloud-based accounting system stores all your financial data in the cloud, which is a term for servers accessible over the internet. This means you don't need to install the software on your local computer or worry about maintaining hardware or software updates. Remote servers. The software and your data are stored on powerful servers maintained by the service provider. Web access. You can access the system from any device with an internet connection, such as a laptop, tablet, or smartphone, using a web browser. 2. Accessibility. One of the main benefits of a cloud-based accounting system is that it allows you to access your financial data anytime, anywhere. Anytime access. You can log into your accounting system 24/7, which is especially useful for businesses that operate in multiple time zones or have remote employees. Multiple devices. Whether you're in the office, at home, or on the go, you can access your accounting system from any device with an internet connection. 3. Real-time updates. Cloud-based accounting systems provide real-time updates, meaning that any changes or transactions you enter are instantly reflected in the system. Real-time data. This ensures that your financial information is always up to date, which is crucial for making informed business decisions. Collaboration. Multiple users can work on the system simultaneously, with all updates being visible to everyone in real time. Security. Security is a major concern for any business, and cloud-based accounting systems are designed with robust security measures to protect your data. Data encryption. Your data is encrypted both during transmission, when it's being sent over the internet, and at rest, when it's stored on the server, making it unreadable to unauthorized users. Access controls. You can set permissions to control who has access to different parts of the system, ensuring that sensitive information is only accessible to authorized personnel. Regular backups. The service provider regularly backs up your data to prevent loss in case of a system failure or cyber attack. 5. Cost efficiency. Using a cloud-based accounting system can be more cost-effective than traditional accounting software. Subscription model. Most cloud-based systems operate on a subscription basis, meaning you pay a monthly or annual fee. This spreads the cost over time and eliminates the need for a large upfront investment. No maintenance costs. Since the service provider handles all the maintenance, updates, and security, you don't need to spend money on IT infrastructure or personnel. 6. Scalability. Cloud-based accounting systems are highly scalable, making them suitable for businesses of all sizes. Flexible plans. You can choose a plan that fits your current needs and easily upgrade as your business grows. Adding features. Many cloud-based systems allow you to add new features or modules as your business requirements change. 7. Integration. Cloud-based accounting systems often integrate seamlessly with other online business tools and applications. Integration with other systems. You can connect your accounting system with your CRM, ERP, e-commerce platform, payroll services, and more. This ensures that data flows smoothly between different parts of your business. APIs. Many cloud-based systems offer APIs, application programming interfaces, that allow you to create custom integrations or connect with third-party applications. 8. Automatic updates. One of the conveniences of cloud-based systems is that they are automatically updated by the service provider. Latest features. You always have access to the latest features and improvements without having to manually download and install updates. Security patches. The provider regularly updates the software with the latest security patches, protecting your data from emerging threats. Example to illustrate how it works. Let's take an example of a small business, Tech Solutions, that decides to use a cloud-based accounting system. 1. Subscription and setup. The owner subscribes to a cloud-based accounting system like QuickBooks Online or Xero. They set up their account by entering basic business information and configuring the settings according to their needs. 2. Data entry. The owner and their accountant can log in from their laptops, tablets, or smartphones to enter sales, expenses, and other financial transactions. All entries are processed in real time, and any updates are immediately visible to both the owner and the accountant. 3. Real-time access. While the owner is traveling, they can still access the system to check on the financial status of the business, review reports, and approve payments. The accountant working from home can simultaneously enter new transactions and generate financial statements. 4. Security and backups. The data entered by both the owner and the accountant is encrypted and securely stored on the provider's servers. The service provider performs regular backups, ensuring that the business's financial data is safe from loss or corruption. 5. Integration. Tech Solutions integrates their accounting system with their online store. Sales data from the store automatically syncs with the accounting system, reducing manual data entry. They also connect their payroll service, so employee salary details are automatically updated in the accounting system. 6. Cost management. Instead of paying a large sum up front for software, Tech Solutions pays a manageable monthly subscription fee. They don't need to worry about maintaining the software or purchasing additional IT resources, as the service provider handles everything. Conclusion. A cloud-based accounting system is an online solution that offers numerous benefits over traditional accounting software. It provides accessibility from any device with an internet connection, real-time updates, robust security, cost efficiency, scalability, seamless integration with other business tools, and automatic updates. For businesses like Tech Solutions, these advantages translate into more efficient operations, better financial management, and the flexibility to grow and adapt to changing needs. By understanding these key aspects, even those with no prior accounting knowledge can appreciate how a cloud-based accounting system can streamline their business processes and contribute to their success. How AI has affected accounting systems. Artificial intelligence, AI, has significantly transformed accounting systems, enhancing their capabilities and revolutionizing the way accounting tasks are performed. AI involves using machines and software to perform tasks that would normally require human intelligence, such as learning, reasoning, problem-solving, and decision-making. In accounting, AI technologies have automated many routine tasks, improved accuracy, and provided deeper insights into financial data. Here's a detailed explanation of how AI has affected accounting systems, broken down into simple steps and concepts to help you understand it thoroughly. 1. Automation of routine tasks. AI has automated many repetitive and time-consuming tasks that accountants used to do manually. This has not only increased efficiency, but also allowed accountants to focus on more strategic activities. Data entry. AI systems can automatically capture and enter data from various sources, such as invoices, receipts, and bank statements, into the accounting system. This reduces the need for manual data entry and minimizes errors. Invoice processing. AI can automatically scan, read, and process invoices. It can match invoices with purchase orders and receipts, ensuring that payments are made accurately and on time. 2. Enhanced accuracy and reduced errors. AI technologies have significantly improved the accuracy of accounting systems by reducing human errors and ensuring data consistency. Error detection. AI can identify and flag inconsistencies or anomalies in financial data. For example, it can detect duplicate entries, unusual transactions, or discrepancies between accounts. Reconciliation. AI automates the reconciliation process by matching transactions in the accounting system with those in bank statements or other financial records, ensuring that all entries are accounted for and accurate. 3. Improved financial analysis and reporting. AI has enhanced the ability of accounting systems to analyze financial data and generate insightful reports. Predictive analytics. AI can analyze historical financial data to predict future trends and outcomes. This helps businesses forecast revenue, expenses, and cash flow more accurately. Real-time reporting. AI enables real-time analysis and reporting, providing up-to-date financial information that helps businesses make timely and informed decisions. 4. Streamlined auditing and compliance. AI has streamlined the auditing process and improved compliance with financial regulations and standards. Automated audits. AI can perform continuous audits by analyzing transactions in real time. It can identify and flag suspicious activities, ensuring compliance with financial regulations. Regulatory compliance. AI systems can monitor changes in financial regulations and update the accounting system accordingly, ensuring that businesses remain compliant with the latest standards. 5. Enhanced decision-making. AI provides deeper insights into financial data, beta, enabling better decision-making. Data visualization. AI can create visual representations of financial data, such as charts and graphs, making it easier to understand and interpret complex information. Scenario analysis. AI can simulate different scenarios based on various assumptions, helping businesses evaluate the potential impact of different decisions and choose the best course of action. 6. Natural language processing, NLP. AI technologies such as natural language processing, NLP, have made it easier for users to interact with accounting systems. Chatbots and virtual assistants. AI-powered chatbots and virtual assistants can answer accounting-related queries, provide information, and perform tasks like generating reports or processing transactions. This improves accessibility and user experience. Document processing. NLP can analyze and interpret unstructured data from documents, such as contracts or emails, extracting relevant financial information and integrating it into the accounting system. 7. Fraud detection and prevention. AI has significantly improved the ability of accounting systems to detect and prevent fraud. AI can analyze large volumes of transactions to identify patterns and detect anomalies that may indicate fraudulent activity. It can flag suspicious transactions for further investigation. Behavioral analysis. AI can monitor user behavior to detect unusual activities such as unauthorized access or attempts to manipulate financial data, helping prevent internal fraud. Example to illustrate how AI works in accounting. Let's consider a small business, Green Tech Solutions, that has implemented an AI-powered accounting system. 1. Automated data entry. The AI system automatically captures data from scanned invoices and receipts, eliminating the need for manual data entry. It reads the details such as the date, amount, and vendor and enters them into the appropriate accounts. 2. Invoice processing and payment. When GreenTech receives an invoice, the AI system scans and processes it, matching it with the corresponding purchase order and receipt. If everything matches, it schedules the payment automatically. 3. Real-time financial reporting. The AI system provides real-time financial reports, allowing the business owner to see up-to-date information on revenue, expenses, and cash flow. The owner can access these reports from any device, anywhere. 4. Predictive analytics for forecasting. The AI system analyzes past sales data and predicts future revenue trends. This helps GreenTech plan its budget and make informed decisions about investments and expenses. 5. Continuous auditing and compliance. The AI system continuously monitors transactions for compliance with financial regulations. It automatically flags any suspicious activities or discrepancies for further review by the auditor. 6. Natural language interaction. The business owner can ask the AI-powered virtual assistant questions like, "What were our total sales last month?" or "Generate a profit and loss report for the last quarter." The assistant quickly provides accurate answers and generates the requested reports. 7. Fraud detection. The AI system analyzes transaction patterns and detects any unusual activities that could indicate fraud. For example, if an employee tries to make an unauthorized payment, the system flags it for further investigation. Conclusion. AI has profoundly impacted accounting systems by automating routine tasks, enhancing accuracy, improving financial analysis and reporting, streamlining auditing and compliance, and enabling better decision-making. AI technologies such as natural language processing, NLP, and predictive analytics have made accounting systems more powerful and user-friendly. By implementing AI-powered accounting systems, businesses like GreenTech Solutions can save time, reduce errors, prevent fraud, and gain valuable insights into their financial data. This comprehensive approach helps businesses operate more efficiently and make informed decisions, ultimately contributing to their success and growth. Risks that AI might bring for an accounting system. While AI brings numerous benefits to accounting systems, it also introduces several risks. These risks need to be carefully managed to ensure that the adoption of AI in accounting systems does not lead to significant issues. Here is a detailed explanation of the potential risks associated with AI in accounting systems, explained in simple terms for easy understanding. 1. Data security and privacy risks. AI systems often require access to large amounts of sensitive financial data, which can pose significant security and privacy risks. Data breaches. AI systems can be a target for cyber attacks. If hackers gain access to the system, they could steal sensitive financial information, such as bank account details, customer data, and financial transactions. Privacy concerns. AI systems often analyze personal and sensitive information. There is a risk that this data could be mishandled or exposed, leading to privacy violations. 2. Bias and discrimination. AI algorithms can sometimes be biased, which can lead to unfair or discriminatory outcomes. Algorithmic bias. AI systems learn from historical data, which may contain biases. If the data used to train the AI contains biases, the AI can perpetuate and even amplify these biases. For example, if an AI system used for credit scoring is trained on biased data, it may unfairly favor certain groups over others. Unintentional discrimination. Bias in AI systems can lead to discriminatory practices. For instance, if an AI system is used to determine loan approvals and it discriminates based on race or gender, it could lead to unfair treatment of certain individuals. 3. Lack of transparency and explainability. AI systems, especially those using complex algorithms like deep learning, can be difficult to understand and interpret. Black box nature. Many AI systems operate as black boxes, meaning their internal workings are not transparent. This lack of transparency can make it difficult for users to understand how decisions are made and to trust the outcomes. Explainability challenges. When AI makes a decision, it is often challenging to explain the rationale behind it. This can be a problem in accounting, where clear and understandable explanations are required for financial decisions and audits. 4. Dependence on quality data. AI systems rely heavily on the quality of the data they are trained on and use for analysis. Garbage in, garbage out. If the data fed into the AI system is inaccurate, incomplete, or biased, the outputs and decisions made by the AI will also be flawed. Ensuring high-quality data is critical, but it can be challenging. Data management issues. Collecting, storing, and managing large volumes of data can be complex and expensive. Poor data management practices can compromise the effectiveness of AI systems. 5. Job displacement and workforce challenges. The automation of accounting tasks by AI can lead to concerns about job displacement and changes in the workforce. Job losses. AI can automate many routine accounting tasks, which may lead to job losses for accountants and other financial professionals who perform these tasks manually. Skill gaps. As AI becomes more integrated into accounting systems, there will be a need for accountants to develop new skills to work effectively with AI technologies. This can create a skill gap if the workforce is not adequately trained. 6. High implementation and maintenance costs. Implementing and maintaining AI systems can be expensive and resource-intensive. Initial investment. Developing or purchasing AI systems can require a significant initial investment. Small businesses in particular may find it challenging to afford these costs. Ongoing maintenance. AI systems require continuous updates, maintenance, and monitoring to ensure they function correctly and remain secure. This ongoing maintenance can be costly and resource-intensive. 7. Ethical and legal concerns. The use of AI in accounting raises various ethical and legal concerns that need to be addressed. Ethical dilemmas. The use of AI in decision-making can raise ethical questions, such as how to ensure fairness and accountability. For example, if an AI system makes a mistake, it can be challenging to determine who is responsible. Regulatory compliance. As AI technologies evolve, there is a need to ensure they comply with existing regulations and standards. Additionally, new regulations may be introduced to govern the use of AI, requiring businesses to stay updated and compliant. Example to illustrate potential risks. Let's consider a hypothetical accounting firm, ABC Accounting, that has implemented an AI-powered accounting system. Here are some potential risks they might face. 1. Data security and privacy. If ABC Accounting's AI system is not adequately secured, it could be vulnerable to cyber attacks. Hackers could potentially access sensitive client data, leading to financial loss and reputational damage. 2. Bias and discrimination. If the AI system used for fraud detection is trained on biased data, it might disproportionately flag transactions from certain demographics as suspicious, leading to discriminatory practices. 3. Lack of transparency. When the AI system makes decisions about creditworthiness, the clients might not understand how these decisions are made. If a client is denied credit, it might be difficult to explain the specific reasons, leading to dissatisfaction and loss of trust. 4. Dependence on quality data. If ABC Accounting's AI system is fed with inaccurate or outdated financial data, the financial reports generated could be incorrect, leading to poor business decisions. 5. Job displacement. The automation of routine accounting tasks by AI could lead to job losses for some employees at ABC Accounting. The remaining staff might need to acquire new skills to work with the AI system effectively. 6. High costs. Implementing the AI system required a significant initial investment, which strained ABC Accounting's budget. Additionally, the ongoing maintenance and updates are adding to the firm's operational costs. 7. Ethical and legal concerns. If the AI system at ABC Accounting makes an error in financial reporting, it could be challenging to determine who is responsible for the mistake. Furthermore, the firm needs to ensure that their use of AI complies with financial regulations, which may require regular audits and updates. Conclusion. While AI brings many benefits to accounting systems, it also introduces several risks, including data security and privacy concerns, bias and discrimination, lack of transparency, dependence on quality data, job displacement, high costs, and ethical and legal issues. It is essential for businesses like ABC Accounting to carefully manage these risks by implementing robust security measures, ensuring data quality, maintaining transparency, providing employee training, and staying compliant with regulations. By doing so, they can leverage the advantages of AI while minimizing potential downsides, ultimately leading to more efficient and effective accounting practices. How to set up an accounting system. Setting up an accounting system is a critical step for any business to ensure accurate financial tracking, reporting, and decision-making. Here's a detailed guide on how to set up an accounting system, explained in simple steps to make it easy for beginners and non-accountants to understand. 1. Understand your business needs. Before setting up an accounting system, it's essential to understand your business needs. This involves identifying the type of business you have, the volume of transactions, and the specific financial information you need to track. Type of business. Determine if you are a sole proprietor, partnership, corporation, or any other type of business entity. This will influence the accounting requirements and tax obligations. Volume of transactions. Assess the number of transactions your business processes daily, weekly, and monthly. This helps in choosing an appropriate accounting system that can handle the volume efficiently. Financial information. Identify the key financial information you need to track, such as sales, expenses, inventory, payroll, and cash flow. 2. Choose the right accounting method. There are two main accounting methods, cash basis and accrual basis. Choose the one that best suits your business needs. Cash basis accounting. Revenues and expenses are recorded when cash is received or paid. This method is simpler and suitable for small businesses with straightforward transactions. Accrual basis accounting. Revenues and expenses are recorded when they are earned or incurred, regardless of when cash is received or paid. This method provides a more accurate picture of your financial position and is required for larger businesses and those with inventory. 3. Select accounting software. Choosing the right accounting software is crucial for efficient financial management. Consider the following factors when selecting software. Ease of use. Choose software that is user-friendly and easy to navigate, especially if you or your team have limited accounting knowledge. Features. Ensure the software has the features you need, such as invoicing, expense tracking, payroll, inventory management, and financial reporting. Scalability. Select software that can grow with your business. It should be able to handle an increasing volume of transactions and additional features as your business expands. Support and training. Choose software that offers good customer support and training resources to help you get started and troubleshoot any issues. 4. Set up your chart of accounts. The chart of accounts is a list of all the accounts used in your accounting system. It categorizes financial transactions and helps organize your financial data. Here's how to set it up. Create categories. Divide your chart of accounts into major categories such as assets, liabilities, equity, revenues, and expenses. Subcategories. Within each major category, create subcategories for specific accounts. For example, under assets, you might have cash, accounts receivable, inventory, and fixed assets. Numbering system. Assign a unique number to each account to make it easier to identify and reference them. For example, assets could be numbered 1,099.99, liabilities 2,029.99, and so on. 5. Record opening balances. When setting up an accounting system, you need to enter the opening balances for all your accounts. These balances represent the financial position of your business at the start of the accounting period. Gather information. Collect all necessary financial information, such as bank statements, outstanding invoices, and inventory records. Enter balances. Input the opening balances for each account in your accounting software. This includes cash in hand, bank balances, accounts receivable, accounts payable, and any other assets or liabilities. 6. Establish accounting policies and procedures. To ensure consistency and accuracy in your accounting system, establish clear policies and procedures for recording and managing financial transactions. Recording transactions. Define how and when transactions should be recorded. For example, you might decide to record sales transactions daily and expense transactions weekly. Reconciliation. Set a schedule for reconciling your accounts, such as monthly bank reconciliations. This helps ensure that your records match the actual financial activity. Documentation. Maintain proper documentation for all transactions, such as receipts, invoices, and contracts. This provides evidence for your financial records and is essential for audits and tax filings. 7. Implement internal controls. Internal controls are procedures and policies designed to protect your business from fraud and ensure the accuracy of financial data. Segregation of duties. Separate accounting responsibilities among different employees to reduce the risk of errors and fraud. For example, the person who processes payments should not be the same person who reconciles bank statements. Authorization and approval. Establish a system for authorizing and approving transactions. For instance, require managerial approval for expenses above a certain amount. Audits and reviews. Conduct regular internal audits and reviews to ensure compliance with accounting policies and identify any discrepancies. 8. Train your staff. Ensure that your staff is trained on how to use the accounting system and follow the established policies and procedures. Training programs. Provide training sessions or workshops to familiarize your staff with the accounting software and processes. User manuals and guides. Create user manuals and guides that outline the steps for recording transactions, generating reports, and performing other accounting tasks. Ongoing support. Offer ongoing support and resources to help your staff address any issues or questions they may have. 9. Monitor and review. Once your accounting system is set up, it's important to monitor and review its performance regularly to ensure it continues to meet your business needs. Regular check-ins. Schedule regular check-ins to review the accuracy and completeness of your financial records. Feedback and improvements. Seek feedback from your staff and make necessary improvements to the system and processes. Updates and upgrades. Keep your accounting software up to date with the latest features and security updates. Consider upgrading your system as your business grows and your needs evolve. Conclusion. Setting up an accounting system involves understanding your business needs, choosing the right accounting method and software, setting up your chart of accounts, recording opening balances, establishing policies and procedures, implementing internal controls, training your staff, and regularly monitoring and reviewing the system. By following these detailed steps, you can create an efficient and effective accounting system that helps you track your financial performance, make informed decisions, and ensure compliance with regulations. This comprehensive approach will set a strong foundation for your business's financial management and growth. Common accounting software options available. Choosing the right accounting software is crucial for managing your business's financial operations efficiently. There are many accounting software options available, each with its own features, advantages, and target users. Here is a detailed explanation of some of the most common accounting software options, explained in simple terms to make it easy for beginners and non-accountants to understand. 1. Overview. QuickBooks, developed by Intuit, is one of the most popular accounting software solutions, especially among small and medium-sized businesses. It offers a range of features to manage financial transactions and generate reports. Features: invoicing and billing, expense tracking, payroll processing, inventory management, financial reporting, tax preparation and filing, mobile app for on-the-go access. Pros: user-friendly interface, scalable with different plans for various business sizes, extensive integration options with other software, strong customer support and community resources. Cons: can be expensive, especially for advanced features, may have a learning curve for complete beginners. 2. Xero. Overview. Xero is a cloud-based accounting software designed for small businesses. It offers a wide range of features to simplify financial management and bookkeeping. Features: invoicing and quotes, bank reconciliation, expense management, payroll services, inventory tracking, financial reporting and dashboards, mobile app for iOS and Android. Pros: easy to use with a clean interface, strong focus on collaboration with multiple user access, comprehensive integration with other business tools, regular updates and new features. Cons: can be expensive for small businesses with limited budgets, limited customer support options compared to some competitors. 3. FreshBooks. Overview. FreshBooks is an intuitive cloud-based accounting software tailored for freelancers, self-employed professionals, and small businesses. It focuses on simplicity and ease of use. Features: invoicing and time tracking, expense tracking, project management, financial reporting, payments and billing, mobile app for managing finances on the go. Pros: very user-friendly and easy to set up, excellent customer support, Strong mobile app functionality, ideal for service-based businesses and freelancers. Cons: limited inventory management features, fewer integrations compared to some other software. 4. Wave. Overview. Wave is a free accounting software option designed for small businesses and freelancers. It offers essential accounting features without any cost, making it ideal for startups and businesses on a tight budget. Features: invoicing and billing, expense tracking, bank reconciliation, financial reporting, receipt scanning, payroll services, paid feature, mobile app for invoicing and receipt scanning. Pros: free to use with no hidden fees, simple and easy to navigate, strong invoicing and expense tracking capabilities, ideal for very small businesses and freelancers. Cons: limited advanced features. Customer support is primarily through email and the help center. Payroll services are available only in select countries. 5. Sage Business Cloud Accounting. Overview. Sage Business Cloud Accounting, formerly known as Sage 1, is a robust accounting software solution suitable for small to medium-sized businesses. It offers a range of features to manage finances and streamline operations. Features: invoicing and payments, expense tracking, bank reconciliation, financial reporting and dashboards, inventory management, project tracking, mobile app for managing finances. Pros: comprehensive set of features, strong reporting and analytics tools, good integration with other Sage products and third-party apps, scalable with options for growing businesses. Cons: can be complex for beginners, more expensive compared to some other options. 6. Zoho Books. Overview. Zoho Books is part of the Zoho suite of business applications. It is a cloud-based accounting software designed for small to medium-sized businesses, offering a wide range of features to manage financial operations. Features: invoicing and payments, expense tracking, bank reconciliation, inventory management, financial reporting, time tracking and project management, mobile app for on-the-go access. Pros: affordable pricing with various plans, strong integration with other Zoho apps and third-party tools. User-friendly interface, comprehensive features for small businesses. Cons: limited payroll features, customer support can be slow at times. 7. NetSuite ERP. Overview. NetSuite ERP by Oracle is a comprehensive enterprise resource planning (ERP) solution that includes robust accounting features. It is designed for medium to large businesses with complex financial needs. Features: general ledger and accounting, invoicing and billing, expense management, financial planning and reporting, inventory and order management, payroll and HR management, multi-currency and multi-language support. Pros: comprehensive and customizable features, scalable for large and growing businesses. Strong integration with other Oracle products and third-party apps. Advanced financial planning and reporting tools. Cons: expensive and may be overkill for small businesses. Complex implementation and setup process. Requires training and support for effective use. Conclusion: choosing the right accounting software depends on your business needs, size, budget, and specific requirements. Popular options like QuickBooks, Xero, FreshBooks, Wave, Sage Business Cloud Accounting, Zoho Books, and NetSuite ERP offer a range of features to help you manage your financial operations efficiently. Consider factors such as ease of use, features, scalability, support, and cost when selecting the best accounting software for your business. By understanding the pros and cons of each option, you can make an informed decision that aligns with your business goals and ensures effective financial management. Common challenges faced with accounting systems. Implementing and maintaining an accounting system can bring several challenges which businesses must address to ensure efficient financial management. Here's a detailed explanation of the common challenges faced with accounting systems, explained in simple terms for beginners and non-accountants to understand. 1. Data accuracy and integrity. Ensuring the accuracy and integrity of financial data is crucial for effective accounting. Inaccurate data can lead to incorrect financial statements, poor decision-making, and compliance issues. Data entry errors, duplicate records, and inconsistencies in data can all impact the accuracy of financial information. 2. Complexity and usability. Accounting systems can be complex and challenging to use, especially for individuals without a strong accounting background. The complexity of the system can lead to errors, inefficiencies, and frustration among users. A steep learning curve can also slow down the implementation process and reduce productivity. 3. Integration with other systems. Many businesses use multiple software applications for various functions, such as inventory management, customer relationship management, CRM, and payroll. Integrating the accounting system with these other systems can be challenging. Lack of integration can lead to data silos, where information is isolated in different systems, making it difficult to get a comprehensive view of the business's financial health. 4. Cost and budget constraints. Implementing an accounting system can be expensive, especially for small businesses with limited budgets. The cost includes not only the purchase or subscription price of the software, but also implementation, training, maintenance, and potential upgrades. Budget constraints can limit the ability of businesses to adopt advanced features or additional modules that may enhance the system's functionality. 5. Security and data protection. Protecting financial data from unauthorized access, breaches, and cyber attacks is a significant challenge. Accounting systems store sensitive information, and any compromise can lead to financial loss, reputational damage, and regulatory penalties. Ensuring robust security measures such as encryption, access controls, and regular security audits is essential. 6. Compliance and regulatory requirements. Businesses must comply with various accounting standards, tax regulations, and industry-specific rules. Keeping the accounting system updated with the latest regulatory changes can be challenging. Non-compliance can lead to legal issues, fines, and penalties. Ensuring the system adheres to all relevant regulations and standards requires continuous monitoring and updates. 7. Scalability and flexibility. As businesses grow, their accounting needs become more complex. Ensuring the accounting system can scale and adapt to changing business requirements is crucial. A system that is not scalable may become inefficient, slow, or unable to handle increased transaction volumes. Flexibility in the system is also important to accommodate new business processes, changes in organizational structure, and evolving financial reporting needs. 8. User training and support. Providing adequate training and support to users is essential for the effective use of the accounting system. Without proper training, users may struggle to utilize the system's features fully, leading to errors and inefficiencies. Ongoing support is also necessary to address issues, provide updates, and ensure users are aware of new functionalities. 9. Customization and configuration. Every business has unique accounting needs, and the ability to customize and configure the accounting system to meet these needs is important. However, customization can be challenging and time-consuming. Over-customization can also lead to a system that is difficult to maintain and upgrade. Striking the right balance between customization and standardization is crucial. 10. Data migration. Migrating data from an old system to a new accounting system can be complex and risky. Ensuring all data is accurately transferred without loss or corruption requires careful planning and execution. Data migration issues can lead to significant disruptions and inaccuracies in financial records. 11. System updates and maintenance. Keeping the accounting system updated with the latest features, security patches, and compliance requirements is necessary for smooth operation. However, updates and maintenance can cause downtime and disrupt business operations. Regular maintenance is essential to ensure the system remains efficient and secure, but it can be challenging to manage without affecting productivity. Conclusion. Implementing and maintaining an accounting system involves several challenges, including ensuring data accuracy, managing complexity, integrating with other systems, handling costs, protecting data, complying with regulations, ensuring scalability, providing user training and support, managing customization, migrating data, and performing system updates and maintenance. Addressing these challenges effectively is essential for achieving efficient financial management and leveraging the full potential of the accounting system. By understanding and preparing for these common challenges, businesses can implement robust strategies to mitigate risks and ensure the successful operation of their accounting systems. How to deal with problems and challenges while using an accounting system. Managing an accounting system effectively requires addressing various challenges and problems that can arise. Here's a detailed guide on how to deal with these issues, explained in simple terms to make it easy for beginners and non-accountants to understand. 1. Ensuring data accuracy and integrity. Problem. Inaccurate data can lead to incorrect financial statements and poor decision-making. Solution. Regular audits. Conduct regular audits and reconciliations to ensure the accuracy of your financial data. Double entry system. Use a double entry bookkeeping system where every transaction is recorded in two accounts, which helps in cross-verifying data. Automated tools. Use automated data entry tools and validation checks to minimize human errors. Training. Train staff on proper data entry procedures and the importance of data accuracy. 2. Managing complexity and usability. Problem. Accounting systems can be complex and difficult to use for individuals without a strong accounting background. Solution. User-friendly software. Choose accounting software with an intuitive and user-friendly interface. Training programs. Provide comprehensive training programs for users to familiarize them with the system. User manuals. Develop clear and concise user manuals and guides. Ongoing support. Ensure that users have access to ongoing support and resources to help them navigate the system. 3. Integrating with other systems. Problem. Integrating the accounting system with other business systems can be challenging. Solution. API integration. Choose accounting software that supports API integration, which allows different systems to communicate with each other. Professional assistance. Consider hiring IT professionals or consultants to assist with integration. Standardized data formats. Use standardized data formats to ensure compatibility between systems. Regular testing. Regularly test the integration to ensure data is accurately transferred and synchronized. 4. Managing costs and budget constraints. Problem. Implementing an accounting system can be expensive. Solution. Budget planning. Create a detailed budget plan that includes all costs related to the accounting system, such as software, implementation, training, and maintenance. Affordable options. Look for affordable or free accounting software options that still meet your business needs. Phased implementation. Implement the system in phases to spread out costs over time. Evaluate ROI. Regularly evaluate the return on investment, ROI, of the accounting system to ensure it provides value for the money spent. 5. Ensuring security and data protection. Problem. Protecting financial data from unauthorized access and cyber attacks is crucial. Solution. Strong passwords. Use strong, unique passwords for all user accounts and change them regularly. Access controls. Implement access controls to ensure only authorized personnel can access sensitive data. Encryption. Use encryption to protect data both in transit and at rest. Regular backups. Perform regular data backups to protect against data loss. Security audits. Conduct regular security audits to identify and address vulnerabilities. 6. Complying with regulatory requirements. Problem: keeping the accounting system updated with the latest regulatory changes can be challenging. Solution: stay informed. Keep up to date with the latest regulatory changes and requirements. Compliance software: use accounting software that is regularly updated to comply with the latest regulations. Professional advice: seek advice from accounting professionals or legal experts to ensure compliance. Internal policies: develop and implement internal policies and procedures to ensure compliance with regulations. 7. Ensuring scalability and flexibility. Problem: as businesses grow, their accounting needs become more complex. Solution: scalable software. Choose accounting software that is scalable and can grow with your business. Modular approach: use a modular approach where you can add or remove features as needed. Regular reviews: regularly review your accounting system to ensure it meets your current and future needs. Flexible plans: opt for software that offers flexible plans and pricing options. 8. Providing user training and support. Problem: without proper training, users may struggle to utilize the system fully. Solution: comprehensive training. Provide comprehensive training sessions for all users. Online resources: develop online resources such as video tutorials, FAQs, and step-by-step guides. Help desk: set up a help desk or support team to assist users with any issues they encounter. Regular updates: keep users informed about any updates or changes to the system. 9. Managing customization and configuration. Problem: customizing the accounting system to meet unique business needs can be challenging. Solution: needs assessment. Conduct a thorough assessment of your business needs before customizing the system. Professional services: consider hiring professional services for complex customizations. Standardization: use standardized processes and configurations where possible to reduce complexity. Documentation: document all customizations and configurations for future reference and maintenance. 10. Handling data migration. Problem: migrating data from an old system to a new accounting system can be complex and risky. Solution: planning. Plan the data migration process carefully, including a timeline and resource allocation. Data cleansing. Cleanse data before migration to remove duplicates and correct errors. Testing. Conduct thorough testing of the migration process to ensure data accuracy. Backup. Create a complete backup of all data before starting the migration process. Professional assistance. Consider hiring professionals or consultants with experience in data migration. 11. Performing system updates and maintenance. Problem: keeping the accounting system updated and maintained can cause downtime and disrupt operations. Solution: scheduled updates. Schedule updates and maintenance during non-business hours to minimize disruption. Automatic updates. Use accounting software that offers automatic updates to ensure you have the latest features and security patches. Regular maintenance. Perform regular system maintenance to keep the software running smoothly. Backup and recovery. Implement a backup and recovery plan to protect against data loss during updates. Conclusion: dealing with problems and challenges in an accounting system involves a combination of planning, training, security measures, and regular maintenance. By ensuring data accuracy, managing complexity, integrating systems, controlling costs, protecting data, complying with regulations, scaling the system, providing training and support, handling customizations, managing data migration, and performing updates, businesses can effectively address these challenges. Implementing these strategies helps maintain a robust and efficient accounting system that supports accurate financial management and informed decision-making. Welcome back, dear students. Today, we are learning about an essential topic that helps accountants and computer systems stay organized and efficient. That topic is called coding. It is part of how accounting software works behind the scenes, and it makes financial data easier to manage. We are studying from Chapter 3, Part 9, subsections 9.2 and 9.3 of your FIA FA1 book. Let's take it step by step. What is coding in accounting? Coding is the process of giving numbers or letters to accounts so they are easier to identify, record, and process by a computer system. Think about it like this. If I ask you to find sales of raw materials to client number 75 in a huge report with thousands of entries, it may take a long time. But if every account or transaction has a code like code 00 for sales, you can search and find it quickly. So we use codes to make accounting faster, cleaner, and more accurate. Why is coding important in computerized accounting? In modern accounting systems, computers process information using codes because codes are shorter than long names. They reduce typing errors. They allow automation. They organize data better in large businesses. Just like how your home has an address or your mobile has a phone number, every general ledger account also has a unique code number. Examples of general ledger codes. Here are examples of simple two-digit codes that may be used in the general ledger. 00, sales. 01, non-current assets like equipment or buildings. 05, expenses. 15, purchases. 22, trade receivables, money customers owe us. 41, trade payables, money we owe to suppliers. 42, interest. 43, inventory or stock. You can already see how these short codes help organize accounts clearly. Instead of writing purchases again and again, the system uses 15. Note, these numbers are just examples. Different companies may use different coding systems. What about receivables and payables ledgers? Just like the general ledger, the receivables ledger and payables ledger also need codes. Every customer and every supplier should be given a unique code number. This makes it easier to track who owes you money or whom you owe money to, especially if you have hundreds of suppliers and customers. Section 9.3, a complete example of how coding works. Let's look at a real-life example from the FIA FA1 book. Imagine this situation. You receive an invoice from one of your suppliers. Their supplier code is 1234. They are billing you for $3,000 for purchasing raw materials. So how do we enter this into the computer? Let's break it down. Supplier code 1234. This is the code given to the supplier. General ledger entry. In this case, code 15 is used for purchases. Code 41 is used for trade payables. So the entry would be debit account 15 purchases, $3,000. Credit account 41 payables, $3,000. In short, purchases increase, debit money we owe increases, credit. This keeps the double entry accounting system correct. Inventory information. We also record extra details. Value $3,000. Inventory code 56742. Quantity of items received, 150 units. Final input summary. Here's the final coded input to the computer system. Supplier code 1234. Debit 15 $3,000. Credit 41 $3,000. Inventory code 56742. Quantity 150. Why is this coding example useful? Let's explore why this coded entry is so powerful. 1. It updates multiple ledgers at once. The payables ledger, showing what we owe the supplier. The general ledger, updating purchases and liabilities. The inventory records, showing what goods we received. 2. It supports both financial accounting and cost accounting. The value of raw materials is recorded correctly. The inventory code can help with further analysis, like which department or product line received the goods. 3. It allows better reporting and decision-making. Managers can track how much we are buying. Accountants can make sure every cent is recorded. Auditors can easily trace every entry using codes. Final summary. What you must remember. Coding is a method of giving numbers to accounts for easier identification and faster data processing. It is used in general ledger, receivables, and payables ledgers. Codes reduce confusion, improve accuracy, and help systems work better. In a coded entry, you record the supplier code, the purchase and payable codes, and the inventory details. This process helps in keeping all records connected and accurate. Teacher's final tip. If you want to become a great accountant in today's world, learn how computers think. They think in codes, not words. Once you understand coding, you will become faster, more accurate, and more professional in everything you do. Welcome, future accountants. Today's lesson is about a practical and powerful tool that every modern accountant must understand and use: the accounting software package. This software is one of the most important parts of a computerized accounting system. Whether you are a beginner or have never touched accounting software before, by the end of this lesson, you will know what an accounting package is, why it is used, what it helps you do, how it makes accounting easier, safer, and faster. Let's break it all down in a very simple, clear way. What is an accounting package? An accounting package is a special type of computer software that helps manage all the financial information of a business. It is like a digital office assistant that records all types of financial transactions, automatically performs calculations, prepares reports, keeps accounts organized, stores data securely, connects different parts of the business together, like payroll, purchases, inventory. An accounting package does the work that used to take out hours using pen, paper, and calculators. Now it can be done in just a few clicks. What can you do with an accounting package? Here are some of the core tasks that you can do using an accounting software package. Enter financial transactions. You can input all types of financial data such as sales made to customers, purchases from suppliers, payments made, money received, bank transactions, payroll entries. Generate reports. It allows you to create important financial reports instantly. Income statement, profit and loss account, balance sheet, trial balance, customer or supplier statements, inventory summaries. Manage accounts automatically. The system updates the correct accounts without you having to manually do double entry bookkeeping. For example, if you buy something on credit, it will increase purchases, increase trade payables, record the supplier's balance, all done automatically. Logging in, password protection. When you first begin using an accounting package, the system will ask you to log in using a password. This is for security, to protect sensitive financial information. Different users may have different access rights. For example, a junior staff may only be allowed to enter data. A manager might have full access to view and approve reports. A payroll clerk might only access salary, and employee records. This setup ensures that only the right people can see or change certain types of information. Menu and navigation. After logging in, you will usually see a menu or a dashboard. It might show you options such as enter data, view reports, print invoice, search accounts, update bank records. Modern accounting packages use icons and buttons so you don't have to type commands. You just click, select, and go step by step. Everything is designed to guide you through the process, even if you are not an expert in computers. Example of using an accounting package in real life. Let's say you receive an invoice from a supplier for buying office furniture worth $3,000. Here's what the software lets you do. 1. Click on Enter Purchase Invoice. 2. Select the supplier name or code. 3. Enter the date and amount. 4. Choose the correct expense account, e.g., furniture and fixtures. 5. Click Post or Save. Once done, the system will automatically record the transaction in the general ledger, update the supplier's balance in the payables ledger, adjust the budget or financial reports instantly. This one action updates multiple ledgers and prepares your reports, saving you lots of time and avoiding errors. Benefits of using an accounting package. Let's now look at the main advantages of using accounting software over doing it manually. Speed transactions are recorded much faster. Reports are generated instantly. Accuracy. Automatic calculations reduce human. Double entry is done correctly by the system. Security. Passwords protect financial data. User permissions limit unauthorized access. Storage and backup. All data is stored safely on a computer or cloud. You can back up your data in case of emergencies. Real-time monitoring. You can check balances and reports anytime. No need to wait till the end of the month. Important while the software helps a lot. It only works as well as the person using it. That means you still need to understand basic accounting rules, debit, credit, account types. You must enter correct data. You should know how to choose the right account codes. You must know when to generate and check reports. The computer only follows instructions. You are the accountant who makes decisions. Summary. Key learning points. An accounting package is software used to manage financial data. It replaces manual bookkeeping with a faster, more accurate system. You log in using a password, which controls who can access which parts of the system. The system has menus with clear options like Enter Data or Print Report. It handles double entry, ledger updates, and report generation all at once. It offers many benefits: speed, accuracy, security, automation, and report creation. Final words from your teacher. Learning to use an accounting package is like learning to drive a car. At first, it might seem like there are too many buttons and options, but with practice, you will get used to it. And just like a good car takes you where you want to go, a good accounting package takes your business to financial clarity and success. Would you like me to create a PowerPoint version of this lecture or a step-by-step visual guide showing how a user works inside an accounting package? Welcome, students. Today, we will explore the idea of modules in accounting systems. This may sound like a technical word, but by the end of this session, you'll understand it clearly, even if this is your very first accounting lesson or if English is not your first language. What is a module? In the context of a business accounting system, a module is a program or a specialized section within an accounting software package that focuses on one particular area of work. Think of an accounting software as a large office building. Each room in that building has a unique purpose. One room might be for sales, another for payroll, another for tracking stock. These rooms are like modules in your software. When you open a module, you only see the tools and information related to that part of accounting. For example, if you are inside the payroll module, you won't see sales invoices or inventory levels. You'll only see salary records, employee information, and tax deduction calculations. This organization makes the system easier to use, safer, and more efficient because people only access the part they need without getting lost in unrelated data. Single module versus multiple modules. Some accounting software packages are very simple and include only one module. This is called a standalone module. It's like having a one-room building. Everything you do happens in that single space. For example, a very small business might only use invoicing software to issue bills to customers and record payments. However, most modern accounting packages contain several different modules, each performing a different task but connected to each other. When multiple modules work together in one software, we call it a suite. In a suite, information can flow between modules automatically. For example, if you record a sale in the invoicing module, that information will instantly update the receivables ledger, the inventory records, and even the general ledger without you having to re-enter the data. Different types of modules in an accounting system. To understand how modules work, let's imagine you work for a medium-sized company using a full accounting software suite. The suite may include the following: Invoicing module. This module is designed for creating and managing invoices. Whenever your company sells a product or service, you open this module, fill in the customer's details, describe the product, set the price, and add any applicable tax. Once you confirm the invoice, it is recorded in the system, and the receivables ledger is updated automatically to show that the customer owes you money. Inventory module. This module keeps track of the goods your company owns and stores. It tells you how many items you have, where they are stored, and their total value. When a sale happens, the system reduces the stock level in the inventory module so you always know the exact quantity left. This prevents problems like selling items you don't have in stock. Receivables ledger module. This part of the system records all the money owed to your business by customers. It tracks the due dates, the amounts, and whether payments have been made. If a payment is overdue, the receivables ledger helps you follow up with reminders or late payment fees. Payables ledger module. While the receivables ledger shows what customers owe you, the payables ledger records what your company owes to suppliers. It keeps track of payment deadlines so you can pay bills on time and maintain good relationships with your vendors. General ledger module. This is the core of the accounting system, often called the heart of the software. It collects information from all the other modules and produces the main financial statements: the income statement, the balance sheet, and the trial balance. It is the master record of all financial transactions. Payroll module. This module deals with employee payments. It calculates wages or salaries, deducts taxes, records overtime, and produces payslips. In larger companies, the payroll module might also connect with government tax systems to report salary and tax information automatically. Job costing module. Some businesses work on projects or specific jobs, such as construction companies or event planners. This module helps track the cost of each job separately, including labor, materials, and other expenses. This way, the company knows if the job was profitable or not. Non-current asset register module. Every company owns items like land, buildings, machinery, or vehicles that are used for more than 1 year. This module records all these assets, tracks their purchase date, value, and depreciation, the reduction in value over time. This is essential for accurate reporting and tax calculations. Report generator module. This is like the reporting office of the accounting system. It allows you to create customized reports for decision-making, such as monthly sales performance, expense analysis, or cash flow trends. Managers and accountants rely on these reports to make better business decisions. Why are modules important? Modules provide several key benefits. First, they keep the system organized. By dividing the software into different sections, each with a specific job, it's easier for users to focus on their work without distractions. Second, they improve efficiency, since information flows between modules automatically, reducing the need to re-enter data. Third, they enhance security by allowing access control. For example, payroll data can be restricted to HR staff only. Finally, modules improve accuracy because the integrated nature of the system means that one entry updates all relevant records. A real-life analogy. Think of a hospital. A hospital has many departments: emergency, surgery, pharmacy, radiology. Each department has a clear role, specialized equipment, and trained staff. Yet all departments work together to take care of patients. Similarly, in accounting software, each module is like a department, specialized in one area but connected to the others, so the whole organization functions smoothly. Exam tip. For your FIA FA1 exam, you should be able to define what a module is. Explain the difference between a standalone module and a suite. Give examples of common modules and describe their purpose. Explain why having multiple modules is beneficial to a business. FIA FA1 Chapter 3, Part 9.6. Integrated Software. Welcome back, team. Today we are going to slow down and really understand one of the most powerful ideas in modern accounting systems: integrated software. I will keep the language simple and the flow clear, So even if English is not your first language, you can follow along easily. Imagine your accounting system as a small city. Each part of the city has a job. One area sells goods, another keeps stock, another pays salaries, another prepares reports. In a non-integrated world, people would carry paper from one area to another, repeating the same information many times and making mistakes on the way. Integrated software is like building fast roads and smart traffic lights between those areas. When you enter information in one place, the software passes it automatically to the other places that need it. You enter once, and the system updates everywhere that is relevant. No retyping, no delays, fewer errors. The heartbeat. One action creates many correct updates. The FIA FA1 book gives the sales example, and we will make it very concrete. You create a sales invoice in the invoicing area. The moment you approve that invoice, several things happen without you entering the details again. First, the customer's balance in the receivables area increases by the invoice amount. This is the system posting the invoice to the customer's account so you can see how much the customer owes and when it is due. Second, the inventory area reacts. If the invoice releases goods, the quantity on hand goes down and the value of stock reduces. The software also writes a tiny movement story. So later, you can see that these units left the store because of this invoice on this date. That movement story is your audit trail inside inventory. Third, the general ledger receives the double entry automatically. Sales income goes to the correct sales account. Cost of goods sold is recognized if your system is set up for it, and stock reduces accordingly. You did not type any debits or credits by hand. The system used its rules to do it for you. Fourth, if the sale belongs to a project or job, the job costing area records the revenue against that job. Later, when you look at profitability by job, this sale is already in the right place. Fifth, the reporting area is quietly updated. The sale joins today's totals, this week's analysis, and this month's performance. When the manager asks for a sales summary, the numbers are already there. No extra work. One action. Many correct consequences. That is integration. Explaining the integrated accounting system diagram, rich descriptive walkthrough. Let's read the diagram as if it were a story happening inside your accounting system. In the middle of this story stands the general ledger module. Think of it as the brain and permanent memory of the business. Every important financial event is finally written here as a clean double entry. One debit and one credit. Nothing is official until it lands in the general ledger, and every other box in the diagram is either feeding it information or drawing summarized information from it. Begin on the left with the receivable module. This is where the business keeps the running history of each customer. Invoices raised, credit notes issued, payments received, and amounts still outstanding. The instant a sales invoice is approved, the receivable module increases the customer's balance and sends a posting to the general ledger. The brain then records a debit to receivables and a credit to sales income, and to sales tax if the system is configured to do so. If that invoice relates to a specific project, the same document can also notify the job costing module so the revenue is recorded against the correct job. Later, when the customer pays, the receivable module reduces the balance and again sends a posting to the general ledger, so cash and receivables move in step. In short, receivables keeps the fine detail by customer, and the general ledger keeps the totals that appear in the financial statements. Slide one box to the right and you meet the payable module. This is the mirror image for suppliers. When a purchase invoice arrives, the payable module records the supplier, the due date, any early payment discount, and the amount. At the same moment, it pushes a posting to the general ledger, a credit to payables, and a debit to the correct expense or asset account. If the purchase belongs to a project, the payable module also notifies the job costing module so that materials or subcontractor charges are assigned to the right job. When the bill is paid, the payable balance drops and the general ledger reflects the cash outflow automatically. Again, detail lives in payables. The official totals live in the general ledger. Now look at the payroll module. Here the system calculates gross pay, taxes, pension contributions, and the final net pay for each employee. When payroll is posted, the module pushes several tidy entries into the general ledger at once. Wages expensed to the appropriate cost centers, liabilities for tax and social charges, and a reduction in cash when salaries are paid. If staff worked on projects, the payroll module also passes labor costs to the job costing module, so each job carries its fair share of labor. This dual link, general ledger for statutory reporting and job costing for managerial analysis, is a pattern you will see again. Move further right to the inventory module. This is the live record of quantities and values held in stores or finished goods. When items are received from a supplier, inventory increases and the valuation is updated. When items are shipped to a customer, inventory decreases and the cost of goods sold is recognized. Those movements create automatic postings into the general ledger, so stock and cost of sales stay correct without manual journals. When materials are issued to a project, the inventory module also hands the material costs to the job costing module. In this way, the same document simultaneously updates stock numbers, job costs, and the accounting books. On the far right sits the non-current assets module, often called the fixed asset register. It stores the lifetime story of each long-term asset, the purchase date, cost, useful life, depreciation method, improvements, and disposal details. At month end, this register calculates depreciation and pushes the required entries to the general ledger, debiting depreciation expense and crediting accumulated depreciation, so both profit and asset values are up to date. When an asset is bought or sold, the register posts the acquisition or disposal entries to the general ledger and keeps a clear audit trail of the transaction. Return to the lower center and focus on the job costing module. This module does not replace the general ledger. It sits alongside it to answer a different question. How profitable is each job or project? It collects revenue from the receivable module when project invoices are raised, collects labor from payroll, collects materials from inventory, and collects subcontractor or service costs from payables. Because all these flows come from the operational modules that actually create them, job costing has a complete, real-time picture of every project without anyone retyping the same numbers. If your business recognizes work in progress, the job costing module can also generate journals back to the general ledger, so unfinished work is valued correctly at period end. Above the general ledger, you see spreadsheet facilities with a two-way dashed connection. This shows a controlled bridge for analysis and planning. Actual results can be exported from the general ledger into a spreadsheet for modeling, charts, and ad hoc analysis. Budgets and forecasts prepared in the spreadsheet can be imported back into the system, becoming targets that your reports compare against. Feeding those spreadsheets are two management layers. The decision support system, which helps finance and managers run scenarios. What happens to profit if sales fall by 10%? And the executive information system, which presents high-level dashboards for directors who need quick summaries rather than transaction detail. The crucial point is that both management layers draw from the same single source of truth, the general ledger's posted figures. Link everything together in a single flow and the picture becomes simple. You issue a sales invoice. Receivables updates the customer. Inventory reduces if goods are shipped. Job costing recognizes revenue if a project is involved. And the general ledger receives the official double entries for all of it. Later, you receive a supplier invoice for materials. Payables updates the supplier. Inventory increases if stock arrived. Job costing picks up the material cost for the job, and the general ledger records the liability and the asset or expense. At month end, you run payroll and depreciation. payroll, and the asset register each push their journals to the general ledger, while job costing absorbs labor for projects. At any moment, spreadsheets and management tools can pull accurate, up-to-the-minute numbers from the ledger without anyone rebuilding data by hand. Two final ideas make the integration safe. First, the system uses shared master data, one customer list, one supplier list, one item list, one chart of accounts, so every module speaks the same language. Second, every automated posting keeps a clean audit trail back to the source document and the user who created it. That means a manager can start at a total in a report, click to see the general ledger entries, click again to view the originating invoice or payroll run, and understand exactly why the number is what it is. If you remember nothing else, remember this. The general ledger is the hub. Receivables, payables, payroll, inventory, and the asset register are the spokes that feed it. Job costing gathers operational costs and revenues across those spokes. And spreadsheets with decision and executive systems sit above, reading trusted numbers from the same hub. That is how an integrated accounting system keeps every part of the business in step, fast, consistent, and audit-ready. What makes this work behind the scenes? For integration to feel magical, a few building blocks must be in place. The first is shared master data. Customers, suppliers, inventory items, tax rates, account codes, and job codes must exist once in a common place and be used by all areas. If the customer is called Ali Limited in receivables, the same name and code must be used by invoicing and the general ledger. Shared master data avoids confusion and duplicates. The second is posting rules. The software needs rules that say, for example, when a sales invoice is approved, credit the sales account, debit the receivable, reduce inventory, and charge cost of goods sold. These rules are configured when the system is set up. You do not see the equations. You simply choose the correct document, and the system follows the rules. The third is real-time or scheduled timing. In many modern systems, updates happen instantly the moment you save a document. In some systems, updates happen in short batches, for example, every 5 minutes, or when you press a post button. Both are still integration. The difference is only timing. The fourth is a clean audit trail. Every automatic movement keeps a link back to the original document and the user who did it. Later, an auditor can click from the ledger back to the invoice, from the inventory movement back to the dispatch, and from the report number back to the list of transactions. Nothing is mystery math. It is traceable. Walking through the main integrated flows. Let's narrate a few everyday flows so you can see integration in action. When you record a credit sale, the invoicing area produces the document. Receivables increases by the total. The general ledger records the income and the tax. Inventory and cost of goods sold adjust if goods are involved. The job costing area receives the revenue if a job was selected, and the reporting area refreshes sales dashboards. When you record a purchase invoice from a supplier, the payables area increases by the amount you owe. The general ledger records the expense or the asset. Inventory increases if goods came in, and the cash flow forecast updates because a payment will be due on the supplier's terms. When you run payroll, the payroll area calculates gross pay, tax, and net pay for each employee. The general ledger records wages, expense, and the liabilities for taxes and contributions. The payables area can hold the amounts due to the tax authority. And management reports update staff cost by department or job. When you add a non-current asset, such as a vehicle, the asset register stores its cost, life, and depreciation method. The general ledger records the asset and later posts monthly depreciation, and the reporting area shows asset values by category. If the vehicle is used on a specific job, the job costing area records usage or recharges. When you issue a credit note or process a return, the same integrated road works in reverse. The receivable reduces, Inventory increases if the item comes back. Sales analysis updates to show the return, and the general ledger posts the correcting entries. Because all pieces are connected, the system keeps your balances consistent. Validation, controls, and error handling in an integrated world. Integration is powerful, but it must be safe. That safety comes from validation at the input stage and controls across the system. Required fields such as date, customer, item, quantity, and price are enforced so important information is never missing. Formats are checked so codes are correct. Ranges are checked so quantities and dates make sense. These checks reduce garbage in, because garbage in would become garbage everywhere once the data flows. User permissions keep sensitive areas protected. Someone in sales can raise invoices but may not be allowed to change the chart of accounts. Someone in payroll can see salaries but cannot view customer prices. Integration shares data, but permissions control who can see and do what. If something goes wrong, for example, you chose the wrong customer, systems provide reversals or document corrections. Because of the audit trail, the correction is linked to the original, and all integrated areas are updated again, so balances remain right. At period end, accountants still perform reconciliations. Integration reduces manual work, but professionals still check subledgers to the general ledger, review suspense accounts, and confirm that the numbers tell a consistent story. Integration with spreadsheets and decision tools. The book mentions links to spreadsheets and to decision support or executive information. In practice, this means your integrated system can export clean, up-to-date figures into a spreadsheet for deeper analysis, budgeting, or charts, and it can feed summary dashboards for managers. The important point is that the data in those tools is pulled from the same single source of truth, not typed again by hand. Common benefits you will feel day to day. You save time because you enter once and the system does the rest. You gain accuracy because the same numbers flow everywhere without rekeying. You see reality sooner because reports update immediately. You work with confidence because you can click from a report to the underlying entries and then to the original document. And you collaborate better because sales, purchasing, warehouse, payroll, and finance are all looking at the same shared information. What to remember for your exam and your job. Integrated software means connected modules. An action in one module automatically updates other relevant modules, such as receivables, inventory, the general ledger, job costing, and reporting. The sales example in the book is the perfect illustration. Create and authorize a sales invoice, and the system posts to the customer account, reduces stock, and records the movement, records the sale in the general ledger, updates the job if one is selected, and refreshes sales totals for management reports, all from that single, well-validated input. When you understand this flow, you understand why modern accounting is faster, cleaner, and more reliable. Integration is not decoration. It is the engine that keeps every part of the accounting city moving in sync. All right, let's go deep into the advantages and disadvantages of integrated accounting software from FIA FA1 Chapter 3, Part 9, Point 6.1, and Point 6.2. But I'll make it extra clear, highly descriptive, and beginner-friendly so that every point is understood in context. Advantages of integrated accounting software. Integrated accounting software is designed so that all the different parts, modules of the accounting system, such as receivables, payables, payroll, inventory, and the general ledger, are linked together and work as one system. This creates a number of major benefits. 1. Single entry updates. Multiple ledgers automatically. In a traditional, non-integrated system, you might have to enter the same transaction in several different ledgers. For example, if you sold goods, you would enter the sale in the sales ledger, update the customer's balance in the receivables ledger, adjust inventory levels in the inventory ledger, and record the totals in the general ledger. With integrated software, you only enter the transaction once. For example, raising a sales invoice in the Receivables module, and the system automatically updates all other relevant ledgers. This eliminates repetitive work, reduces errors, and speeds up processing dramatically. 2. Powerful automatic reporting. Integrated systems store all related data in a connected way, which means the reporting function can pull information from all relevant files at once. Instead of you manually collecting figures from multiple places, the software can instantly produce accurate reports. For example, an income statement, an aged receivables report, or a project profitability report, by pulling live data from all the connected modules. This is especially valuable for managers who need quick answers, auditors who want complete information, or business owners who need real-time insights for decision-making. 3. Reduced workload and smoother operations. Because transactions only need to be entered once and reports are generated automatically, the workload on staff is much lighter. In older systems, users had to load and unload disks or move between separate programs to perform different tasks, which was slow and frustrating. An integrated system eliminates this, meaning less wasted time and more focus on productive work. It also reduces the stress of remembering to update every ledger manually. The system takes care of it for you. Disadvantages of integrated accounting software. While integrated systems offer many benefits, they also have some drawbacks that need to be considered. 1. Higher memory and storage requirements. Integrated systems require more computer memory than separate, standalone programs. This is because the software contains all modules, receivables, payables, inventory, payroll, etc., in one package, even if you don't use all of them. On older or less powerful computers, this could mean slower performance or less storage space for actual data. In modern cloud-based systems, this is less of an issue, but it's still relevant for businesses with limited IT infrastructure. 2. Risk of being a jack of all trades, master of none. Because one integrated program is expected to handle everything, there's a chance that it may not do every single task as well as a specialized standalone program. For example, an integrated payroll module might be less flexible than a dedicated payroll software, or its inventory module might not have all the advanced features of a specialist inventory system. This is sometimes summed up by the phrase, open quote, jack of all trades, master of none. In other words, you get the convenience of everything in one place, but you might lose the depth and customization of specialized software. Close quote. Final summary, integrated accounting software is like having all your accounting tools under one roof, sharing information instantly and reducing repetitive work. It shines in speed, accuracy, and reporting, but it demands more computer power and may sometimes lack the advanced features of standalone specialist systems. For many businesses, the advantages far outweigh the disadvantages, especially when efficiency, accuracy, and real-time information are priorities. When we talk about accounting modules, we're really talking about the different specialized sections inside a full accounting system. Think of an accounting package as a large, modern building with many rooms, and each room has its own specific purpose. One room might handle payroll, another might deal with accounts payable, and another might take care of accounts receivable. These modules are connected to each other, so information flows between them smoothly, just like doors connecting the rooms in a building. This means you don't have to keep entering the same information over and over again. Once it's entered in one module, it's available wherever it's needed. In this lecture, we're going to step inside the Receivables Ledger module, the part of the system that deals with money owed to the business by its customers. This is sometimes called accounts receivable. It is an essential part of any business that sells goods or services on credit. If you run a business and you allow customers to pay later, you need a reliable way to keep track of who owes you money, how much they owe, when they are supposed to pay, and whether they have actually paid. The receivables ledger does exactly that. How a computerized receivables ledger works. A modern computerized receivables ledger does much more than simply record the amounts customers owe. It constantly keeps the records up to date. Let's imagine a medium-sized business that sells electronics. Every time a customer buys a laptop on credit, the sales invoice is recorded in the receivables ledger. The system immediately increases that customer's outstanding balance by the amount of the invoice. But the power of the system doesn't stop there. It can automatically generate useful reports and outputs. For example, it can produce daily sales listings so that management knows exactly what was sold each day and on credit to whom. It can create monthly customer statements that summarize all transactions for each customer. These are often sent at the end of the month, so customers can check their accounts and arrange payment. It can also produce quarterly sales analysis reports showing patterns and trends, like which products sell the most, which customers buy the most, and which sales periods are the busiest. The system can even produce information periodically for special purposes. Suppose your marketing department wants to send out promotional offers only to customers who have bought in the last 6 months. The receivables ledger can provide an accurate list of names and addresses for exactly that group. Or imagine a customer phones in with a question about their account. With a computerized ledger, you can search their records instantly and respond right away. The processing of receivables. When we talk about processing in a receivables ledger system, we're talking about the work a business does to keep track of how much each customer owes. Imagine each customer has their own personal account in your system, and that account is like a living record. It changes whenever the customer buys something on credit or makes a payment. The primary goal here is to update this account so it always shows the correct amount outstanding, meaning the amount the customer still owes you. Now, how do we update it? That depends entirely on the type of transaction we're entering into the system. If it's a new invoice, the amount the customer owes will increase. If it's a credit note, maybe because the customer returned goods or was overcharged, the amount they owe will decrease. If it's a remittance, a payment from the customer, the amount owed will also decrease. So the receivables ledger is like a financial diary for each customer. Every sale, return, adjustment, or payment gets recorded there, and these entries either increase or decrease the running total, the brought forward balance. When we begin processing for a new accounting period, say the first day of a new month, we start with the amount the customer already owed at the end of the last period. This is called the brought forward balance, often written as BF. Think of it like starting a new page in your diary and writing at the top, "We begin with this much debt carried over from last time." For example, if last month ended with the customer owing $500, that $500 is the brought forward balance. The carried forward balance. Once all the transactions for the period have been entered, all the invoices, credit notes, adjustments, and payments, we reach the closing figure for that customer's account. This is called the carried forward balance. It's simply the ending amount they still owe, and it becomes next period's brought forward balance. So if you start with $500, add a $200 invoice, subtract a $100 credit note, and subtract a $300 payment, you end up with $300 at the end of the month. That $300 is the carried forward balance. And when the next month begins, it will become that month's brought forward balance. Every accounting period begins with a brought forward balance. This is the amount the customer owed from the previous period. For example, if at the end of January a customer owed $500, that $500 becomes the brought forward balance at the start of February. During the new period, transactions happen that either increase or decrease this balance. If the customer makes new purchases on credit, invoice values are added to the account. Sometimes there are positive adjustments, such as adding delivery charges or applying interest for late payments. These additions increase the amount the customer owes. On the other hand, there are also deductions. If the customer returns goods, a credit note is issued, reducing the amount owed. There might be negative adjustments, like correcting an overcharge. And of course, when the customer makes a payment, called a remittance, the amount owed decreases. When all these additions and deductions are accounted for, we reach the carried forward balance, which is the amount the customer owes at the end of the period. This carried forward balance becomes the brought forward balance for the next period. Methods of updating accounts. There are two main ways to update a receivables ledger. The balance forward method is quick and straightforward. It focuses only on the total balance owed without linking payments to specific invoices. For example, if a customer owes $800 and pays $300, the new balance is simply $500. The system doesn't specify which invoice was paid. The other method is the open item method. This one is more detailed and precise. It matches each payment to the specific invoice it relates to. If a customer owes $200 on one invoice and $300 on another, and they pay $200, the system marks the first invoice as paid in full and leaves the second one unpaid. This method is more work, but it gives a much clearer picture of which invoices are still outstanding, making it easier to follow up on late payments. In fact, most accounting experts recommend the open item method because it provides better control and accuracy. Outputs. From the receivables ledger, one of the strengths of a computerized system is the variety of outputs it can generate. It can produce a complete list of all transactions posted each day. This daily record is vital for audit purposes, allowing auditors to trace and verify every single entry. It can automatically produce invoices if the package is set up to do so, saving time and reducing human error. It can also create end-of-month statements for customers, making it easy for them to see what they owe. Another very important output is the aged receivables list, which breaks down debts into categories such as less than 30 days old, 31 to 60 days old, and over 90 days old. This helps the business identify which debts are overdue and need urgent follow-up. Sales analysis reports help managers understand which products or customers are most profitable. Customer reminder letters can be generated automatically to prompt late payers. The system can also produce customer lists for marketing or mailing campaigns, and it can respond to inquiries instantly, displaying the answer on screen rather than requiring a printed report. In integrated systems, the receivables module can even send information to other modules, such as the inventory control or general ledger modules, ensuring that all records in the business remain accurate and consistent. The big advantages. The advantages of a computerized receivable system go far beyond simply keeping records. It improves accuracy, because calculations are automated and errors are minimized. It improves speed because reports and outputs can be generated instantly. It supports cash flow management because overdue accounts are spotted quickly and follow-ups can happen without delay. And it improves customer service because customer questions can be answered immediately with accurate, up-to-date information. From a management perspective, this system is a powerful decision-making tool. By analyzing payment patterns, the business can identify customers who always pay on time and those who frequently delay. Promotions can be targeted more effectively, and risky customers can be managed more carefully. In short, the receivables ledger module is not just an accounting tool. It is a vital part of running a healthy, profitable business. A computerized trade payables ledger is a special part of an accounting system that keeps track of all the money a business owes to its suppliers. These suppliers are the people or companies who have sold goods or services to the business, often on credit, meaning the payment will be made later. Just like a mirror reflects an image, the trade payables ledger is often described as the mirror image of the trade receivables ledger. The receivables ledger deals with customers who owe money to the business, while the payables ledger deals with the opposite side, the business owing money to others. One focuses on sales, the other focuses on purchases. This is why both ledgers are similar in structure and function, but their direction of flow is reversed. The main job of a trade payables ledger is to keep this record accurate and up to date. It also needs to produce various useful reports whenever the user, often an accountant, finance manager, or auditor, requests them. These reports could be used for budgeting, payment scheduling, supplier negotiations, or simply to maintain transparency in financial operations. Inputs into a trade payables ledger system. To understand what goes into this ledger, imagine you are the business owner and you receive goods from a supplier. The supplier sends you an invoice, which is a document showing the items you bought, their quantities, prices, and the total amount you must pay. That invoice will be recorded in the trade payables ledger. Sometimes you might return goods to the supplier. Maybe they were damaged or incorrect. In such cases, the supplier will give you a credit note, which reduces the amount you owe. That credit note is also recorded in the ledger. Payments you make to suppliers, whether through bank transfers, checks, or other means, are also recorded. In addition, adjustments might be made for other reasons, such as correcting errors or applying discounts. So, in short, the ledger records: all purchases made from suppliers, all returns and credit notes received, all payments made to suppliers, any necessary adjustments to the amounts owed. Processing in a trade payables ledger system. Once the data is entered, the ledger must process it. Processing means updating the outstanding amounts owed to suppliers. If you think of each supplier as having their own mini account within the ledger, then every purchase you make increases the amount you owe to that supplier, while every payment you make decreases it. In the receivables ledger, the balances are debits, money owed to you. In the payables ledger, the balances are credits, money you owe to others. Apart from this difference in balance type, the way we update the payables ledger is almost identical to the receivables ledger. For the most accurate and transparent accounting, the open item method is considered best. This method matches each payment directly against the exact invoice it is intended to pay. That way, you can easily see which invoices are fully paid, which are partially paid, and which are still outstanding. This is especially useful if you need to follow up with a supplier or resolve disputes over payment. Outputs from a trade payables ledger system. A good computerized payables ledger does more than just keep records. It can also produce valuable outputs. First, it can generate a list of all transactions posted every time the system is run. This acts like an audit trail, showing all the changes made and helping in case of any disputes or audits. Second, it can provide analyses of expenditure, breaking down how much you have spent on purchases for general ledger purposes. This is useful for management to see where the money is going and to control costs. Third, it can produce a list of supplier balances, along with a reconciliation report. This report shows the balance at the start of the month, all transactions during the month, and the balance at the end of the month. Such reports help ensure that your records match the supplier's records. Lastly, it can create copies of suppliers' accounts. These might only show the brought forward balance, the current transactions, and the carried forward balance. If full details of unsettled items are shown, the ledger is called an open-ended ledger, similar to the open item method used in receivables. In short, the trade payables ledger is an essential tool for managing the lifeblood of a business's purchasing activities. By keeping accurate, up-to-date records and producing useful reports, it ensures that the business can meet its obligations on time, maintain good relationships with suppliers, and avoid the risk of missed payments or disputes.